and the growth momentum will continue. That is a CNBC TV18 exclusive. And Commerce Minister Piyush Goyal tells CNBC TV18 that the first phase of a potential India-Israel FTA is expected to kickstart benefits for both economies. He added that the R&D is a key driver for future collaborations. On talks with the European Union and the US, the minister says that the negotiations are on case-to-case basis and we have to decide what to open up and what not. An important trading week lies ahead of us. Good morning. You're watching Power Breakfast on CNBC TV18 in the Mumbai News Center. I'm Hormuz Fatakia. Let's first take a look at how the Asian markets have started off, and they're reflecting the handover from Wall Street last Friday. Hang Seng up 1%. The Taiwanese index also up 0.4%. The Japanese markets are shut today on account of a holiday. The Kospi in South Korea trading with gains of 1% as well. The Shanghai Composite, though, trading around the flat line, not doing too much in what is otherwise a positive looking screen for the Asian markets. And that is, of course, on the back of a very strong session on Wall Street that we had last Friday. We'll talk more about that as the session goes by. Pull up the GIFT Nifty and give you an idea of how we are likely to start off. Well, after a bit of a breather that we took on Friday, the implied open is suggesting a gap up of around 85 points. So somewhere around the mark of 26,150 is what the implied open is currently suggesting is where the Nifty is likely to start off if these gains sustain by market open. But to set you up for today's trade, our research team is here. They'll tell you about the trade setup, the stocks you need to keep an eye out for, and of course the setup on the F&O side of things as well. First up, Ekta is here to tell us all the market cues that we need to watch out for. Ekta, good morning. There's a positive handover from Wall Street, but what are some of the important cues you're watching out for?
Hi, Hormuz. Morning. Well, yes, just to recap, on Friday, the markets did snap that two-day gaining streak and all of the major indices did close in the red. But what really stood out besides the equity markets is what took place in the currency markets. We had the rupee, which hit a lifetime low of 89.49. It was the biggest intraday fall we've seen in 6 months, and it was weighed down possibly by the US-India trade-related concerns, a global risk-off, which we've seen. With regards to the US markets, yes, the Dow did close 500 points higher in a big market rebound which took place as the Fed Reserve Chairman, President John Williams said that central bank could possibly cut rates again this year. And we're seeing that rebound take place in Asia as well. The US markets, however, will be closed with regards due to Thanksgiving. But nonetheless, the Asian optimism is probably going to seep into the Indian markets. But let's see whether that sustains or not. So it is indicating maybe a gap up for the Indian markets. Now, watch out for a couple of factors, which would be the rupee movement in today's trading session, the Nifty recovery and sustaining above 26,100, mid caps underperforming because the mid caps were down 1% last week versus the Nifty, which was up around 1%, and the IT outperformance because the IT sector itself was up around 2% last week. And Indigo is going to be replacing Tata Motors PV in the Sensex from December 22nd. So that would be one of the stocks that I'll definitely keep on my radar.
Ekta, thank you for that update. Of course, we will keep an eye out on Indigo as well. But Sudarshan is now here to tell us all the cues from the F&O space. Sudarshan, good morning. Yet another day, yet another attempt at the record highs. But what's the F&O data indicating?
Good morning, Hormaz. So cues are looking largely mixed. If you talk about the global cues, yes, GIFT Nifty is indicating that we'll open with a gain of almost 80 to 90 points. But cues on the domestic front, especially from the F&O side, are looking largely on the short side. So first, talking about the flows in the index futures on Friday, we have seen FI selling more than rupees 800 crore. They have reduced long positions more than 1,600 contracts, and also they have added short positions of more than 2,670 contracts, and their longs exposure remains around 12%. But on the short side, they continue to be heavily shorted, and shorts exposure remains 88%. Look at the options data, what has happened. On the call side, 26,100 call has seen huge increase in the open interest. Similar thing was done for 26,250, and there was a sharp fall in the premium. At the end, premium for 26,100 was 96, 26,250. Premium was almost 39. On the put side, what happened? 26,000, 25,900. Both these put options have seen premium has fallen for these put options as well. But at the same time, there was a shedding of shares in the open interest, where the support came 25,700, where we saw increase in the number of shares in the open interest. At the same time, the premium was just like around 14. So larger range for Nifty would be 25,850 to 26,250. So I've taken the support at 25,850, resistance again 26,250. For Nifty Bank, support would be around 58,300 and resistance would be 59,450. That's around record high. Two stocks that remain in the band, SAIL and Samant Capital. Some of the stocks that I'll keep an eye on first. IndusInd Bank has been seeing fresh longs, and Max Health also has seen fresh longs even on Friday. And last one is all the defense names were under pressure, so I'll keep an eye on Mazgaon Dock.
Sudarshan, thank you for that update as well. Keep an eye out on all of these names. Take a short break. All the action from Wall Street on the other side. Welcome back. The Asian markets continue to remain steady as we speak. The Kospi is still up around 0.8%. The Shanghai Composite, though, has slipped into the red as we speak, still 0.25% lower, but the Hang Seng still holding on to gains of around about 1%. The GIFT Nifty at the start of the show was around about 80 points high, still continues to remain at those levels. So a gap up nonetheless is what we are anticipating. On to Wall Street then. It was a positive session after days of selling pressure that the indices witnessed, and the Dow ending around 500 points higher. That came after the New York Fed President John Williams suggested that one more rate cut is likely in the near term. CNBC's Steve Kovac gets us a wrap of all the action on Wall Street.
U.S. markets were up sharply across the major indexes in Friday trading as Wall Street rebounded from Thursday's sell-off after a Fed member suggested another interest rate cut could be coming. The Dow gained 493 points, the S&P 500 up by 64 points, and the tech-heavy Nasdaq was up 195 points. New York Fed President John Williams said Friday the central bank could lower rates in, quote, the near term, arguing that labor market weakness poses a bigger threat than higher inflation. Those comments helped send stocks higher and help boost sentiment about another rate cut this year. The CME's Fed Watch tool put the chances of a rate cut next month at 70% after those Williams comments. The prior day, those odds were at just 40%. Paramount, Skydance, Netflix, and our current parent company Comcast formally submitted takeover offers for Warner Brothers Discovery. People familiar with the matter tell CNBC the Paramount Skydance has been weighing whether to submit a higher bid than a previously rejected offer of $23.50 a share. Both Comcast and Netflix bid only for the film and streaming assets, the Warner Brothers Studio and HBO Max. The size and structure of the offers were not immediately clear. Warner Brothers Discovery is aiming to have the sale process wrapped up by the end of December. That's what's happening here in the U.S. Back to you, Mumbai.
That's what selling pressure does to you. And John Williams saying that a rate cut is possible in the near term, not specifying that it would be December. But the markets have latched onto that in a positive fashion, and it shows in the Dow futures as well earlier this morning, still trading with gains of around 130 points, and that is reflecting across Asia and on the GIFT Nifty as well. Let's now listen into what market experts believe that the Fed will do in the December policy.
I've always said the Fed cares about the credit markets. They don't care about the equity markets directly. And I think the real issue here that so many people have been talking about is, will there be a divisive vote? Will we have 3 governors vote against Powell, or will the bankers argue the opposite? I think that's the real issue, to see what comes out of this meeting. And I think it's very important, Becky, to realize there's nothing new about this. 4 of the governors voted against Paul Volcker at one point at the instruction of President Reagan, who wanted lower interest rates. Volcker resisted. He nearly quit his job because of that.
What's causing the tremors under the market? And to me, I think the answer is, and I think the real thing is the Fed and the levered part of the markets and the tightened liquidity in those areas. It seems very clear that the Fed's cutting stance, when it went below 50%, really accelerated to the downside. And that's because the levered parts of the market that are illiquid were raising cash where they needed to raise. So you saw crypto lead to the downside. The deleveraging was happening in crypto. Investors sold what they needed to do to cover that. And I think what the market is saying, that the market now needs a third cut for this year.
It nets out as uncertain. It nets out as whatever the outcome is going to be controversial, it's going to be messy, and it will reflect a divided Fed. The market is all over the place on this, Mike. As you know, in the last 3 weeks alone, the implied probability of a December cut went from the 90% to the 30% and now to the 60s. Those are massive moves for a meeting that is on December 10th. So it reflects what you said, and this is why it's going to remain uncertain. The data isn't going to resolve this, especially as we heard that we won't get the October CPI inflation report.
Interesting developments there with regards to the Fed, despite majority of the Fed members in recent past saying that the more appropriate thing to do would be to hold on to interest rates in December. Let's see what happens on the 10th of December. But US President Donald Trump has made some important remarks in the high-stakes Ukraine-Russia peace talks on Sunday, publicly accusing Kyiv's leaders of showing zero gratitude for the US support. Now, this comes as US officials in Geneva were working towards showing a united front. Trump's Truth Social comments landed at a delicate moment. His administration is pressing Ukraine to accept a 28-point peace proposal by Thanksgiving, even as the confusion over the plan's authorship and concerns from the European allies and US lawmakers have raised questions about whose interests it serves. US officials, the senior ones, including Secretary of State Marco Rubio and Special Envoy Steve Witkoff, met with Ukrainian officials in Geneva this weekend to move the peace talks forward with a goal of ending the war. Meanwhile, President Volodymyr Zelensky said that Ukraine was grateful to the US and to President Donald Trump for all the efforts aimed at helping Kyiv. He said, and I quote, "Ukraine is grateful to the United States, to every American heart, and personally to President Trump for the assistance that, starting with the javelins, has been saving Ukrainian lives." These comments come after Trump said that Ukraine's leaders had expressed zero gratitude for their assistance. As we slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away, introducing the CNBC TV18 all-new app, which gets you breaking news, in-depth articles and financial world updates right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that is up on your screens. We take a short break. We'll be back with more on the other side. Stay tuned. Welcome back. Now, Manisha Gupta joins in with all the updates from the commodity space. Manisha, good morning. What's on your radar today?
Thank you for that, Hormuz. Well, I'm looking at the dollar index trading at a 6-month highs as investors assess the U.S. Fed monetary policy outlook. The markets now are pricing in a higher 69% chance of a 25 basis point rate cut. There are fiscal strains in Europe, and it's the reason that we've seen those currencies, including the pound sterling and euro, decline versus the U.S. dollar. That in turn should have been helpful for commodity markets, but that's not what we are looking at right now. Because when you look at the crude oil prices, we are trading at a 1-month lows. A decline of 3% is what crude has done in the month of November till time. It's on track for a 4th monthly decline, but what the street will watch out for is the possibility of a Russia-Ukraine peace deal. That is what is taking premium off the crude oil prices. In the metal space, whether it's gold, silver, copper, aluminum, all of these metals have seen a bit of a decline. It is a strong U.S. labor data, the dovish central bank signals, soft U.S. yields, all of that continues to weigh onto the market.
Manisha, thank you for that update there from the commodities market. Now, as Royal Enfield celebrates 125 years, the company's CEO takes a ride with CNBC-TV18's Parikshit Luthra on the streets of Goa to take us through the experience of their motorcycles. Take a look.
We'll just go for a spin and then we'll come back and start talking about it.
I think great idea. I'll choose the cruiser. Let's get ready. Let's put our jackets on. We'll take a quick spin and come back.
Come.
All right, let's
Can't
start.
Stop.
Speaking to CNBC TV18 on their 125th anniversary, Royal Enfield CEO says that they will continue to focus on middleweight motorcycles and also takes us through the journey over the years. Listen in.
Go with 125th year of Royal Enfield. You're entering into your 125th year. Could you give us a sense of the vision going forward?
See, Royal Enfield is the oldest motorcycle brand in continuous production for the past 125 years. Very few brands can actually climb. Over this 125 years, this brand has gone through a lot of challenges, some seminal moments, but yet it withstood all the storm and became very successful. Primarily, we started making motorcycles in the middleweight segment. That's where the focus is. As an organization, we had a choice at a point of time what sort of a motorcycle we have to make. We took a decision and we said that less is more. We won't do too many things. We will focus on middleweight. And continuously we have been doing it. So at a point of time we were making 4,000 motorcycles per month. Currently we make almost 4,000 motorcycles per day. And last year we crossed about 1 million motorcycles. So that has been a success story for Royal Enfield. What is that? It's built based on what? It's built based on our understanding with the community and ride with the community. We are riders, myself, Siddharth, we all ride, and our top management ride. So we ride with the community, learn from them, come back, go to the drawing board, design the motorcycles, make the motorcycles, ride, test it, take it back to the community. That's what it is. In fact, the Motoverse is our annual motorcycling festival. We do every year. In fact, this year we had, if I'm right, about 35,000 plus footfall. And this is a place where we celebrate motorcycles, customs, art, music. That's why every year we make it bigger, better. So that's the Royal Enfield as a DNA. From here, what do we see? We do see the motorcycling culture, which is getting built, and we are an evangelist in a way. We want the motorcycling culture to spread across the globe. In India, in fact, we have been very successful, and we hold a market share of almost about 89% in the middleweight. Outside India, we are holding a market share of almost 9% in the middleweight, but still we see there's a huge scope for us to create one more success story, what we have created in India.
We'll definitely touch base with Parikshit sometime in the day to ask him whether he had fun riding that Royal Enfield motorcycle. On to other updates then. Prime Minister Narendra Modi addressed the G20 leaders at the summit in Johannesburg in South Africa, where he underlined India's approach to AI and also extended an invitation to all the leaders to attend the AI Impact Summit, which is to be held in India in February of next year. The Prime Minister also met with Canada's Prime Minister Mark Carney, Italian Prime Minister Giorgia Meloni, and the IMF chief on the sidelines of the summit. And as we wrap up on Power Breakfast, we leave you with some heartening news. India has won the inaugural T20 Blind Women's World Cup after defeating Nepal by 7 wickets in the final played at the Pisara Oval in Colombo. Phula Saren top scored for India in the run chase with 44 not out. India had beaten Australia in the first semi-final, while Nepal had won against Pakistan in the second semi-final on Saturday. More glory for India in the World Cups. But with that, we take your leave on this edition of Power Breakfast. From me and the team, thank you so much for watching. Bazar Morning Call on the other side to set you up for the day's trade.
countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Moti Oswal studios. Start of a fresh week, Monday morning. I'm Prashant. With me, my colleague Nigel. Nigel, hi. Morning.
Hi, morning, Prashant. There was a somber end last week, with the rupee in focus. But hopefully things recover from here on. Global markets pretty okay, I think so.
There was that much-needed bounce in Wall Street on Friday.
Yes.
And I think we pick up from there. So let's take it from the top with regards to where we are set up as we begin this fresh new week, right? And I'll start with, of course, the big overarching themes, which I don't think are very different, which is, of course, AI skepticism, which is still the dominant driver for markets, is the big debate point. And actually, it's too tough a question to get answers to. I mean, the simple question is whether all the investment which is going into AI and AI, building out AI infrastructure, is there tangible return at the end of the tunnel? At what point does that end of the tunnel come? And what is the return? I mean, all those questions remain unknowable, I guess, at this stage. But it's because stocks have done so well and has gotten so extreme, there is worry. Now, apart from the return on investment questions, markets are also doubting who the winners will be, right? So think about it. So far, the clear answer, the clear sort of response used to be, it's the OpenAI ecosystem, NVIDIA, OpenAI, and the other players, which the market has bid up very, very high. Last week, Google launched Gemini 3. And, immediately it topped the charts in terms of performance against ChatGPT, etc. So what that does basically is it elongates everyone else's product cycle because now they got to better this one. It means more capex, more investment, and that elusive ROI becomes even more elusive. I think it's an important point. The market has been concentrated on the OpenAI ecosystem, and suddenly you've got this Google Gemini 3, which has kind of shaken things up. So that's the other point, new thing, which I think we'll talk about as we go forward. The number two reason, AI is one. The number two reason, of course, the Fed, right? Now, I don't know why the December Fed rate cut matters so much. Whether the Fed will cut or not in December, it's 50-50 at this point in time. But it seems to, right? And the Fed, of course, has been, the September jobs data is too old. We got that. And we won't get the next jobs number, which will be bunched up. We'll only get it after the December decision of the Fed. And we will have a decision by then. But in any case, I mean, I think these are two big reasons, two big factors at play at this point. Now, just to touch upon the price action on Friday, S&P was up 1%, NASDAQ bounced about 0.8%, the Wix fell about 11%. And at the margin, what helped basically were two things. One was dovish comments from Fed's Williams, which helped equities. He basically said, I fully supported the earlier rate cuts, and I think there should be more. And there was also news at the margin that the Trump administration was considering allowing NVIDIA to sell the H200 chips, semiconductor chips, to China. Remember, China has been shut out. In the conference call, Jensen Huang, the CEO of NVIDIA, did not even mention China once. But that's a market which is basically being a big booming market, has gone to zero for NVIDIA. And this, of course, at the margin helps. It's a big market for chips. Oracle was down, and I'm just talking about Oracle because, again, this is such a big AI trade. It was down 6%. For the week, it was down 11%, and it did not recover along with the rest of the market. And that kind of highlights that this question is still there, the broader AI-related concerns. The question, of course, as we head into the end of the year is simply this, right? You had a good year. Some of the sheen has been taken off in the last fortnight or so. Will investors want to take more tactical risk and go into the end of the year with some profits in one's pocket? So will they kind of go into P&L protection mode? Or, I mean, is it going to be once again the revival of that entire risk cycle, risk sentiment in that sense? Macro markets were quiet. 10-year yield was down 2 basis points. Oil prices 1.5%. And on oil, the new thing, of course, is that, and actually it's new in the sense that, well, it's come back once again. Trump is putting immense pressure on Ukraine to accept a U.S. brokered peace plan to settle the war with Russia. And a lot of it's facing humongous backlash and criticism from European countries. But Trump apparently has given a deadline to Ukraine, that is the 27th of November, later this week, to decide what they want to do. So this is another story which is important to track. The war, of course, has gone on for 3 years now. Levels, I'll just tie in support levels, nothing more at this stage. So the 20-day for both the Nifty and the Nifty Bank remains supports, as we've been highlighting for some time now. The 20-day for the Nifty is moved up to 25,844. The 20-day for the Nifty Bank is moved up to about 58,305 levels. This is as of Friday's closing level. GIFT Nifty gives you a quick sense of where we're likely to start, and we'll pick it up from there. 85 points higher is the open today. Nigel has walked across with the F&O positioning and the lay of the land there. Nigel, over to you.
Well, what spooked the markets in Friday's trading session was the kind of spike that we saw in the Indian rupee in the final hour of trade. You know, there was that fear that maybe, in fact, the RBI has stepped aside, that trade deal that we were waiting, that's got pushed back a little bit, and maybe some outflows as well. So that was a bit of a concerning factor. You'll want to see some kind of stability on the money market with regard to the Indian rupee. So hopefully that takes place today. And in fact, the hope is that we see that rate cut in RBI. Hopefully the rupee doesn't weaken too much, because that could put a bit of a jitter in terms of that rate cut as well. So that's one point. The other factor is that, yes, we were down in Friday's trading session. The India VIX did spike up more than 10%. It's a while since we saw that kind of a spike out there. But for the week itself, the Nifty actually was an outperformer. And for the month of November, the Nifty actually has been an outperform. We were making this point, so 120 points down, but the global markets did see a sharper cut. So India did outperform. One of the reasons that we did end under pressure was the FIs. They had reduced their selling, their turn mile net buyers. They sold yet again, close to around 1,800 crores odd. That was offset by the DI buying, which pumped in close to around 3,200 crores. So the institutions, they net bought close to around 1,300 crores in Friday's trading session. What did the FIs do in the F&O market in the index futures? Well, they went ahead and they added some short positioning. 2,700 contracts is what they added. 88% of their positions are on the short side. And keep in mind, tomorrow you have the monthly expiry that will play out as well. So that's the way the FIs are set up on index futures. This market is still a heavily net short market. On the option side, well, they wrote more calls. You know, in Friday's trading session, after a while, you saw call writing. 80,000 contracts were written out there. And earlier in the week, you saw a lot of put writing. There was some unwinding of those puts that were written earlier. And the PCR that had moved to around 1.5, which is towards the upper end of the range, that's cooled down to around 1. Because the call writers came back into play. 26,200 call, 26,100 call. Aggressive writing is what we saw in both those two strikes, which caused the PCR to cool down a little bit, which is not such a bad thing. Now, punching in these levels, the technical levels, as well as what the options data is suggesting, in the near term, the 20 DMA becomes very, very important. You know, if we protect that on the downside, the bulls will say, well, we have some unfinished business at higher levels. So that 20 DMA becomes crucial on the Nifty itself. The recent high at around that 26,250, that becomes the near resistance level. So that's the broad 400-point range that I'm working with. The Nifty Bank will have to lead the way. It's lost, it lost a little bit of ground in Friday's trading session, but that's still comfortably above the 20 DMA, close to around 700 points away from those levels, 600 points or thereabouts. So that's the one that will have to lead the way. But we've been making this chatter about the Nifty moving to all-time highs, the Nifty outperforming. However, the broader markets haven't participated, which is the bit of an issue. Just look at it, a clear divergence out there. The small cap index, in fact, is still down 2.5%. So 3% underperformance is what you're seeing the small cap index. You'll want the Nifty to chug along, but gradually portfolios will feel good when the small cap index and the mid cap index catches up. So we'll keep an eye out on that catch-up trade as well.
All right, no, absolutely. And the more on this as we go along, but we'll build on this. Nigel, thanks very much for that. Now, U.S. markets ended higher on Friday, as we told you, after, Federal Reserve... the New York Federal Reserve President, John Williams, suggested one more rate cut this year. Listen in into what the market experts believe the Fed will do in December policy.
I've always said the Fed cares about the credit markets. They don't care about the equity markets directly. And I think the real issue here that so many people have been talking about is, will there be a divisive vote? Will we have 3 governors vote against Powell, or will the bankers argue the opposite? I think that's the real issue, to see what comes out of this meeting. And I think it's very important, Becky, to realize there's nothing new about this. 4 of the governors voted against Paul Volcker at one point at the instruction of President Reagan, who wanted lower interest rates. Volcker resisted. He nearly quit his job because of that.
What's causing the tremors under the market? And to me, I think the answer is, and I think the real thing is the Fed and the levered part of the markets and the tightened liquidity in those areas. It seems very clear that the Fed's cutting stance, when it went below 50%, really accelerated to the downside. And that's because the levered parts of the market that are illiquid were raising cash where they needed to raise. So you saw crypto lead to the downside. The deleveraging was happening in crypto. Investors sold what they needed to do to cover that. And I think what the market is saying, that the market now needs a third cut for this year.
It nets out as uncertain. It nets out as whatever the outcome is is going to be controversial, it's going to be messy, and it will reflect a divided Fed. The market is all over the place on this, Mike. As you know, in the last 3 weeks alone, the implied probability of a December cut went from the 90% to the 30% and now to the 60s. Those are massive moves for a meeting that is on December 10th. So it reflects what you said, and this is why it's going to remain uncertain. The data isn't going to resolve this, especially as we heard that we won't get the October CPI inflation report.
Okay, well, as I said, I don't know why that December meeting is so important, but yeah, I mean, I think no data, that basically is the point, and the decision is split 50-50 about a cut, no cut. We'll see. Well, I want to welcome in Surabhi as well, who's now in the studios. Surabhi, morning.
Morning, folks. Sorry for the delay, a bit of a hiccup getting into work this morning.
Yeah.
But anyhow, I think the world's feeling slightly better because the hope is that after that commentary that we had from the New York Fed president, that indeed that rate cut will be delivered like a December goodie around the middle of the month. And that's showing up in a lot of the Asian markets which are trading. Japan's shut. The ones that are trading are positive. Let's quickly pull up the implied open, the GIFT Nifty, and what that is suggesting, whether indeed our market will keep marching on smartly above the 26,000 mark. And yes, indeed, that's the indication right now. So let's see. For the time being, let's bring in Ed Yardeni, president of Yardeni Research, into the conversation. He's our first guest on the show. Mr. Yardeni, thanks very much for joining in. Always a pleasure having you on. So which camp are you in? Will 25 basis points get delivered in December?
I don't think so. I think the economic data is going to show that real GDP is coming in at something like 4% in the third quarter. The fourth quarter is going to be somewhat confusing with the government shutdown. But I think we're going to see the PPI this week come in a little bit on the hot side because I think tariffs continue to put some upward pressure on durable goods inflation. And I kind of stick with what Powell said at his press conference only a few weeks ago, and that was that a rate cut in December is not inevitable. And he was kind of frustrated. He said, we've already done 150 basis points cut in the past year. Maybe it's time to just kind of pause again and see how things unfold. So I think that it's not inevitable that there's going to be a rate cut, even though the president of the Federal Reserve Bank of New York made it sound as though maybe things were changing at the top levels of the Fed.
All right. Hi, Ed. Good morning. Good to see you. And Ed, a quick question with regard to the cryptocurrency market. That's falling apart. Do you see any kind of contagion to the equity markets? Point number one. And the second factor is, you're clearly clear with regard to your stance on the Fed. But with the yen weakening, there is a growing concern that Japan may go ahead and raise rates. The yen carry trade then could face some disruption, and that could spill away into global equities. Do you think that's a risk?
Well, to start with your last question, I think that we've already, about a year ago, we had a stress test of the yen trade. These things can be cleaned up pretty quickly. Mm-hmm. And I think yen traders have recognized that it's a volatile situation right now. They can't count on rates to be low in Japan. And they can't really predict where the currency is going to go. For now, it looks like it's going to go down. I do think that much of the weakness in the stock market this week related to the free fall in the crypto market, particularly in Bitcoin. A lot of people miss this, but back in July, the United States Congress and the president enacted a act called the Genius Act. And the Genius Act basically established stablecoin, dollar-based stablecoins that'll be backed by treasury bills. And that means Bitcoin really doesn't have a purpose as a transaction media, not that it ever was because it's so volatile. So that leaves it as a store of value, and that hasn't been so predictable. A couple of years ago, Bitcoin had a real fall, but then Wall Street and the Trump administration came in and took some actions that boosted the Bitcoin. I don't think they're going to do that again this time, or they've already done it. Let's put it that way. So I think Bitcoin is going to remain weak, but I think the NASDAQ increasingly is going to diverge from Bitcoin. They had been tracking each other very closely, but I don't think that continues.
Yeah. I mean, on a spectrum, I guess, Ed, right? There's technology, there's unprofitable technology, there is new age stuff, unproven stuff, and then there is Bitcoin, crypto, right? So in a way, it's the most speculative part of the spectrum, and it kind of just maybe there's a sentiment. I mean, in terms of signaling effect, it's a sentiment indicator that maybe it's. I don't know if there's anything beyond that in terms of crypto, as you say, right?
Well,
in terms of signaling value.
Yeah, look, and at the beginning of the month, I did think that there might be a pullback in the market because the bull-bear ratio that I follow was extremely high. So I concluded there's too many bulls and we need some correcting in the sentiment, and that seems to be playing out quite well. In addition to that, as you mentioned, it's not just crypto. We also have everybody kind of conceding that we really don't know what's going on with the accounting for earnings by these companies that buy these NVIDIA GPU chips. You know, we don't know how long the GPU chips can be used. There's some talk that, you know, after 1 to 2 to 3 years, they're no good anymore. You might as well throw them out. and there's others saying, no, they'll be good for 5 to 6 years so they can be depreciated over that period of time. I think this has just become, let's be honest, this is a known unknown. Nobody really knows. And as a result of that, some of the excitement and froth in the AI trade has come out, and it may stay out for a little while.
And the new thing was Google's Gemini 3 last week, right? And that's the other thing, right? Everyone just assumed that OpenAI and everyone around it is basically going to win this thing, this AI thing. And now suddenly you've got Google Gemini, which basically is topping performance charts against ChatGPT, etc. And now it kind of throws everything into a tailspin once again. So one is not sure anymore who the winner is. So there's that aspect to this as well.
Absolutely. As a matter of fact, I was using ChatGPT. I was using the Copilot version that Microsoft has. And then a couple of days ago, I switched over to Gemini 3 for some more in-depth research. I mean, I'm using them all. And I'm using AI all day as a research tool. So I think that the winners are going to be the cloud providers. They are expanding their capacity as fast as they can because the demand for that capacity continues to increase. So I think if you have a diversified portfolio of AI stocks, you'll probably do all right. But I think they're due for a bit of a pause here, and I wouldn't be surprised if the market broadens out from the Magnificent Seven, which includes most of the hyperscalers, the big AI stocks. I think it can broaden out to what I call the impressive 493.
Yeah, no, absolutely. By the way, are you paying for Gemini or using the free one?
No, at this point, I'm not. I think it's kind of on a trial basis.
Okay.
And by the time I think about paying for it, maybe somebody will come out with an even better model.
There's a new Chinese one called Kimi, Kimi. I mean, which is also apparently all these things.
Like I said, I think the LLM, the companies that sell the large language models, are not going to be the ones that make the money. It'll be simply the cloud providers.
Yeah. Thanks very much, Ed. Great speaking with you. Thank you very much for joining us. Really a pleasure having you with us here on CNBC-TV18. Well, let me just quickly run you through the interactions which are lined up here on the program. 8:35, you had the management of Jupiter live to discuss their outlook for the second half of the financial year. That's a hospital company. 9 o'clock, we have Intred Capital's Pramod Athe to discuss the ABS and ABS norms, especially for the auto sector. We'll do a quick check in terms of whether the GST-led demand boost is enduring. 9:20, we have First Global's Devina Mehra, who talks markets with us. 9:35, KEI Industries breaks down the demand momentum and outlook for the second half. The management of Chola Finance is back with us at 9:45. Impact of renewal certificate rate revision and their business outlook there. And towards the end of the program, Lata in conversation on loan growth, margins, stress in the NBFC sector with Krishnan Sitharaman of CRISIL and Jairam Sridharan of Piramal Finance. Piramal Finance as a company, as a stock, has done phenomenally once it's listed separately as well. Major.
Time to slip into a quick break. We've got a lot of stock-specific action to track for you on the other side. For the time being, I give you a sneak peek into that list. We're looking at Tata Chemicals, HG Infra, Kalpataru Projects. You have SBI Card as well. All of them will be reacting to positive news flow. On the flip side, Swiggy, Eternal, TCS, Lupin, Shilpa Medicare, as well as Natco Pharma will be reacting to negative news flow.
Welcome back. Well, the cues across Asia this morning are fairly optimistic, as is what we saw on Wall Street as well on Friday, because the market is hoping that the Fed will deliver that 25 basis points rate cut, and maybe some of that AI wobble is behind us. At least no signs of that right now as the week opens up. And because of this mood and sentiment, the implied open is also looking very buoyant, almost 80 points higher last time we checked the GIFT Nifty, and that implied open, still around 82 points up. So let's see if the Nifty today can decisively take out what has been a resistance up until now, this whole zone of 26,100 to 150. That's the watch point. Plenty of interesting news flow over the weekend, lots of stocks to watch as well. So let's straight away get to it with our list of top stocks this Monday morning. Our team is standing by. Guys, morning to all of you. There were, the labor codes, 4 labor codes finally got implemented, and it's a new era in terms of labor laws in India. But Mangalam, what impact could this have on the gig economy? So Zomato and Swiggy in focus?
That's correct. So the government had announced 4 new labor codes which go into implementation from November 21, 2025. And in that, for the first time ever, gig and social workers have officially been recognized under the Social Security for the first time. What this means is that platforms must contribute about 1 to 2% of their annual turnover, which is capped at 5% of gig worker payouts for Social Security. And this benefit should be rolled out via state welfare boards and government schemes itself. What does this mean for Eternal and Swiggy? Now, Eternal and Swiggy already provide health insurance to their riders, which amounts to about 0.7 to 1% of their overall sales. If this mandate provides for 2% of sales, the incremental hit could be about 150 to 200 crore on their gross merchandise value. This could mean a 1 to 2 rupee increase per order, which have to be passed on to the consumer. The companies want to stay EBITDA neutral out here. What is it that the companies say? They welcome the government proposal on gig worker safety, but they will await final notification before assessing any materiality out here. But the short point is it could be a hit anywhere between 150 to 200 crore on these companies. So to that extent, we may see a bit of a dip.
Okay, all right. Mangalam, thanks a lot for that. Hopping across to Rima, who's back from Japan. Good to have you back, Rima. Tell us about TCS.
Hi, good morning. Good to be back. So on TCS, there is a legal setback. So one, the US Court of Appeals has upheld that the company TCS has to pay damages worth $194 million. This case dates back to 2019, where a company called CSC, which is now a part of DXC, said that an employee, they were working on a partnership, and an employee moved over to TCS, and they used CSC's proprietary software to help TCS build out their own insurance platform and software. So basically, it's called misappropriating trade secrets. So this case goes back for more than 5-6 years now. So TCS has to pay $194 million of damages. But the good part is, in that earlier judgment, it also said that TCS cannot use there was an injunction against the company TCS using part of the trade secrets, which there was a contention about. At least that has now been vacated, which means TCS can use the software, but it's not a closed case because it's gone back for reassessment. So at least there is some wriggle room over here, but $194 million of damages. The company has said that they will be appealing this vigorously to defend their position. Back to you.
Thanks very much. And I'm not sure, Rima, when you say good to be back, you're happy to be back.
Missed us, all of us.
Smiling, but more on that later. We missed, what is that, Rima? Sorry, the audio was not on.
I said, I've got kids back home. Yes, I'm happy to be back.
All right, okay. So that's Rima back from Japan, not from Japan, but back from Japan. Well, Tata Chemicals is the next one we want to focus on. Sonal is here with details on this one. Sonal, morning.
Good morning, Prashant. Well, a couple of capacity expansion plans announced by Tata Chemicals. One of them is their major Mithapur capacity itself. They will be expanding their soda ash capacity by 350 kilotons per annum and investing 135 crore rupees for this one. It will be added in the next 24 months, and the company is doing it because they're seeing increasing applications in sustainability formats, something like battery chemicals, etc. Something that the company had spoken about in Q2 numbers as well, but they had indicated soda ash demand otherwise highs is quite low. They have a current soda ash capacity utilization of 90%, so they want to add more capacity here. Precipitate silica as well, 50 kilotons per annum is what they'll be adding with an investment of 75 crore rupees. Period in which it will be added in next 27 months. They'll be funding it via internal accruals and other options. And the rationale is growing demand in rubber and tire industry, and the capacity utilization that they have here is around 86%. So this stock will be on our radar.
Okay, so we will keep Tata Chemicals on the radar. Thank you for that, Sonal. Let's go across to Gaurav, who's watching out for all the spending patterns and trends with SBI Card. This is just after the big, bumper festive season. Gaurav, how did SBI Card fare?
Well, as if you look at SBI Card, it actually performed more or less in line with the industry, because if you look at the industry level, the overall spends that declined almost by 1.1%, while SBI Card, we saw a decline of around 1.5% on a month-on-month basis. But on a year-on-year basis, these numbers actually look good. SBI Cards actually increased almost by 25% in terms of overall spends. Now, coming to the cards in force, if you look at number of cards, there also we saw a steady increase both in terms of industry as well as SBI Cards at around 0.6%. But a key thing to highlight is that SBI Cards now gained around 26% of the incremental market share in the last 12 months. So that is something which is positive. Other than that, in terms of value, if you look at the spends, SBI Cards, they have gained almost around 65% of the incremental share in the last 12 months. So that is also something which is positive for the company. And lastly, in terms of the overall volume, it increased almost by 6% on a month-on-month basis for SBI Card. It was a bit better than the industry, which stood at around 4.7%. And overall average transaction, that number also came in a bit better at around 5% for SBI Cards versus overall 4% for the industry. So definitely a bit better performance from SBI Cards, at least in this month, for the October update that we have seen so far.
Okay, all right, Gaurav, thanks a lot for that. And I recall we had a chat with Shweta Filara, who had upgraded the stock after a very, very long time. So SBI Cards in focus. But let's get our daily dose of Pharma. Ekta joins in to help us out with news flow on Lupin, Shilpa Medicare, as well as Natco. Ekta?
Morning. Well, not looking too good for all three of these stocks. So Lupin, there was a US FDA inspection in their Goa facility. They were issued 7 observations. The inspection ended on the 21st of November. Shilpa Medicare, the US FDA inspected their Unit 4 at their Jailda facility, and they were issued around 8 observations, but they've indicated that there were no repeat observations. So maybe that should be a positive. And lastly, we had Natco, where the US FDA inspected their API manufacturing facility, which is located in Chennai, and they were issued 7 observations by the US FDA. Obviously, the detail lies, the devil lies in the details when it comes to these observations and how difficult it might be to solve, but the number of observations will probably weigh on each of these stocks.
All right. Ita, thank you very much for that. Now, HG Infra, Kalpataru projects are the other ones we want to address. Vivek has got this covered. Vivek, morning.
Well, good morning. That's right. So HG Infra, Kalpataru, they formed a JV. It's a 40-60 JV where HG Infra owns 40% and Kalpataru owns the rest. So this particular JV has been declared as L1 or the lowest bidder. This is for a Maharashtra-based metro project, the Thane Integral Ring Metro project. The EPC bid for this particular project was at 1,415 crore rupees, and the time period for construction is close to 36 months. So now what is the scope of the work? The design as well as construction of an elevated metro viaduct. HG Infra, remember, order book at the end of Q2 was in almost 14,000 crore, and Kalpataru project's order book was in excess of 64,000 crore. A positive development for both of these names.
Okay, all right, Vivek, got it. Thanks very much. So let's quickly recap our list of top stocks to watch this morning. The ones that have positive news flow around them are Tata Chemicals, HG Infra, Kalpataru Projects, and SBI Card. Stocks with negative news flow around them: Swiggy, Eternal, TCS, Lupin, Shilpa Medicare, and Natco Pharma. So that's our top 10 list on the equity side. Now let's focus our attention to the commodity markets. Manisha is joining in with the latest. Manisha, good morning. New week, new start, and the markets are hopeful of a Fed rate cut. So how are commodities digesting it?
Still looking at it, but you're right. Yes, from a nearly 40% of a probability of a rate cut to almost 70% today, clearly is a change there. And we have seen the dollar index move certainly in the positive side. It's a 6-month high, 100 is holding, and the fiscal strains in Europe also is one of the reasons that you have seen euro and pound decline, and in turn the dollar is getting support because of that as well. Having said that, this is exactly the reason that you also have seen some pressure coming in, the strength in US dollar index, that is. Take a look at the gold and silver prices. We've seen a decline come in there. Remember, we also are dealing with the strong US labor data, soft US yields, dovish central bank signals, and that has led to a decline in silver prices below $50 an ounce. Markets also are looking at copper prices trading at around 2-week lows right now. There are signs of soft demand from China, and that seems to be weighing in. A quick word on the crude oil prices then, and we're trading at a 1-month lows onto this one. It has been a 3% decline for crude prices for the month of November right now.
Okay, all right, Manisha, thanks a lot for that. For the time being, we slip into a short break. Up next, we have Dharmesh Kant, Head of Research at Chola Securities, who joins us for some fundamental stock talk. Welcome back. As promised, Dharmesh Kant, Head of Research at Chola Securities, joins us on the show. Hi, Dharmesh. Good morning. Good to see you in. Hope you had a good weekend. Dharmesh, I wanted to ask you about these new labor codes that will be introduced from November 2025. It could have a marginal impact on various companies. Mangalam just told us maybe a sentiment hit on stocks like Eternal as well as on Swiggy. These stocks have corrected a fair deal actually for various reasons from the recent peak. What's the view on both these two names?
Yeah, good morning, Nigel. Thanks for having me for the show. Even after the correction, look at the valuations where they are trading and the path to profitability. It's still wide open to justify the current valuation multiple which they are. So be it Eternal or Swiggy, Eternal is trading above almost 3 lakh crore market cap.
So this may be a slight dampener and a marginal hit, but the way the cash buzz is happening in the entire sector, I don't see next 2 years or 3 years where good profitability can come through. And eventually, if the global margins you look at, I imagine it does about 4 to 5% kind of a margin for the same sort of a business, that too in US. So in India, it can be at best be 2.5% kind of a margin. So to that extent, I mean, the stock prices can range bound. It may nudge around, say, 10-15% plus minus, but I don't see this two stocks being a wealth creator for next 3 or 4 years.
Dharmesh, hi. Good morning. Good to have you in. SBI Card. Our colleague Gaurav was just telling us that October trends have been fairly decent. And year on year, of course, there's a big pickup, but not too bad month on month either. How do you find the stock, the valuations, and would it make the cut for you?
Yeah, good morning, Survi. I mean, valuations are on the higher side, and it has been the case for SBI Cards for quite long. The only problem is the asset quality, which is still, I mean, the deterioration is above 9.5% kind of NPA problem is there. So that is the gray area for SBI Card, though this month has been good. And so has been the case with most of the, lending space. So October particularly was better in light of the GST cut and the enhanced buying, which has happened and the pent-up buying put together. So real test will come through in the month of November and December, and let's see how this entire space pans out on the microfinance and the credit card business when it comes to the asset quality front. That is still a bit of a gray area to be negotiated on. Having said that, I mean, trading rallies based on this news flow can still be there for a couple of days. And the market, to my mind, is likely to be more of a trading market from here till, say, next couple of months with budget being lined out and maybe US tariff comes through. So this will keep the bottom line in place and maybe a new high before the year end.
Okay, all right. Dharmesh, a couple of other quick questions. Then we have a lot of news in terms of pharma stocks as well. Lupin, that's the one that could be top of mind. Any view on this one? And from pharma, what do you like?
Yeah, Nigel, I mean, Lupin came out with a very strong set of numbers last quarter, and it was followed up with a good set of numbers in Q1 as well. So no, complaints out there. The numbers continues to be steady state and the growth trajectory in excess of 40%. So it may, come down to say 25-30% kind of a growth trajectory. And these companies, pharma companies, are also aided by the depreciation in the currency, which is happening. So that will keep the bottom line in place and the margins swelling up going forward because of just the INR benefit of the depreciation they are going to get. Fundamentally, if you look at all these pharma companies, incremental news flow here and there keeps on coming, and that's the nature of the business. One has to deal with that. But from a long-term perspective, I think Lupin, Zydus Lifesciences, Torrent Pharma, these all are value placed, and Lupin being cheaper of the lot compared to say a Sun Pharma or a Cipla. I think 15-20% kind of an upside traction by the time they give out their Q3 earnings is likely on the card. So any declines out there in this space should be bought into. Pharma as a space is looking very attractive, but again, the topic remains to be there is Lupin, Zydus Lifesciences, and Torrent Pharma.
Okay. All right. Stay on, Dharmesh. We'll have more questions for you in just a bit. But let's also get our first corporate conversation of the morning going. Ankit Thakur, CEO at Jupiter Lifeline Hospitals, is with us now to talk about some of the trends that they've seen in the second quarter and the outlook ahead. Good to have you with us. And, if I look at the basic numbers, it seems to be a fairly steady quarter for you. There is a 17% revenue growth. Margin is at around 23.4%. But Ankit, let's start by understanding what is leading to this ARPOB growth. 16% growth, and your ARPOB, average revenue per occupied bed, now stands at just almost, just under 65,000. So just tell us, is it a better mix, or have you managed to take any price increases? And what's the outlook on this metric for the second half?
Good morning. So on the ARPOB front, we predominantly have a mix to credit for this quarter. Indore is continuing its growth journey, and because of which it is getting into more and more complex medical services, which contributes to the ARPOB growth. This is on expected lines, as we have spoken about in the past as well. And then this year also we saw slightly lower medical infections, which typically happen in Q2, which led to higher percentage of surgical cases for the quarter, which also reflect for a higher ARPOB.
So where do you see the ARPOB by the time the year ends, FY26 end? Can you aim at, say, a 70,000 kind of a mark?
So honestly, ARPOB is not a number or a lever which we try to manipulate actively. It is just a reflection of the kind of patients who walk in through our doors. And it is not something that we actively control. Having said that, we don't really expect very turbulent ARPOB movements. Broadly speaking, they should grow in line with inflation.
Okay. All right. Hi, Ankit. Good morning. Good to see you, Ben. I wanted to ask you about, there were some cashless payment differences between hospitals and insurance companies. Have you all experienced anything on this front? And if you could tell us, what is the recent update?
So currently, we don't see a lot of friction as far as we are concerned. And I have maintained multiple times that I see insurance providers and healthcare providers' relationship in the long term as a symbiotic relation. Both the industries have to necessarily grow hand in hand. So in the long term, it's a relationship of partnership. However, because in the short term, there is a little bit of a buyer-seller kind of arrangement. So from time to time, those kind of frictions may happen. But we are not seeing anything which can derail activities for either of us.
So you're continuing with the cashless facility, right?
Absolutely.
Okay, Ankit, we'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC-TV18. Good luck as you continue to execute. We'll take a quick commercial break here. We're going to come back in just a bit from now. We'll connect with Sudarshan Sukhani and Mitesh Thakkar on some technical trading ideas. We'll also bring in Karan Torani on this entire sort of new labor laws, and the implications for platform companies like Swiggy, Eternal, etc. Coming up. Welcome back. You're with us here at Bazaar Morning Call. Well, as Royal Enfield celebrates its 125 years, the company's CEO takes a ride with CNBC-TV18's Parikshit Luthra on the streets of Goa to take us through the experience of their motorcycles. Take a look.
We'll just go for a spin and then we'll come back and start talking about it.
I think great idea. I'll choose the cruiser. Let's get ready. Let's put our jackets on. We'll take a quick spin and come back.
Come.
All right, let's
Can't
start.
Stop.
Well, some nice visuals coming in there. Now, the CEO told Parikshit that they will continue to focus on middleweight motorcycles and also took Parikshit through the journey over the years. Interesting stuff. Listen in.
Go with 125th year of Royal Enfield. You're entering into your 125th year. Could you give us a sense of the vision going forward?
See, Royal Enfield is the oldest motorcycle brand in continuous production for the past 125 years. Very few brands can actually climb. Over this 125 years, this brand has gone through a lot of challenges, some seminal moments, but yet it withstood all the storm and became very successful. Primarily, we started making motorcycles in the middleweight segment. That's where the focus is. As an organization, we had a choice at a point of time what sort of a motorcycle we have to make. We took a decision and we said that less is more. We won't do too many things. We will focus on middleweight, and continuously we have been doing it. So at a point of time, we were making 4,000 motorcycles per month. Currently, we make almost 4,000 motorcycles per day. And last year, we crossed about 1 million motorcycles. So that has been a success story for Royal Enfield. What is that? It's built based on what? It's built based on our understanding with the community and ride with the community. We are riders, myself, Siddharth, we all ride, and our top management ride. So we ride with the community, learn from them, come back, go to the drawing board, design the motorcycles, make the motorcycles, ride, test it, take it back to the community. That's what it is. In fact, the Motoverse is our annual motorcycling festival. We do every year. In fact, this year we had, if I'm right, about 35,000 plus footfall. And this is a place where we celebrate motorcycles, customs, art, music. That's why every year we make it bigger, better. So that's the Royal Enfield as a DNA. From here, what do we see? We do see the motorcycling culture, which is getting built, and we are an evangelist in a way. We want the motorcycling culture to spread across the globe. In India, in fact, we have been very successful, and we hold a market share of almost about 89% in the middleweight. Outside India, we are holding a market share of almost 9% in the middleweight, but still we see there's a huge scope for us to create one more success story, what we have created in India.
Well, that was a rare and exclusive chat with Enfield's CEO. But stay tuned for more excerpts of this interesting chat all through the day on CNBC-TV18. Hoping they come out with a bigger bike as well. 650cc is good.
We have a proud owner, a happy customer, I think. Looking to upgrade.
I have only ridden the Royal Enfield all my life. The 350cc, the 500cc, the 525 Lightning as well did come in limited edition. And today I ride the 650 Interceptor. That's my preference for the bike. No comments on the stock, but I'm a loyalist, and I've tried the other brands out there, 650cc. Miles ahead.
No, I think we have to hold back Nigel. He might go riding on the bike right now otherwise.
I will say something. As avid rider, Nigel,
yeah.
ये आपकी responsibility बनती है कि आप सड़कें भी ठीक कराएं. Especially Mumbai की. Campaign चलाएं.
No.
I mean, but these bikes you ride out, right? On highways.
I mean, I don't ride too much very far right now, but I've done long rides. And you're talking about bad roads, Prashant. Just a quick word on that. You take that right turn from Nipani. The roads were terrible to ride a Royal Enfield to Goa. But on the Royal Enfield, it just feels so good, you know. I've left on a Friday night and reached on Saturday morning, beautiful, and come back to work on Monday morning.
Forget it. I've done the night one.
Oh my God, two riders.
Back in the day. But anyway, well, Hormuz is now joining us with the big movers on Friday, which saw some of the heavy volumes. What's behind the price action? Hormuz, tell us more.
Good morning, Prashant. There's a public transport user speaking to two bike riders as of now, but shrimp feed stocks continue to move higher all through last week. Avanti Feeds was one. Apex Frozen's turn on Friday and snapped a two-day losing streak. Friday's volumes were the highest on record. Over 1.5 crore shares have been traded on that stock on Friday, but out of those 1.5 crore, only 12.5 lakh shares were marked for delivery, and compared to the 20-day average of just over 1 lakh. And the stock has done well in the last 1 month. It's up 33%, and as a result of which it has also turned positive on a year-to-date basis. VLS Finance is a small cap stock, is a market cap of less than 1,000 crore. It's gained in 6 out of the last 7 sessions, but ever since it made that buyback announcement last week, the volumes have been on a downtrend every single day. And from around 8 lakh shares that were traded on last Monday during the buyback announcement, last Friday saw only 90,000 shares traded. That was even below the 20-day average. And the delivery volumes were also lesser than the 20-day average. Stock is in the stage 1 of the ASM framework as well. So VLS Finance is one. And lastly, DCM Shriram, it snapped a 4-day losing streak on Friday, and it's a very interesting trend here. One single day every month over the last 3 months, the stock has had outsized moves and outsized volumes. Now on Friday, the stock was up 8%, over 30 lakh shares traded. On the 29th of October too, the stock was up 8% with over 32 lakh shares traded. And on the 17th of September, the stock was up 12% with over 40 lakh shares traded. The last two of them, barring the October move, which was in reaction to the earnings, the other two moves don't have a specific reaction to it. Even on Friday, or 30 lakh shares traded, 20-day average of 2.2 lakh. But out of those 31.5 lakh shares traded, only 1 lakh shares were marked for delivery. That was also around about the 20-day average of around 35,000 shares. So some outsized moves on DCM Shriram, but delivery volumes being significantly lesser.
Okay, interesting stats there, Hormaz, and we'll keep some of these stocks on the radar as well. With that, let's head across to Sudarshan. He's been going through all the brokerage notes of the morning. Let's see what he found most interesting. Morning, sir.
Morning, Surbi. So first one is Shelley Engineering. UBS has initiated coverage with a buy call, and target is 4,000 rupees per share, almost 50% upside from current levels. And it says it's one of the few companies with patented technology for fixed dose and auto-injector pens, and also it's ready for the launch of generic GLP-1. Even the India-US trade deal, if it happens, it could be one of the biggest beneficiaries, and it's in the process of gaining one large customer in consumer electronics and semiconductor. UBS forecast a 75% EPS CAGR over FY 25-28. Ambit has written on NBFCs, especially auto NBFCs, and the biggest positive has come for Shriram Finance, where it has upgraded the stock to buy, and target is as high as rupees 945 per share. It says auto NBFCs slippages had risen up to 104% FY 25, but it sees asset quality cycle improving for these NBFCs over next 6 to 9 months. And that can be led by, first, increasing truck operator margin, second, reducing excess transport capacity. Also, it has reduced credit cost estimates by 14 to 50 basis points for Chola and Shriram Finance, and it expects EPS CAGR in the range of 20 to 28% over FY 26-28. And also, it has upgraded earnings estimates for both Chola and Shriram Finance by 5 to 6% and 10 to 11% respectively.
Okay, all right, so thanks very much. So we will keep some of these names, NBFCs as well as Shelley Engineering, on the radar today. Take a break. On that note, on the other side, we'll of course track the pre-opening maneuvers that the market is making, and also we'll have with us Incred Capital's Pramod Amte. We'll discuss the demand outlook for the auto sector. Welcome back. About 17 minutes to go before the day's action starts off. Let's actually turn the spotlight on HEL, because what we are dealing with is a set of very, very unfortunate, tragic circumstances. And the stock is going to be in focus on the back of that. I think we have Sudarshan joining in. Sudarshan, we all saw those absolutely heartbreaking visuals that came in on Friday evening. And obviously, I mean, it's an aircraft that has been manufactured by HAL. But tell us more about it.
Not a good day to talk about HL stock, but unfortunately we'll have to. It's our job. It was a tragic incident in Dubai Air Show involving HAL, or say Hindustan Aeronautics Light Combat Aircraft Tejas. And in that incident, Wing Commander Naman Sayal, who was the pilot, and he got killed. It's the second incident of Tejas aircraft in the last 20 months. The last one was in March this year in Rajasthan, Jaisalmer. After HL has issued statement, but Elara has today come out with a note on HL. It maintains buy call with a target of 5,680 per share. It says fighter aircraft crashes are common globally, even in the last few years. We have seen aircraft of US and China, which are a better, more advanced version of Tejas aircraft. They also were involved in crashes. So it's very common. And it believes that HL remains the key player in aircraft manufacturing in India and likely to remain a beneficiary of burgeoning order pipeline. It does not see any major financial impact because of this crash, but Tejas Mk1 exports may be delayed despite stable domestic orders, but it maintains buy call.
Okay, all right. Sudarshan, thanks a lot for joining in and giving us that piece of news. We'll track the HL stock, but prayers and condolences to the pilot, who lost his life, and the family out there as well. Strength to them in this very, very difficult time. Above all, we lost one of our pilots. Well, time to move on then and talk about the markets. Sudarshan Sukhani of Technical Trends and Mitesh Thakkar of Bonanza Portfolio join us on the show. Hi, Sudarshan. Good morning. Good to see you in. Good morning, Mitesh, as well. Mitesh, you go first. Friday's action, if you're an optimist, you'll say India outperformed the globe. If you're someone who's a little bit bearish, you'll say, hey, we ended at the low point of the day. The rupee weakness is something that hurts sentiment as well. So maybe those all-time highs will have to wait. Which camp are you and what's the trade, Mitesh? For starters, the gift would be suggesting a positive start.
Good morning, Najib. So I think, two things. Both of what you said is correct. We did better than the rest of the world. And also is the fact that we kind of retraced from the earlier highs or the historical highs, all-time highs. So I think that's a very natural reaction when any index or a stock price reaches its all-time high, which was established a couple of years back. I think you will see some profit booking from a psychological point of view. I think that's a process which the Nifty might also undergo. So therefore, I think, till now, the index gets past 26,280, 300. I think be patient. You will get those declines to enter. And on the downsides, the bigger supports I've always maintained are closer to about 25,900, 800 zone. So once you get close to them, that will be the time to, possibly be aggressive on the buying side. But for the time being, try to be moderate and trade with stock-specific biases.
Okay, all right, Mitesh, got that. Let's go to Sudarshan as well. Sudarshan, good morning. So what should the approach be? Because the market, every time we've approached this zone of 26,100, the bulls have gotten stalled in the past. So how would you approach things today?
Yeah, good morning. You're right. Every time we approach that level, something happens and we are not decisively crossing it. Look at it the other way around. The other way is that level is so significant. Whenever we cross it, as I've explained last week also, the markets will go up like a rocket. So we'll have to anticipate that crossing and wait patiently. We are not intraday traders because intraday trading doesn't make money. You have to be patient. The patience is go with the trend. The trend is up. These 1 day, 2 day moves on the downside are going to come again and again. They are corrections, they are pullbacks, they are inevitable. We should simply suffer through them. So my view is the trend is up, either be long or go long and keep a tight stop somewhere around 25,800.
Okay, fair enough. So 25,800 is the stop that Sudarshan is telling us to keep in mind. Let's also talk stocks, gentlemen, now. Mitesh, morning. What's your list looking like today?
Good morning. I have a mix of buys and sells despite the fact that the GIFT Nifty is slightly on the positive side. I have buys and two sells. On the buying side is Max Health with a stop at 1160. a recommended buy for targets of 1220 in the short term. And Siemens, which has given a good pullback over the last 3-4 days, is now close to its support areas of moving averages. So buy with a stop at 31.44. Look for targets of 32.35. On the selling side is HFCL with a stop at 73.5 for targets of 66. And on a mild pullback, BEL, looks like a stock which could possibly go through some profit booklet correction. So try to sell in the range of 419, 420. Keep a stop at 426 and look for targets of 407.
Gentlemen, morning. Sudarshan, what about you?
Well, I have 3 buys and 1 sell. I'll start with the sell. It's BSoft, Birla Soft, which is an intraday short with a stop above 390. Then NTPC is a buy with a stop under 320. Blue Star is a buying opportunity with a stop under 1750. And Tata Consumers is a buy with a stop under 1160.
Okay, those are specific trading ideas. But the rupee is opening up at the bottom of the screen. And there was, I think there was a news flash on the wires that maybe the RBI has intervened, and we'll try and sort of find the exact bid. RBI likely intervenes to prop up rupee ahead of local spot market open. That's according to traders, but that's a wire report which is coming through, and it's a bit of a move the other way. It was a massive move in the last 60 minutes. Last 45 minutes actually started at about 2:45 and then went on all the way into closing. And very few, it took out the 88.90 type, 88.80 type of levels. Very few trades all the way to where it went. So basically just a frenzied short covering move, which took it to new all-time lows, the rupee that is. And of course, the dollar appreciating against the rupee. So that's the picture. We have Pramod Amte, Head of Institutional Equity Research at Incred Capital now joining us. And Pramod, good to have you with us here. Thanks very much for joining us. And we're talking about the autos as a space, Pramod. Just give us the overall view first up on where you stand, because stocks have done well pre the GST cut, after the GST cut. What's your view on your list of stocks under coverage?
So clearly, in terms of sector, we continue to remain overweight. Couple of macro trends which have turned substantially favorable, which will play out. One, there is large stimulus for consumer demand, almost to an extent of rupees 5 trillion spread across income tax cut, interest rates, pay commission, and the GST, which is huge, which we feel will continue to play out for next 2 years plus. Historically, if you look at when such steep cuts on prices have happened, the CAGRs on the 2-year basis on the demand side has been double digit, even though the managements have been cautious to come out and guide post the festival momentum. But we feel it will sustain and it will surprise on the positive. The best cases to look at is, in spite of such tough situations like COVID or in terms of financial crisis, when interventions happen, the consumer has surprised on the auto demand. So looking at the Nifty valuation for auto sector, which is near the 10-year mean level, we clearly see a comfort and continue to remain overweight as we upgraded early September, the entire sector.
Okay, all right. Hi, Pramod. Good morning. Good to see you in. Nigel on this side. Let's focus on the two-wheeler pack first. We were just discussing about Royal Enfield. My colleague Parikshit had gone down to Goa and had a chat with the CEO, a rare interview. Do catch it during the course of the day. But from the two-wheeler pack, I believe you're more comfortable with Hero MotoCorp and Bajaj Auto. Tell us about them and rationale behind that.
So within the two-wheeler space, the way we are looking at is the mass segment players will be benefited better. One. Second, they will pull through the execution on volumes as the consumer comes through. Even if you look at the festival growth has been pretty decent without spending much on the incentives. So that's a positive for the sector. Within the two-wheelers, the way we are positioning ourselves is considering the price gap increase for EV versus ICE. The incumbent ICE players are better placed on two fronts. One, to drive the short-term growth in ICE, and also they will have a more sufficient time and money to put through for EV transition, as we are seeing even the late entrants like Hero building on to it without blinking the eye on profitability. So that is the reason why we like Hero as a topic within two-wheelers, followed by Bajaj, we have a hold on Eicher and sell on TVS.
Sell on TVS. Got it. And from the four-wheeler pack, you believe that Mahindra and Mahindra, which has been one of those most beautiful stocks, right? I mean, big returns. I recall they made that investment in RBL Bank. The stock was 1,500 approximately. It was down 6-7% odd. They have undone that measure and they've gone from strength to strength, whether it is with regard to the tractor segment, gaining market share, or focusing on the premiumization theme as well. Tell us about your preference in the four-wheeler pack.
So within four-wheelers, the start post of GST has been a little slow because of some concerns even on the cess front. Having said that, the first-time buyers we feel will come back over the next 2 years period. Historically, if you look at when interventions happened, the four-wheelers have given a superior CAGR upwards of double digit versus two-wheelers. So we feel that trend will repeat and hence a four-wheeler preference over two-wheeler will continue. Within the four-wheeler space, we again feel the first-time buyer will be in the small cars or compact SUVs. That's where our preference will be for the companies which already have it or will be taking action there. Mahindra action there is in 2027 versus Maruti, which is strengthening its portfolio in the current situation. So we prefer Maruti over Hyundai. We prefer Mahindra over Tata Motors in the four-wheeler space.
Pramod, on the auto comp side, what are the ideas, top ideas?
So within the comps, we have a limited coverage. Within tire space, we feel that the reversal to mean on profit margins are going to be sooner than expected because the price cuts have been steep and consumers may not be so much sensitive on the replacement market. We have already seen that playing out in the early part of September, October. We expect that trend to continue. Our preference there is we cover Apollo and Balkrishna. Our preference there is Apollo over Balkrishna, domestic versus international. We like Endurance, which has taken a beating post the second quarter results, but clearly 2-3 drivers which clearly look out for them is content per vehicle is increasing. One, second, they're getting into four-wheelers. They have got the magic on M&A coming through in 2 acquisitions which they have done in last 2 years. So we clearly see both organic and inorganic growth playing out for Endurance. The third one which we like is Samuel, where clearly the balance sheet is pretty decent to make a benefit of any international turmoil as we go through. So those are the preferred picks in the comp space.
Okay, all right, Pramod. Thank you very much for those thoughts and the views on some of the stocks that you like within the pack. 9:10, so let's go back and see how the session has settled. Actually, it settled quite nicely, 54 points up. And the Nifty is exactly around that zone that we were discussing with both Sudarshan and Mitesh, 26,100, which has been quite a resistance in the past. Well, can that change today? We'll find out. Gentlemen, back to you for your final stock advice, stock calls. Sudarshan, which stock will it be?
It will be Tata Consumers. Buy Tata Consumers with a stop under 1160.
Okay, and Mitesh, your stock?
I'll go with the buy and Siemens with a stop at 3144 for targets of 32.35.
Okay, all right. By the way, Eternal, as we're starting off, is about 2% lower. Swiggy is about 1.5% lower. So this is how the platform players are reacting to the new labor codes that have been ushered in. So keeping them on our radar. But for the time being, let's look at IT, because if you recall, CLSA had last week told us about their optimistic call on the sector. Well, there's one more call coming through, and it's a contrarian positive call on IT. This one's from Motilal Oswal. Rima is here with more. Rima, so what's their rationale? Why have they turned positive on IT?
Thanks so much for that. As you rightly pointed out, Motilal Oswal has upgraded Indian technology to a mild overweight. Now, there are 3 key reasons. One is, you can imagine the underperformance in Indian IT, not just over the last 1 year, where the Nifty IT index is down 12%, but even in the last 3 years, the Nifty IT index CAGR is just 3%, underperforming the index of broader markets, which have gone up 13 to 16% CAGR. Secondly, on the global front, they're saying that global AI hyperscalers are now experiencing diminishing marginal utility from infrastructure build-out, which basically means now the focus is turning away and it's shifting from infrastructure development to application and maintenance, which is where the Indian IT companies come in. And thirdly, they've done an analysis and they're saying that the IT companies' profit share in the Nifty has remained steady at 15% over the last 4 years. But the weightage has dropped to a decadal low of 10%. And they also, they go on to believe fundamentally that generative AI inflection point is a couple of, quarters away, but it will happen. So on the whole, all these factors makes Motilal Oswal upgrade IT, the tech index, from a underweight to a mildly overweight. And Infosys has now come into their model portfolio. They believe Infosys will be the big beneficiary of the enterprise-wide AI spend, and valuations at 21.7 times forward multiple are fairly attractive.
All right, Rima, thank you very much for that. So that is IT services as a space for you. By the way, I think last week the IT index was up 1.6%. And it's basically been a very, very volatile last few weeks. Big up, then a big correction. I think the week before last was bad, and then last week came up. Let's see what happens here. Platform companies, right? We want to just address those with regards to the labor laws and what they mean for the profitability here. Mangalam is with us. Mangalam, take it away.
Well, the pre-open is something to go by. There has been some disappointment out here on these stocks, but remember, from a long-term standpoint, it is a positive when it comes to labor laws, etc. So the government has announced new labor codes effective from 21st November. Gig and platform workers are now officially recognized under Social Security for the first time. And the platforms will now have to contribute 1 to 2% of their annual turnover, capped at 5% for gig workers for Social Security. The benefits would be rolled out via state welfare and government schemes. Analysts say this could be an impact of anywhere between 2% of the sales, which could mean about 150 to 200 crore for both Eternal as well as Swiggy. They already provide health insurance to their riders. This could also mean an incremental pass on to consumers of rupees 1 to 2 or at best about 3 rupees per order. The company, on their part, they welcome the government proposals on gig worker safety. They are awaiting final notification for assessing materiality. But short point, about 150 to 200 crore is the incremental spend that these companies will have to make, which over the long term would be positive for gig workers.
All right, Mangalam, thanks very much for that. So bring certainty, maybe a little bit of short-term impact. We've got market open coming up on your screens. It's up about 0.2% on the Nifty, 0.2 on the Nifty Bank. Similar amounts on the small cap index and I guess on the mid cap index as well. We'll see if you're able to build on some of this, but it's 30 points basically, around 26,100 once again on the index, 58,990 or so on the Nifty Bank, 59,000 now on the Nifty Bank. Mid caps are flat, small cap index is absolutely flat as well. Nifty 50 heat map gives you a quick sense of where we're likely to start, and then we'll pick it up from there. It is what, 25 up and 25 down as far as the screen goes. Infosys, Indigo, Wipro, etc. on one end, Eternal, Mahindra and Tata Motors passenger vehicle on the other side. Surabhi.
Yeah, absolutely. It's IT all the way, and the IT index is the best performer. I mean, so far this month it's put on about 4%, and now you have that Motilal Oswal call coming in. They are quite optimistic on basic large IT services. So Infosys, Wipro, HCL Tech Mahindra, TCS, all of those stocks up there. Infosys is leading the charge with a gain of nearly 2%. Interglobe Aviation is the other one that's flying high this morning, 1.25% up. L&T is chipping in a little bit. There's some support coming in from ICICI Bank, a little bit of green on Axis Bank as well. And then there is Lever, which is contributing about 0.25% at this point in time. Hindalco, which had obviously a rough last week thanks to another fire at Novelis. This morning it's seeing some green, 0.5% up. Now on the downside, Eternal is down about 1%. Actually, let's watch out for its peer Swiggy. It was down about 1.5% in the pre-open session. Still is. So these two stocks are down between 1 to 2%. M&M, BEL and Tata Motors are some of the other names from the Nifty, which are cooling off this morning. A lot of the auto stocks had a great last week, so there's some profit taking today. Mid-cap index, by the way, has already slipped into the negative territory. So that's something to watch. Nigel?
Well, that's right. You know, a few stocks actually that deserve special mention. I think MV Photovoltaic, that's a stock that listed last week. That's down closer on 4% or thereabouts. Hindustan Aeronautics, HAL, there was a big difference in pre-open on the BSE and the NSE. However, that has corrected itself, I think so. So now that arbitrage between the BSE as well as the NSE, both the rates are more or less similar at around 4,440. In pre-open, there was a large difference between the two out there. HG Infra, there's some positive news flow that's come in there, explains why that stock is bursting away. It's up close to around 4%. You have Karnataka Bank. That's actually an outperformer from the banking stocks. It's up 4.5%. Good move out there. And Grow. Very, very volatile stock, for the last few trading sessions post its listing. Currently, that stock is up close to around 2.5%. So that's one of the big movers today on decent volumes. You have Physicswala, the other one that's been fairly volatile, listed at a 40% premium, then corrected to 120 rupees. It's down 2% and volumes quite large as well. So net, markets, the Nifty that is, holding well in the green with a gain. But as we mentioned earlier, Nifty is moving to all-time highs. Portfolios are not feeling like that because the mid-cap and the small-cap indices have actually underperformed.
Absolutely. You got what Karnataka Bank, as Nigel mentioned, which has come up. Actually, Friday's session was very, very large for Karnataka Bank. It basically went from 175 to Friday's close of almost 190. And it's up to almost 200 now. So, 2 days now. That's pretty, almost like 15% kind of gains coming in here. NBCC is the other one, I think, which is trying to make a comeback. NetWeb is up about 1.5%. Shelly Engineering is coming up with volumes at this point. It's come off the highs. I mean, highs were about 2,800. But it's been a super, super performing stock, no doubt. I think Shyam Metallic, there's coverage on this one. So 4% on Shyam. M&M Finance, 2% higher at this point. There is Team Lease, I think we mentioned it, 9% on Team Lease, right? It's been kind of sideways for a long time now. I think if you just go back almost prices are the same levels where the stock's been about, 7-8 years ago on Team Lease. Action Construction Equipment is up about 3.5%, and so it goes.
Just two more stocks, Prashant. I don't know if you guys mentioned these or not. HG Infra and Kalpatru.
Yeah, I mentioned.
Yeah, that combination that's won that Thane Metro viaduct. These two, still up 5 to 6%. So big high flyers there.
Yeah, absolutely. Well, let's welcome in Devina Mehra, who's with us, founder, chairperson, and managing director at First Global. Devina, good morning. Great to see you, as always, here on CNBC-TV18. Now, let me just start by asking you, Devina, the basic, let me start with the premise. Typically, you would not do well by doing what everybody else is doing. And that is the reason why, these calls for buy stuff which no one else is buying and sell a little early, and that's good if there's too much euphoria. I know it's a tough one, but my question is actually simple, although I'm prefacing it with all this. Which are the areas which are absolutely unloved, which you think will do well as we peer into 2026, and vice versa?
See, that's difficult to say because, you cannot be contrarian for the sake of it. That does not make sense. The only thing where we think our system help is that it signals it a bit early. So, for example, industrial machinery, capital goods, we got in October 21. Most people discovered it a good 2.5 years later. So that sometimes happens. But I wouldn't say that this, in this current rebalance, one area which was at least unloved by us, where we have added is the energy or oil sector. So, that's been the kind of new thing which has come in, and I don't think we had any weightage there. So that is one thing which has changed this quarter. Most of the others are often not that dramatic changes. IT went from large cap IT to mid cap IT. But other than that, some of the themes have run for a while for us, like pharma, healthcare, auto components. Of course, pharma did not perform that well in between. So I think that has begun to change. PSU banks is something we added through this year. So that is, again, by now a discovered theme, you can say. So broadly, that would be, or as I said, some themes have run from last year. FMCG has been built up over this year. Again, liked more and more by our systems as time went by.
Devina,
and I don't think we get into a very high risk sector just with the hope that it might outperform.
Yeah, no.
Usually outperform.
I mean, there are enough stocks usually in a market that outperform. Of course, I mean, I heard what you said at the tail end that the in the index, the things look much better than they do in individual portfolios. So this has been an unusually narrow market. It has broadened a bit since August. August was, I think, one of up to August was like the up move was one of the narrowest I've seen, where only about 10-15% of the stocks outperformed. Probably even, I think at one point it was even less than 10%. Whereas, I mean, just to give you a norm, I mean, the norm is about 40% outperforming. Even when it is 25% outperforming, we think, this is the market is narrow. And this time it's been very narrow. And even now, there are a whole, I haven't seen the last numbers, but if you look at stocks down 20% plus or 25% plus, that is still a very large percentage of the stocks.
Devina, hi, morning. Good to have you with us. So you're someone who's always been a strong advocate for diversification and global diversification as well. So just wondering, Amin, if there is any change in thought in terms of the global part of your portfolio, looking at everything that's happening in the US. I mean, it was almost US equities were unrivaled, unchallenged, but now there's this whole AI debate going on, bubble, not so much a bubble, etc. So have you made any changes there with respect to your US allocations?
Yeah, so as I always say that US is not the world. So this is what other thing which I keep telling people, that don't think you have globally diversified just because you have bought an NASDAQ or S&P. And of course, there the market has been extremely narrow. I mean, it has been just the tech. In fact, global equities also, if you see the entire move this year, something like 75% has been tech. In US, it has been just that one handful of stocks, the Magnificent Seven. But besides that, also, I was looking at the categories of stocks that have done the best in NASDAQ, and the companies with no revenues and profits have done the best. So, so either with no revenues or no profits, both those filters, those stocks have done extremely well. So, but that's a sign of danger. And even before this, if you'd asked me last year also, I would have said that the US has outperformed for well over a decade. And at some point, that outperformance has to end. And I think President Trump, all the things that he did also is kind of hastening the end of that US supremacy in many areas. And also, you talked about the AI bubble. Yes, I mean, to me, it is always, I talk about this, that when a new technology comes in, which particular thing will succeed, how long will it take to succeed, which company will succeed, and even if the company succeed, will you make return on capital? That is the real question in all this spending on AI. I mean, just to remain in the race, you have to keep spending. You have to keep spending on, of course, the data centers, which is real estate, fast depreciating assets, and also a lot of power. But even to get people, I mean, I've heard of 100 million salaries and 500 million salaries. So you have to run just to keep in place. And you will, I'm not sure you will get anything like the return on capital. People might use it, but when schools and colleges were shut, many of these AI models, their usage dropped by 60-70%. So it's been used by students for assignments, whether they go to pay. And still, I mean, you are a long way from the enterprise segment trusting the AI systems, because there is so much of hallucination, and that famous Deloitte thing in Australia, when so much of the report generated by AI they found it was made up, right from court judgments. It had made up a whole lot of things. So there are many, many question marks, and basically it ultimately, if you look at in financial terms, whether the return on capital will come on all the money that's going in. So there's definitely, something which doesn't make financial sense. And eventually, if something doesn't make financial sense, the market wake up to it. Then there's also a lot of debt being raised by AI companies, which is like, again, one other red flag.
All right. Hi, Devina. Good morning. Good to hear your thoughts as always. Let's talk about what you said you recently added. Oil and energy sector, right? Could we drill down a little bit into this? What have you added out there?
Basically, oil marketing companies. So that's mainly where it is, because, I mean, the crude oil
prices are not that high that you would go to that side, the other side.
All right. So you like the valuations. Your crude oil prices remain suppressed, and I think refiners are they have a smaller portion of that in their mix.
Yeah,
But
this was a sector where we practically had no weight. So I mean, it's not that we have gone hugely overweight or anything, but that's where we have added.
You know, there was this, I keep, by the way, another way to measure, but Devina is talking about all marketing companies here, it just struck me. This one stat about, and Hormuz did that link, if you remember last week, how big is NVIDIA? NVIDIA is larger than the entire US energy sector combined.
Wow.
Right? So that's the other one. And to Devina's point, and Devina, looks like it's Sanjeev Prasad of Kotak put out that note, and I thought that note really, the title of that note really, you don't need to read the note. I mean, the title said it all. It said low ceiling, high floor. That's his description for the market here in India. Low ceiling, high floor. So you're basically stuck, very, very narrow. And I think what you're saying somewhat echoes that broadly.
No, I mean, I see, I mean, the markets will always frustrate you. They will never do what you want it to do and when you want it to do. But always remember that sentiment is a contraindicator. When there's excess buoyancy, as there was for the first 3 quarters of 2024, when everybody thought like 30% compounding was there for the taking, is when you should be cautious, because studies around the world show that when there's that buoyancy, the next period returns are below normal, as what happened in the last whole summer. And when you are questioning yourself, what's the point of being invested in India? And, should I stop my SIPs? That's when the next period returns are above normal. I mean, that's the data around the world, from Brazil, Portugal, India, US, wherever, whichever market you track it is the same. So that is the whole point, that you're keeping control of your emotions and remaining invested when those questions come is really the superpower.
Okay, all right. Devina, we'll leave it there. Thank you very much for joining us. Good speaking with you here on CNBC-TV18. Appreciate it very much, as always. I think 45 points on the Nifty, 26,100 is where we are at. We're absolutely flat right now. So neither here nor there as things stand. Okay, I think UBS is initiated on Shelly Engineering.
Yeah, that's
and we should have someone sort of come up and talk about this initiation as well. So maybe 2 initiations, right? I think both from UBS. There's Sham Metallic and the other one is Shelly. And we'll try and have this coming up in just a bit from now. The number one volume-led gainer is Infosys with a 2.5% gain. So that's the other initiation. Not initiation, but upgrade. Moti says that no, not Moti. I get...
it is, yeah.
It is.
Motilal has upgraded the entire sector. That's what Rima was explaining. Again, their deeper thought process or rationale is very similar to CLSA.
Yeah.
Exactly what Vikas Jain told us, that as AI moves from the build-out stage to more the application stage, that is when Indian service providers, which know how to use all these new technologies very, very well, that's where they'll start showing up their edge. And that's also the thought process that Moti shares, which is why they've upgraded the sector. So it's not just a tactical upgrade from a cash balance perspective or the fact that the sector is underperformed this year, but it's also sort of thematic in that sense, that eventually these companies will prevail.
And the point they make on weightage, right? The weightage of tech stocks in the Nifty has fallen from 19% in December 2021 to around 10%. But the profit contribution is constant at around 15%. So that's the other point they're making in that note as well. Okay, all right. I think for today, there's going to be an MSCI rejig that's going to be taking place. So we'll watch out for those flows, because I think roughly it could be around $200 million. Is looking at a Nuvama note. Vivek joins us to help us out with a quick refresh on that. It's scheduled to take place today. Vivek, go ahead.
Well, that's right. Especially in the last hour of the session, all the names that we mentioned will see heightened volume activity. Important to note that these names have been flagged off earlier as well. There has been quite a lot of price move going into this particular rejig as well. Now, remember, given the fact that India has underperformed most of the emerging market indices, India, which started off the year with a roughly 20% weightage in the MSCI EM, is now just around 15.6 to 16% weightage. So there has been a significant underperformance, leading to a drop as far as the weightage of India in the MSCI EM is concerned. Now, in terms of the individual stocks to keep an eye out for, 4 additions. Fortis Healthcare, Paytm or 197, GE Vernova TND, and Siemens Energy are the stocks that will enter the index today. Fortis expects to see inflows of close to $450 million, Paytm too in the same range. On the other hand, two stocks get deleted from the index, Container Corporation of India as well as Tata Elxsi. Both of them will see outflows in excess of $170 million. In addition to this, the MSCI India Small Cap Index will see close to 30 deletions as well as 6 additions. So because of the underperformance, you're actually seeing a significant amount of deletions as far as the small cap index is concerned.
Okay, all right. So we're going to watch out for some of these index changes. Vivek, thanks for putting that on our radar. For the time being, we are turning the spotlight on KEI Industries. We have Mr. Anil Gupta, CMD of the company, joining in. Mr. Gupta, thanks for being with us. So, we really want to understand what the second half of the year is looking like for your sector and, of course, for KEI in particular, because up until now, it's been fairly steady demand for wires and cables. So, you tell us, what do you see ahead and how do you expect the second half to shape up?
Yeah, good morning. Thanks for inviting me. Second half of this year, this financial year is going as projected. And we expect a overall growth of around 18 to 19% in the full year period. And I think the demand is pretty strong, and I see no challenge in achieving the growth trajectory in the second half as well.
All right. All right. Hi, Mr. Gupta. Good morning and good to see you, Ben. You're confident on growth. I believe at a recent conference, you said that, in fact, demand is very, very strong and getting to these numbers will be no problem. I think the following year, you're guiding for close to 20% growth as well, if I remember correctly.
From in the beginning of the year, I mentioned a growth of 17 to 18%. And I think we have delivered more than that, much more than that in H1. Okay. And actually, I'm always conservative in my projections. So I don't want to over-project. We should be able to achieve whatever I have said.
Okay, all right. Give us a sense in terms of exports. On a low base, did see a good uptake. So if you could tell us how are things looking out there? And I believe the exports to the United States has been weak, obviously because of tariffs. But in Europe, you're seeing some kind of traction out there. So fill us in on that front. And also, if you could help us out with the margin difference between domestic and exports.
The export remains pretty strong in all our export markets, Europe and Middle East, as well as Australia. So far as US is concerned, yes, our projection was pretty strong this year, but it has stopped because of the tariffs. But we are able to make up the shortfall from other markets. And regarding margins, I think there is a margin difference of 1 to 1.5% in export markets, better than domestic market. And as we are building up capacities, we will be able to grow our export as well as margins with the economies of scale.
All right. And I think you're guiding that exports will be in the high teens, right? As a percentage of the mix, 18 to 19% of the total mix is what you're looking at. And yes, on a year-to-year basis, you're expecting margins to improve as well for the company on the whole by around 75 to around 100 basis points, for the coming year, FY27 as well, in comparison to 26?
Yes.
Okay,
definitely. Yeah.
Mr. Gupta, just one quick, so I want to just take away, continue on that margin point. You don't think, and we've discussed this in the past as well, right? And I think you were the one who told us once, when copper prices go up and there's an unprecedented runaway move, if there is an unprecedented runaway move, what it does is, I mean, it's of course passed through and there's hedging, etc. But it kind of impacts volume of work, etc. I mean, and I think we had KEC recently who kind of sort of alluded to that as well. Anything you can tell us on this, sir?
See, the pause comes only for a short period, because the contractors who might have taken contracts on firm prices, they think that prices will go down and they try to wait for placement of new orders. But eventually, they can't wait for more than a month or two. So eventually the demand comes back. So, so far as margins in rising market is concerned, I my observation is in several years that it may impact 0.5% plus or minus depending on the market situations or market sentiments.
Okay. So this guidance which you've given out, which is for improvement, that takes into account all of this?
Yes.
The copper price rally, etc.
Yes, we always take into account, and we have delivered even a revenue, volume growth also of 15% in the first half. So it is not just the turnover by way of prices, but it is, we always, observe the volumes, not just the value.
Mr. Gupta, since we're talking margins, one obviously added component of that conversation has to be what the competition is doing. And the earlier part of this year was spent really discussing that. The deep-pocketed, large business conglomerates that are getting into your space. Now, I don't know where things stand. I'm not quite sure if that product has already hit the market, the Adanis, the Birlas, and if it has started showing up in any way. Can you just update us what's happening with respect to competition from these other large players?
Yeah, so far, no one has entered the market, neither Ultratech or Adani. And I had said in my earlier interviews also that even if they enter, I'm sure that our growth will not be impacted. We are working our growth based on larger territories and geographies and larger markets and segments and the product lines, instead of just focusing on traditional product lines of the construction and building industry.
No, absolutely. What I was just asking, you have your ear to the ground, so what are your channel checks indicating? By when do we, I think they announced their plans in March of 25, now we're at the end of 25. So what are the channels saying? By when will they be a presence? And then of course we'll see how competition plays up. And you all have been, old-time players, old-time hands. So what timelines are we looking at when this competition actually becomes real in the market?
In my opinion, it takes minimum 2 years to build up a plant and launch the product. So that much of time anyone is going to take. That is for wires. And for cables, if it is medium voltage or high voltage cables, it is more. So I think next year also, we don't see much impact due to them.
Oh, okay. On a side note, just a different tangent, I'm just asking this. The fact that there is a huge data center build-out that started in India, and we know that power is a huge part of it, and a lot of the power equipment suppliers, transmission companies, they're seen as a bit of a play on this data center build-out. Can you tell us if this has any direct implications for you?
Of course, every demand coming from any sector has a cascading effect on the demand. And data centers, they require a power source or energy source from 3 different sides. So the incoming power demand increases, incoming demand for cable increases because to bring the incoming energy. And also within the data centers, there is a substantial requirement of wires and cables to interconnect their panels or systems. So definitely it is seeing in the demand, but this is just one of the sector which we cater.
All right. Mr. Gupta, I don't know whether you have a number offhand, but I believe one of your competitors, that is Polycab, they said for 1 megawatt of to set up of data center capacity, the total cables and wires demand will be around 3.5 crore approximately. Do you have any rough numbers in terms of a matrix out there? And that's why they believe that this data center push with the 6 gigawatt of data center addition, it will be a big tailwind for the industry. Do you have a rough matrix out there?
I agree with it, but I don't have the actual numbers that how much wires and cables will be consumed with 1 megawatt.
Got it.
But I agree with these numbers.
And how much do data centers right now contribute to your revenue? I'm just trying to get a sense, your exposure to data centers and how you see that growing.
Actually, we have not quantified the numbers.
Okay.
Which are going to data centers.
All right. Final question, sir, before we let you go then. Tell us about this GST cuts that we have seen, it was supposed to propel some kind of a demand for housing wires. Have you seen signs on ground out there? If you could help us out with that. What would the ideal mix for you be between cables as well as wires? If you could tell us there. And expansion is on stream, right? Sanand, it was supposed to be in September, November. I believe next week you're going to cut the ribbon out there. Is that correct?
Yes, we are going to commence the production in next week, first week of December. And so far as this wire segment due to GST is concerned, actually, I don't think that we are able to quantify it so far, because October month was the festival month and November is just going on. So we will definitely quantify. I will let you know in the next conversation that what is the impact of GST cut on the wire sale.
But demand is strong enough. That's all you'll have to say with regard to cables as well as wires.
Demand is strong enough, and demand is basically related to the construction activities. I mean, I don't think that just because of some GST cut, somebody is going to buy the wires for just keeping it.
Yeah, but it gets cheaper, then you get more adventurous, right? We got that point with regard to demand being strong. And you want to give us the rough breakup about how will you see the wires and cables, mix progressing from here on?
Our cables mix will remain 75% and wires and flexible will be around 25%. Yes.
Always a pleasure talking to you, Mr. Gupta. Thanks a lot for joining in. 18% to 20% growth on the top line. Margins will continue to improve. Strong traction both on ground as well as in the export market. And Sanand facility set to cut the ribbon in the coming week itself. Well, time to slip into a short break. On the other side, we'll have the management of Chola Finance who will be joining to discuss the impact of the renewable certificate rate revision and also their business outlook. Stay with us.
Welcome back. Well, we have the management of Chola Finance now with us as promised. Remember, rates for certifying, vehicles, both personal vehicles and commercial vehicles, but of course, the impact is much more for commercial vehicles. The rate for certifying these vehicles are fit for use and can remain on road has gone up dramatically, especially for commercial vehicles older than 20 years. So let's try and understand what the implications for the vehicle finance business is from the CFO of Cholamandalam Investment Finance, Arun Selvan. Mr. Selvan, good morning. Great to have you with us here. Thank you very much for joining us.
Good morning. Yeah.
These are pretty dramatic increases, sir, on the CV side. Can you run us through what kind of what can we see? What's the right way to think about it before you try and quantify the impact?
See, this is like an essential part of what we need to do when a new used vehicle needs to be sold to a new buyer. So they will incur this cost. To some extent, this will have to be funded by them, and partly it can be funded by us. So we need to understand how this funding impact will happen. But it is not a large sum when you compare the total vehicle cost that needs to be funded out. So I think this is part of the cost that needs to be borne, and it will be borne, and it will move on. On a cycle of 3 years, this number is, even if it is funded, it gets amortized or it gets split into EMIs. So it will not be a large differentiator in my view.
Yeah. So you think, at the margin incrementally, do you have any numbers, sir? What are the number of vehicles impacted because of this? Your team would have those numbers, right? And
it all depends on the age of the vehicle also. So that would also mean for us, as you know, we more handle vehicles which are the first time resold. We don't do more than 10 years or 7 years. So around maturity it is 10 years. So the cost on that is comparatively still lesser. So accordingly, our customer profile may not be that much impacted, while it could be slightly higher on further or more older vehicles. So.
You think at the margin, Mr. Selvan, this kind of pushes, sort of raises demand for loans, as you began by saying, possible? And also, if some vehicles are at the margin, and cost goes up, it's basically a decision between whether to continue, pay this, or but you said the cost of the new vehicle is much higher. So is it really a trade-off in that sense? Maybe for a few.
If you look at it, what is happening is when the BS4 to BS6 happened, there was a large push into used vehicles because the cost difference between a BS4 and BS6 was wide, and people who would normally even go for a new vehicle opted for a first time changeover of a BS4 vehicle. That is, the second buyer. But this progressively is now reduced because the quantum of BS4 vehicles, which are up to 7 years old, has come down drastically over the years as this BS4 has been completely stopped now. Add to that, the cost of the BS6 vehicles have also come down because of the GST change. Both put together, I think there will be a shift back to people buying new vehicles who used to buy new vehicles earlier and then shifted to used vehicles when the price differential between the BS4 and BS6 become wider. Now this difference is changing, and now what will progressively happen is only BS6 vehicles will come into the used market, at least for the first changeover, and that way the differential is narrowed and people would more opt for a newer vehicle. We have to experience this. This is my assumption or my hypothesis about how the market will pan out. We need to see how this pans out as we move into the
So Mr. Selvan, morning, sir. So if you put everything together, in the second quarter, your vehicle finance book grew almost 15-16%. Disbursements in vehicle finance were also healthy at around 10%. So all things put together, including what you just described, in terms of the emission norms having changed, the GST cuts having set in, second half, what is the kind of growth you're seeing in your vehicle financing book, and which part, what will drive it? Is it going to be light commercial vehicles? I mean, what part of the book looks most robust right now from a demand perspective?
In Q2, the large push happened primarily because of two-wheelers and then the passenger car, which where people wanted to take advantage of the reduction in GSTs, and then also the festival season started. You will see this continuing into the Q3, and you will also see on the commercial vehicle, progressively heavy commercial vehicle coming into play. The other factor, especially with regard to Chola, is during periods when cost of funds goes up, we slow down on the heavy commercial vehicle because the yields are low in this particular segment, and we can't really have adequate margins when the cost of fund is high. But now the trend is cost of funds being low. We will now slowly move back into the heavy commercial vehicle segment also. So we see H2 having a reasonably good growth on vehicle finance, and they should end the year with a decent growth around the 18 to 20% AUM.
All right. Hi, sir. Good morning. Good to see you. When I recall, you had cut down on the growth guidance from, I think, closer to the mid-20s to 20 to 22%. Is that gettable, or are you scaling down a little bit? Because some on the street believe actually it will be in high teens. So if you could help us out with clarity on the growth number for this year itself, which was already scaled back a little bit.
We still hold the 20 to 22% growth levels. We should be there by the end of the year for the full year, year on year.
Okay, wanted clarity on that front. Let's focus on the other two aspects then. Credit cost, if you could give us the comfortable level that you're looking at on that front. And also NIMs, you were guiding that things start improving from here on, as the yields improve, as, cost of borrowing as well comes down. Stick to that 10 to 15 basis point improvement. What would be the rough range? Credit cost and NIMs. Please go ahead, sir.
Credit cost will come down a bit in Q3, Q4. This is always the trend in any year if you look at it pre-COVID, and we will experience this. We'll see this coming down. Our guess is at a company level, we will close the year with around 1.5 to 1.6% on the credit cost. This is also primarily the impact on account of the step back from the fintech business, where the credit cost will see some larger proportions as we move into the final legs of running down that AUM of that book, which will mostly run down by end of Q4. So we should close the year by around 1.5, 1.6 at a company level on the credit cost. Well, the NIMs will improve. NIMs are improved in Q2. You'll see similar levels with further, 5 to 10 basis points improvements in the Q3, Q4 numbers. So overall, you'll see around 20 to 25% movement in the NIMs as compared to last year.
Okay, all right. Let's focus on the other parts of the business, the housing finance as well as LAP traction. How has that been? If you could give us some color there, sir.
Both LAP had been growing at a decent pace, around 30% plus on the AUM, and it will see the similar growth. It is not impacted either positively or negatively by the cost of funds because it's a floating rate book, so it will continue to deliver the ROAs it has been giving. So that's a good business. We have sort of stabilized it, and it is running at a good, decent pace and adding to the bottom line in a decent way. On the home loans, there has been a little bit of a slowdown on the disbursements, primarily because of a certain SRO-related, issues with regard to Qatar and etc. in certain pockets of certain states. But this is getting addressed, and I think progressively you'll see in the second half disbursement also growing. While disbursement slowdown, AUM was growing still at around 20% plus, and you'll see that the full year we will still close the home loan book at about 20% mark.
Okay, what about the competitive intensity? PSUs, they are being a little aggressive in the home loan space. Have you seen that?
We have never been in the same market as PSUs. PSUs more focus on salary. We are in the self-employed non-professionals. Our competition is more with other NBFCs and housing finance companies so we don't see being our competition there.
Good to get clarity, sir, on that front. And finally, ROAs should be closer to around 2.4% odd. I think it was around 2.2% the last number that I have recorded.
Yeah, I would keep it between 2.2 to 2.4. Let's keep it conservatively because you always take my higher side number. So
No, sir. I take what you say. I'm happy to ask you the questions. What you take, I hold you to that number. So you're saying 2.2 to 2.4. You want to keep it in that range.
Yes.
Pleasure talking to you, sir. Thanks a lot for joining in. Wishing you all the best. And, we catch up either later this year or early 2026. Thanks for joining in. Well, that said, let's get a technical check on the markets. The markets, dipped into the red, and now we have moved back into the green, up close on 20 points. The Nifty Bank is doing some of the heavy lifting today. It's up 0.2%. But yet again, the breadth of the market is in favor of the number of stocks declining. So you have only 1,000 stocks advancing, 1,500 stocks declining. Siddharth Rai joins us on the show. Hi, Sid. Morning. Good to see you, Ben. What's the call today? Buy the Nifty, or would you stay, at the sidelines and then look to buy at lower levels? So call on the Nifty first, and then fill us in with your individual trading calls.
Hi, Nigel. Good morning, and thank you for having me on the show, first of all. See, Nigel, if we talk about Nifty, the undertone in the index still looks bullish, first of all. But having said that, Nigel, I do think that there was a change in the Nifty structure after the second half on Friday. Now, 26,200 is a strong resistance for the index. And also, when I look at the other spaces other than IT, Nigel, I don't think there's any signal of a good momentum from any other major space. So we have to wait for a while. It is a good idea to wait for a while right now. And only once Nifty manages to go back above 26,200, then only we should be taking fresh positions in Nifty, because only then we'll be seeing a fresh momentum move towards the all-time highs and probably even beyond them towards 26,350 and 26,400 levels. But for now, it is much better to wait and just, like you said, to sit on the sidelines in the index.
Okay, and Siddharth, morning. What about your stocks? What are you working with today?
Yeah, sure. So we see two stocks. Both of these we have to buy. The first one is definitely from the IT space itself. The name of stock is Tech Mahindra. See, it is one of the leading IT counters right now if you look at momentums. So a lot of up move has already come, but there is still a big room for an up move towards 1560, 1570, those levels. So Tech Mahindra can be bought right now. The spot is trading around 1510-ish. Our stop loss will be at 1495. And the targets being, just like I said, 1560 and the second target 1575. The second stock is Tata Technologies. See, this stock has a base around 660, 665, these levels, and it's a very strong support for this counter. Just around those levels, we have seen an open low being made today. The stock opened around the levels from where it started running. So the structure looks very good for now. Tata Technologies can also be bought. Right now, the spot is trading around 678, 679. We can keep the stop loss at 669, and the targets being the first target 699 and the second target 710.
Got that. Thanks very much for that, Siddharth. Appreciate it. We'll take a quick commercial break here. We'll come back in just a bit from now. It's a quiet kind of day so far. 25 odd points. And let's see if things pick up, right? Otherwise, market breadth, 1,800 stocks are lower and about 1,000, 1,050 stocks are higher. So that's not just the Nifty, but a look at the broader sort of picture in terms of mid caps, small caps, everything. Manisha is with us on the other side. Commodities in focus.
Welcome back. 26,100. That's the story on the equity market side. Let's figure out what's happening in the commodity market space. Manisha is here with the latest. Manisha, what's the big headline or the big commodity you're tracking?
Well, there is profit taking across sectors, and zinc is no different, and that's what I'm focusing on right now. But we did see 11-month highs in the beginning of November itself, when the zinc prices went all the way to $3,100 a ton. It's holding around that 3,000 level at this point in time. But the overall pullback that you have seen in regional equities and various other base metals as well seems to be weighing onto the zinc prices also. And then there are concerns of that exaggerated AI investment pledges that seems to be bothering many of these green metals there. It also has to do with the higher delivery commitments that are coming in from China. That seems to be weighing onto base metal prices right now, including zinc as well. Take a look at what zinc really has done in 2025 till time. So the high that we've seen in this year has been $3,150 a ton, and the low has been to the tune of $2,550. We seem to be holding at around 3,000 levels at this point in time. So on the higher side of the range is where zinc prices seem to be trading at this point in time. So that range really is $2,550 to $3,150. As I said, this is the range that we've seen. A $500 of a range is what zinc has done in the year 2025. Now let's take a look at the LME zinc stocks, and there has been a very strong decline onto that one. The year started with 230,000 tons. We're standing at 34,000 tons right now. This is 1 day of global consumption where we are. But the reason the zinc prices are not running up is because while the LME inventories are trading at a 2-year lows, but when you look at the Chinese stocks, well, we have seen an increase coming in for that. In the month of January, the China stocks were at 100,000. They stand at 162,000. So when you look at China and ex-China, these are two different worlds when it comes to zinc, and is the reason you're looking at a disparity and the reason that the zinc prices have not run up really. There also is a report from SMM which says that the refined zinc is at a surplus in China to the tune of 290,000 tons. But when you look at ex-China, there's a 90,000 tons of a deficit there. So it clearly is two worlds that we're talking about. Interesting data also coming in from the Singapore Customs, which says that a lot of zinc has been exported into Asia. A lot of countries like Indonesia, India, Vietnam, Malaysia, Middle East have bought in a lot of zinc. These are the countries which also are looking at infrastructure. Galvanized demand is quite higher here. And there is also a re-export happening from these countries. So there's a lot of zinc coming in for these countries. Interestingly, when you look at the Indian zinc demand, well, we are looking at 1.1 million tons of per annum demand in 2024, with an expectation that this could easily double up to 2 million tons by 2030. Also interestingly, while India's per capita consumption of zinc is 0.5 kgs, global average stands at 4 to 5 kgs, and developed countries consume anywhere between 6 to 7 kgs. So expectation being that Asia could be a big demand driver when it comes to zinc, especially coming in from India.
All right. Well, Manisha, thank you very much for that. Well, I think we've got the new Chief Justice of India taking oath. The visuals are coming in of the swearing-in ceremony. Mr. Suryakant, Justice Suryakant, who's taking oath as, at the Rashtrapati Bhavan as the Chief Justice of India, the next Chief Justice of India. And this is, of course, after B.R. Gavai. Justice B.R. Gavai is retired. So that is what's happening. You can see the Prime Minister, Mr. Modi, some other cabinet ministers. I think there's a fair bit of family of Justice Suryakant also present at the swearing-in ceremony. So visuals coming in from the Rashtrapati Bhavan. Okay, well, let's come back to the stocks, right, and address two names, HG Infra and Kalpataru projects, and shine the spotlight on these once again. Vivek, take it away.
Well, that's right. HG Infra doing quite well in the session on the back of being declared as the lowest bidder in this particular project. Remember, this particular project is for Maharashtra Metro project. It's for the Thane Integral Metro Rail project. Now, HG Infra has a 40% share in this particular JV, and Kalpataru project has close to 60% JV. It's an EPC project. The total bid or the lowest bid has come in at 1,415 crore rupees. Time period of execution is close to 3 years. Now, what is it that both of these companies will be doing? Design and construction of the elevated metro diaduct. And when you're talking about HG Infra, the order book was in excess almost 14,000 crore rupees, and Kalpataru projects, the order book was in excess of 64,000 crore. A more meaningful order as far as HG Infra is concerned, which is why you're seeing the pop-up as far as the stock price is concerned.
Okay, all right. Got that, Vivek. Thank you very much. Both of those stocks in focus. But they have cooled off significantly, obviously, from the highs of the morning. We'll take a break on that note. On the other side, our special segment, it's the economy. Lata today discusses loan growth, margins and stress in the NBFC sector with Krishnan Sitaraman of CRISIL and Jairam Sridharan of Piramal Finance. Welcome to It's the Economy. NBFC stocks like Shriram Finance, Bajaj Finance, Chola have all been the best performing stocks, rising 40 to 46% this year, while the newly restructured Piramal Finance has jumped over 20% in just this month of November after the relisting. Rating agency CRISIL has just published its NBFC outlook for the next 2 years, and it states that it sees the sector's loan growth at a decent 18 to 19% for the current year and the next year. To get a firmer understanding of this very buzzing sector, I'm joined by two experts, Krishnan Sitaraman, the Chief Ratings Officer of CRISIL and I think the author of the report, and Jairam Sridharan, Managing Director and CEO of Piramal Finance. Gentlemen, good morning and thank you very much for joining us. Krishnan, since it's your report, I'm starting with you. Tell us exactly the growth trajectory. I read the headline saying 18 to 19% growth, but what was it last year? Should we be very thrilled with this 18-19?
Hey, good morning, Lata. Thank you very much for having me on the show. Good morning, Jairam, and good morning to your viewers. In fact, this article report that we have put out, we're talking about an 18 to 19% AUM growth for the NBFC sector. And that is across this fiscal and next fiscal. What we need to keep in mind is that decadal growth for the NBFC AUMs have been around 14%. And if I look at the last fiscal, it was, that is FY25, it was 18%. However, the first fiscal had first half of this fiscal had seen some slowdown in the growth as bank lending became a little more cautious. However, the policy measures that the government has announced, the GST rationalization, the lower interest rate regime, benign inflation, and the income tax cuts, which we saw at the beginning of the year, and also the healthy monsoons, has revised our estimates on the growth slightly upwards. We believe all these factors would drive consumption demand, and that would help retail credit growth. And that would help the overall second half growth be better than the first half growth for NBFCs, resulting in a roughly 18 to 19% AUM growth. Okay. And that would be led largely by the segments like loan against property, gold loans, and the secured asset classes. Unsecured and the MFI may see a subdued.
Okay, got that. That's by way of initial comments. Good morning, Jairam. You all did far better than that 18% that Krishnan is talking about. 25%, right? Total AUM growth for the second quarter itself. What's your sense? This is still September. You know, we haven't seen the festival season into those numbers. Your growth forecast for the next, say, 18 months.
Yeah, thanks, Lata, for having me. The growth has been very strong in the first half. The festive season, it has been the biggest festive season I remember in a very, very long time. It has been really, really strong. A lot of us have shown our festive season numbers at Piramal. We said that the festive period, which is the 30 days surrounding Diwali and Dussehra, that period, our disbursement growth was 45% over last year, which is far and away the largest festive season I remember seeing, actually, in many years. So festive has been super strong. Having said that, the post-festive season has come off a little bit. It is not nearly as strong. So in our case, for example, the post-festive season, the 1 month after that, is looking more like 24%. Still very strong in absolute terms, mid-20s. So quite strong indeed. However, not as strong as what the festive season would have led you to believe. So it has been a very good start to Q3 for the NBFC sector overall. As Krishnan pointed out, it's led by the secured segments. LAP is doing extraordinarily well. It continues to really rock on growth. I'm sure we'll talk about asset quality in a few moments. Yes. It's doing very well. Yields and margins are also holding up. So it's been a really strong H1 for the sector as a whole, and followed by a good solid kind of month and a half. And as NBFCs grow and PSUs grow, there's been a little bit of shift away from private banks in these last year and a half. So that's been kind of the trend in the market so far.
Okay, as you said, asset quality. Krishnan, any worries at all in any sector?
Yeah, so I think what we need to keep in mind is NBFC is an agglomeration of different kinds of segments and sectors. So one view may not be applicable for all these segments. So on the whole, I would say that while we are expecting some uptick in delinquencies, it is not a major cause for concern.
In which sector are you all expecting?
Yes. See, I would say that across the board, there would be some marginal inch up in delinquencies. That said, we are seeing the unsecured segment showing a higher increase in delinquency. Segments like microfinance, unsecured personal loans. Over the last 1 year, we have seen issues, headwinds facing these sectors, and we have seen the delinquencies go up. And one of the key reasons that we have identified is customer over-leveraging. And that has caused problems in the repayment ability of these customers, and that has resulted in delinquencies going up. Those sectors are still under watch. Additionally, in the small ticket business loans, that is another segment that we have seen in the recent quarters, some uptick in delinquency. So we are keeping a watch on it. These sectors have overlapped with the small ticket, the microfinance segment. So the issues that will affect those sectors may be somewhat similar. So these are some of the sectors, but they don't contribute a significant chunk to the overall NBFC.
Got that. Let me get Jairam on this. Jairam, you have the distinction of pointing out to the unsecured loan problem, I think even ahead of the regulator in one of those CNBC events, remember. Now, what Krishnan is pointing out to is something we saw even, see, Bajaj Finance showed MSME loans as a problem. There were a couple of others, if I remember right. Would you say that there is any developing pocket of worry?
Yes. I think the unsecured lending story has largely played out. I think it is, and you can see it in the delinquency numbers, which have been very not come down, but they have not moved up in the last 9 months. They have been pretty much at the same level. So that's holding up okay. My emerging pocket of concern, Lata, is the one segment which is also, as we discussed in the previous section, the fastest growing, which is LAP. It's an area I want to kind of take a lot more of a close look at. I think the problems have a risk of spilling over into the LAP segment, particularly the smaller LAP segment, which already seems slightly impacted. And the problems might move up the ticket size curve. As you know, in this entire cycle, the smallest tickets are the ones that have been badly affected, but the larger tickets have been mostly unscathed. My anxiety building up right now is just to make sure that the lab business, which looks so great right now, fantastic growth, great margins, superb risk, everything looks good about that segment. I wonder whether it is too good to be true and whether something is going to give there.
Fair point. Spoken like a true banker. Just one number, which you probably said and I didn't note. You said that post festive season, it is about 24%, which you described as moderate by your standards. What was the festive season growth?
Ours was 45%.
Ooh, okay, okay. And what would your annual average be, say, for the next 12 months or so?
I would say right now it's looking like 26-ish% for us. We've not guided specifically for the next year, but looking at what I'm seeing right now, I would say about 26 seems doable. I'm encouraged by what Krishnan is saying. If he thinks the industry is going to grow at 19, I better grow at 26.
Okay. No, I'll tell you why I was a little skeptical and I asked you this number, because both Chola and Bajaj Finance brought down their AUM growth forecast by about 1 percentage point. It was a range. So it's good to hear that if that is not the industry-wide experience. But this again was before festive season, so we can wait and see. Krishnan, running out of time, you want to add anything on LAP quickly? And do you think that NBFCs are struggling to get money from banks? That's what your note indicated.
So just coming back, in my earlier part, I still did indicate small ticket business loans. That is largely LAP. So as Jairam was pointing out, unsecured was always a watch point. But what is emerging is a small ticket business loan, which is largely LAP. And there we need to watch out for some uptick in delinquencies. So that's something which we need to look at. Another thing I wanted to add was in terms of this growth. We are seeing also a differentiation between the larger and the better rated NBFCs and the smaller and the more moderately rated NBFCs. So we are seeing the AAA and the AA rated NBFCs grow faster than the BBB and the single A rated NBFCs. Okay. And that one of the reasons there is the access to bank funding. Okay. So bank funding, if you would recall, a couple of years back was growing at 25% to the NBFC sector. That has considerably come down. And despite the risk weight reduction from April this year, we are just seeing only a marginal uptick in the bank exposure to the NBFC sector as of September, vis-a-vis last September. So that needs to pick up for the mid-size and smaller NBFCs to grow. The larger NBFCs have access to other sources of borrowings, like the debt capital markets, external commercial borrowings, and so on. So they would be able to source the funding and grow, even if the bank funding is not keeping pace.
Got it. I would assume Piramal would fall in the category of the, the better off NBFCs. Jairam, your word on cost of funds. Are banks still being stingy? And more importantly, the RBI has opened out some doors. They're only draft rules, but easier ECB funding is on the way. On the other hand, the debt market has stopped reflecting what the Reserve Bank is doing by way of cutting rates. We have, if anything, seen a slight rise in yields and spreads. Cost of funds for the next 12 months and therefore margins.
I think cost of funds are headed down, and you will see it continue to head down over the next full year for NBFCs. The trend for NBFCs might be different. Will be different than the trend for banks. Banks will probably see margin compression. NBFCs will probably see margin expansion in this period. We saw it the last cycle as well when RBI was increasing rates. If you look at NBFC data and you look at when cost of funds for NBFCs actually increased, you will see that there was a 1-year lag between when RBI was increasing and when it was reflecting in NBFC P&Ls. The same will happen on the way down. There is about a 1-year lag. RBI started in February, March last year or this year. So I expect starting Q4 more to be visible on NBFC balance sheets, but you should expect to see it. Yes, banks cutting MCLRs has not happened very much, particularly in PSU banks. Private sector banks have still cut a little bit. PSU banks have not cut MCLR at all. And since they are pretty substantial parts of the market, you're not actually seeing that impact come through. The bond markets, the low end obviously has reacted really well, and you've seen the rates, and they're baked in all the cuts that have happened. The high end remains, the long end remains stubbornly high, and it is not moving, and that does make for an area of anxiety. It does show a little bit of a lack of confidence of the market in what's going to happen in the long run, and whether RBI is going to be able to solve the longer term kind of liquidity issues. In the short term, though, liquidity is ample, and costs are benign and on the way down.
And so your margins will be? Any guidance?
So I would say that last quarter you saw our cost of funds come down by about 20 odd basis points, cost of borrowing. I expect another 25 odd basis points reduction in cost of borrowing by the end of this fiscal year, and another kind of 30 odd basis points in the coming.
Okay. Oh, that brings you to double digits in NIMs actually. Even the last one you reported 9.55. So that's very good going if it is 26% loan growth and over 10% margins for at least the top-notch NBFCs. Krishnan and Jairam, according to me, are the more cautious people in this space. And if they are telling you that things are looking reasonably good, and in fact, Jairam is saying it's looking very, very good, then perhaps the rally we saw in NBFC stocks this year may not be the best of the rally. Maybe more to come. Thank you very much, Krishnan and Jairam, for joining us with a comprehensive understanding of the NBFC space. Wrap up on Bazaar. Chartbusters coming up.
The rally in IT stocks continues as Motilal Oswal upgrades the sector to an overweight rating, expecting stocks to benefit from the following: sustained underperformance and a shift from AI infra to application and service layers.
Food delivery companies Swiggy and Zomato open weak but recover after the new labour laws include gig worker under social security. Analysts expect the laws to have an impact of around 1 to 2 rupees per order.
NBCC surges nearly 4.5% after it bags an order worth nearly 117 crore rupees.
HAL trades under pressure after its light combat aircraft Tejas crashed in Dubai Air Show on Friday, making it the second Tejas crash in the last 20 months. The stock is down 3.5%. Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. Markets holding higher, as you can see to the top of the screen. The problem is the breadth of the market. You have that's under pressure. Only 1,000 stocks advancing, 1,600 stocks that are declining. That's what's not making portfolios feel too good, Mangalam. There is quite a bit of selling, and this green-looking screen, actually, the portfolios are not looking that green.
Take that point because, the large part of the up move is led by a couple of these names.
Yeah.
A lot of them from the IT pack, which has been an underperformer. But even from the banking pack, if you look at it, it's HDFC Bank, which is leading the Nifty bank right now. It's moved to the high point of trade and is supporting the cause of the frontline index. But by and large, HDFC Bank as a stock too, over the last few months or so, has been a mild underperformer. So let's take note of all those factors as well. HDFC Bank currently doing well. ICICI Bank giving it company as well. So let's see whether these heavyweights can take the market further higher from here on or not. But your point on broader markets, well taken. Let's get you some ideas for profit then. Coming in from our colleagues today, we have Money Control Pros Khushbu Rai Gupta joining in.
In today's Idea for Profit, we have Nestle India. The company saw significant growth in demand across categories led by key brands in urban India. Looking past the margin compression, the double-digit sales growth was a positive surprise amid GST-related inventory destocking in the September month. The festive demand product launch across key categories also supported growth in the quarter. While the noodles category delivered double-digit volume growth led by the key Maggi brand, in confectionery, the KitKat remained a key volume growth driver. These flagship products continued to gain market share, led by rising contribution of quick commerce, distribution expansion in the rural India, and also higher spends. Going forward, the GST rate cut in across 85 to 90% of the portfolio will drive consumption and contribute to overall growth. Hence, we believe Nestle is a good play in the packaged food segment and will be a key beneficiary of the urban demand revival.
Thanks a lot for that, Khushbu. Well, a quick reminder for all our viewers then. HSBC presents Future Female Forward Season 3, co-presented by Cognizant. From New Delhi, we bring you the newest state chapter edition with powerful perspectives, action-focused agendas, and a collective vision for accelerated equity. Tune in on 25th of November, that's Tuesday, at 5:30 p.m. onwards for insightful conversations only on CNBC-TV18 and CNBC-TV18.com. Well, time to slip into a short break. Come back, continue to focus on markets and stock-specific action. Stay tuned.
Welcome back. You're watching us here on Chartbusters. Now, as promised, let's get to the management of Billion Brains Garage Ventures, or you better know it as Grow. Ishan Bansal, who's the co-founder and CFO of the company, joins us now to discuss their second quarter numbers. Ishan, congratulations on listing the first quarter numbers that have come by as well. And alongside that, the detailed presentation that you guys have given to the exchanges, along with a Zoom call where the entire management was present. So kudos on transparency and investor trust. But now on to the questions when it comes to growth plans for Grow from here on as well. Let's talk about one of the businesses that has been doing extremely well for you. That's MTF. The book's grown from what? Almost, 389 crores in the second quarter last year, all the way up to 1,700 crores right now. That quantum jump that has taken place, do you believe that the best of growth is ahead of you? And how big do you expect this opportunity to be for you?
Thank you, Prashant, for having me here. And I think thanks for looking at us from a transparency perspective. We actually want to be as much transparent to the public as possible. Our focus on MTF has been started like a year back only. So when we look at a number from a 300 crores at a Q2 last year level, that is the time when we just started. So it was like only a quarter in. So effectively, we've been adding roughly 400 to 600 crores every quarter to our book on MTF side. I think that is what has been continuing from last 12 to 15 months. And we think it is still a early stage for MTF as a product. It is only used by around 80,000 odd customers. And we think there is still a potential of at least, if not more, at least 5% odd customers should start using it over a period of time. But MTF as a product takes some time to build up because it's a balance sheet kind of a product. So everyone doesn't need it every day. But sometimes over a period of time, people keep on using it and then they kind of redeem, or not redeem in this case, but you can say square off their positions as well. But as the more and more people start using it, the book keeps on expanding. So we expect that book will keep on expanding in the coming future as well. If you look at overall market, there is more than 1 lakh crores of book in the market, and we are just 1.5% of this market today. And we think in longer run, we can reach a double-digit number.
All right. Hi, Ishan. Welcome to the show. Mangalam asked you the first question, and Nigel is here. We're happy to have you on the show, and we look forward to interacting with you earlier as well. Prashant and myself had interacted with you earlier when you all opened up the IPO. That said, let's move on then. Let's get a couple of numbers out of the way. For the first half of the year, there's been a bit of a degrowth on revenues. But I think the street was penciling, I think Chola briefly mentioned that there'll be mid-20% growth is what you're looking at in terms of revenues. You can correct me on that. Is that a number that you would like to go by? And also, since you were talking about the MTF book, broking is dynamic part of your revenues, right? Majority of it comes from there. How do you see this evolve? As MTF and other smaller divisions contribute more, the dependence on derivatives volumes actually go down. So how do you see this contribution shape up? Growth as well as the revenue mix?
Got it. So I think when we talked about 20 to 30% kind of a growth rate, that was we are talking about from a longer term perspective. And our journey, especially because we are somewhere a capital market related business, there is going to be like a relatively ups and downs depending on the markets. And we obviously every year will not look the same. Hence, on an average basis is what we are thinking that we will probably end up doing 20 to 30% in a longer run basis. On the kind of change in pattern, we have already seen derivatives as a business, as a contribution of derivatives as a business has come off. Earlier it was in late 60s, now it is in late 50s. I think it will come off even further as our MTF and the newer business starts contributing more, because the growth rate of those businesses is significantly higher. And hence, in longer run, we expect all the businesses will start contributing significant revenue, and broking overall will probably we're more closer to like say 50-60% compared to only the derivatives piece doing 50-60%. Cash as a business is also growing because the MTF also gives benefit to the cash as a business because the brokerage component of MTF will be counted under the cash or stocks as a revenue for us.
Right. I'm looking at your product portfolio where the first touch point of the consumers happens with Grow. Understandably, when you started out, it was stocks, derivatives, IPOs, MF lump sums, etc. But as the markets are maturing, the cult of equity is growing. We've seen a large part of your new customers first interact with Grow via SIPs. So this number, same time last year, was 29%, and it's inched up to 36% as well. What is your plan on monetizing this, and how do you translate this first touch via SIPs into revenue for yourself?
So the way we look at it is we are a platform, and if customer comes from any of these products, we get their mind share, their kind of investments on Grow. And over a period of time, most of these customers end up doing a second or the third product. So in even on the mutual fund side, you can see that within a time frame of let's say 2 to 3 years, more than 50% customers start using a second product. Second product, most of them will be like stocks or in some cases derivatives or in some cases credit. But there is like a lot of customers who need both of these products. And on a overall India basis also, if you look at it, roughly more than 50% customers will be common between mutual funds and stocks. SIP as a product is very beautiful from a customer's kind of wealth creation perspective because it helps them keep on adding money in both ups and downs of the market and generate more stable returns in a longer run. And it creates a positive loop for the customer on the platform as well.
Right. And how does that impact your customer acquisition cost over a longer period of time? Because one is sticky, and then secondly, because of your platform approach, people start using other products as much. So ideally, that should lower your CAC, right? How has that moved? And it should also increase the lifetime value of a customer because of your newer offerings. So this CAC to LTV sort of ratio, how does that change from what it was to now and what it could look like going forward?
So LTV actually has been slightly difficult for us to calculate because we've been launching newer and newer products. But what we look at is on a short-term basis is a payback period. And generally the target is the payback period should be somewhere between 4 months to 6 months. Today we are more closer to 6 months because market has not been very good in last 1 year, and hence the acquisition has been relatively more expensive. And CAC, if you look at, we look at CAC on a blended level because it's very difficult for us to message exactly that a customer A will start with SIP or will start with stocks. But what we message to the customer is if they want to start investing, probably Grow is one of the best platform for them to start investing. And we have multiple products available for them, and they can start with whatever they are comfortable with.
Okay, all right. Ishan, final couple of questions before we let you go. You know, the investor base moving up is going to be important. And that base actually has reduced. What are the targeted numbers there? For example, how long will you take to maybe double this customer base that you have right now, investor base that you have? A rough projection out there. And as you said, on a longer term, we're looking at 25% revenue growth. But in the near term, for this year, what should the street work with in terms of growth, given that the first half of the year, you have a degrowth of around 10%? So give us clarity on both these two fronts, this year's guidance, as well as in terms of the customer base.
So on the customer base, idea is that there will be like, again, when market cycles are negative, the growth actually takes a hit. But in that market also, if you look at it, with the exception of this last quarter, our NSE active number has been growing, but active number on the platform was still growing, but it was growing with the lesser pace. So YOY 20% growth is still there when we are looking at a bad markets. So we think this 20% growth rate we can maintain in bad markets and can be easily be beaten in the good markets as well. So assuming if the market continue in a similar way, we will be more closer to 15 to 20% kind of a user growth. Coming back to
FY26,
this year's numbers. So I think first 2 quarters was slightly different because the regulations that came in, there were two regulations that primarily came in. One was regarding the derivative side, and another was regarding the true to label side. Both of them started happening from October timeframe. And what we see is that without these regulations, we've been doing well. And in the coming quarters, you will start seeing the growth also from a YOY basis, from a revenue perspective. But it'll be very difficult for me to come to a number saying that how much will be a blended number coming between both of these with regulation and the without regulation kind of a time frame.
So on a year-on-year basis, by the end of this year, when we speak at the start of the new financial year, would you have had positive revenue growth in FY26 versus FY25?
Our expectation is that, yes, this will be positive.
All right. And just throwing this one at you, Ishan, with a lot of studies that suggest most of the traders are making losses, 80-90%. You observe the same?
So in our case, it's slightly different, but what we have seen is that derivatives as a product is very small on our platform from a number of users only doing derivatives. So there is around 0.3% customers who only do derivatives. And in that cohort, this number is similar. But our expectation is that people end up doing multiple products. And hence, if they are losing money in one product, but they are still making money on the other product, overall, still they are growing their wealth.
What's the average return per grow customer on a year-on-year basis? Have you done this calculation?
So that number is very variable, obviously, because again, it's linked.
It's a function of the market, yes.
But people have generated, I think there was a time frame when we looked at this, I think around 60 to 70,000 crores was generated on Grow as a platform. And I'm sure this number would have increased further in the recent times. I think this number is something a year old or so.
Okay. All right, Ishan. We'll try to get you further clarity, but appreciate you joining in. Wishing you as well as the team all the best, in the time to come. And we look forward to chatting up with you soon. Have a good day ahead. Well, time to slip in a short break, but as we do that, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates. All of that at your fingertips. Download the CNBC-TV18 app from the Apple Store or from the Google Play Store. Or you can just scan the QR code that's come up for you on the screen. Welcome back. You're watching Chartbusters here on CNBC TV18. Well, as promised, let's get you a technical check. We have Dharmesh Shah of ICICI Securities who joins us on the show. Hi, Dharmesh. Good morning. Good to speak to you. It's been a while since we chatted. Well, tell us, how do you view the Nifty? What's the call out there? Levels you're tracking, and fill us in with your individual calls.
So good morning, Nigel. Yes, definitely. I think so. There is a lot of tough war happening between bulls and bears at the psychological level of 26,000, 26,200. But what we believe, I think, so the way the technical setup seems to be forming for the Nifty, it looks like, I think it's a question of time. We should take out the lifetime high and we should be looking for a target of around 26,500 for as far as Nifty is concerned. If you look at the relative outperformance for last 2 weeks, I think something key point to highlight is that the Nifty has been outperforming by 3.5%. Whereas if you look at the global markets like Dow Jones or even European markets, they are down by 5%. So in terms of relative outperformance, yes, definitely Nifty is showing the signs of relative outperformance, but some bit of a selling pressure in the small cap seems to be disturbing the party. But we believe, I think so, the way the technical setup for small cap also, it looks like, I think so, it is at the very strong support of 200-day EMA. So we believe we can see some bit of a stability in the small cap also from the current levels. But as far as Nifty is concerned, we expect Nifty to head towards 26,500 with strong support placed at 25,600. So yeah, buy the dip should be the strategy going forward. As far as Bank Nifty is concerned, yes, definitely Bank Nifty has been the leader even the current today's trading session. We expect Bank Nifty to head towards 60,000 in the coming few days. So buy the dip should be the strategy going forward.
All right, buy the dip should be the strategy. Any particular stocks, Dharmesh, that you'd like our viewers to take note of?
We remain to be positive for the Bank Nifty so PSU banks looks more positive from the current levels. As you look at the PSU index, I think so it seems to be coming out of a 16 months of long consolidation breakout, which augurs well for the uptrend going forward. So we believe Union Bank among the PSU banks looks positive. Again, the stock is forming a cup and handle formation, and the way the technical setup seems to be forming for Union Bank looks for a target of around 168, giving a stop loss of 138. So Union Bank remains to be a topic inside the banking space. Apart from Union Bank, logistics space looks positive, and where again we remain to be positive for Adani Port. Adani Port, the stock has also witnessed a breakout from the cup and handle. For last 6 quarters, the stock has been consolidating in this range of 1,000 to 1,500. We expect a breakout to happen above 1,500 and look for a target of around 1,675, keeping a stop loss of 1,375.
Okay, all right, Dharmesh, quick word on the metal index. When things were looking good, very bullish calls are coming in on the index itself. Now, the globe has gone into a bit of a near-term tizzy, a bit of risk-off prevailing, Bitcoin slumping, some softness in terms of global metal prices. And also you have the Fed that may or may not cut rates. Any view on the index?
Yes, Nigel, if you look at the metal index from the medium-term perspective, what we see is nothing but a retracement happening of a sharp move in the metal index. And also the dollar index also is something which is disturbing the metal party currently. But what we believe for metal index, I think so, it seems to be forming a strong support at around 9,600, 9,700, which was the previous breakout level. So yes, metal index, we are not negative. Yeah, in the near term, we can see some bit of a profit booking happening for the metal space as a whole. But from the medium-term perspective, I think so any fall or any dip in the metal stocks like Tata Steel or even SAIL should be looked as a buying opportunity.
All right, we take that point. Just before we let you go, here's a curveball. Do you have a view on the IT space?
Yeah, IT, again, I think so, depend on the US market. But the way the technical setup seems to be forming for the IT space and for Indian market, it looks like worst seems to be getting over for overall IT space as a whole. We believe the stocks like TCS, Wipro, HCL are the ones one should definitely look out from the medium-term perspective. So we are not so negative for the IT, but yeah, definitely it's more of a stock-specific rightly going on in IT space.
All right. Dharmesh, thank you so much for joining in and giving us your view on a whole host of stocks and the index. Buy on dips should continue. With that, what we'll do is take your leave on this edition of Chartbusters with the promise that the team of Trading Hour comes up next. All 4 indices in the green, not so much the broader markets in terms of market breadth, but let's see how that pans out. From Nigel and me, the entire team, thank you.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Reema Tendulkar and Hormus Patakia. Hey guys, good morning. It's a Monday morning. You're back from work and it was a long work week for you as well. But you've come back to a week where we are seeing some green on the Nifty. We saw second consecutive week of gains on the Nifty last week. Today as well, we opened in the green, but we are off the highs of the day. So it's a 40-point uptick as we speak, but we are 40 points off the highs of the day as well. So in the last couple of minutes itself, we saw that, selling come by in the Nifty. What is leading to that? We do have a couple of these banking names. There's Reliance Industries, some of these steel names as well, metal names for instance. They are the ones which are leading to this selling pressure that has come off from the highs of the day. So watch out for that one. Mid caps, that was the only index which ended in the red last week. The others did really well. So we'll watch out for that performance this week as well.
And I think the good luck charm for IT, right?
Yeah.
IT index is doing very well, and that's leading the gains. The Nifty IT index is up more than 1%. And look at the movers there. You've got a Tech Mahindra, which is racing away across the 100-day moving average. That's the top Nifty gainer. Giving it close company, Wipro, Infosys up close to about 1.5%. On Tech Mahindra, there's also an upgrade from HDFC Securities. So they were earlier reduced. Now they've upgraded it to an add. And they say that the valuations relative to peers is pretty okay. So the stock is trading at about 19.5 times forward multiple, cheaper than HCL Tech, cheaper than TCS, cheaper than Infosys. And therefore, it's an add rating and an upgrade. So IT is doing well, but what about other stocks? Hormus is at the big wall and he's putting the spotlight on the individual movers. Hormus.
You can't not talk about IT. Let's talk about the trading volumes in today's session. He spoke about Tech Mahindra and of course the top gainer on the Nifty, and it shows up on the kind of volumes at which it is trading as well. It's close to 30 lakh shares that have already been traded. The 20-day average here is only 4.5 lakh shares. The Motilal Oswal note is projecting a 66% upside on the stock, and giving it companies, Infosys had close to 40 lakh shares traded, double of its 20-day average, and Wipro as well. The upgrade that has come in earlier in the day, 32 lakh shares traded compared to a 20-day average of just around 19 lakh shares. We spoke about VLS Finance on Bazaar, and the stock now is up 17% in today's session. Now it's up 7 out of the last 8 trading sessions. It announced a 100 crore buyback over the weekend, and that buyback size is almost 25% of its free float market cap. And the volumes as well. We spoke about the volumes declining after the announcement was made last week that they will be considering a buyback. But today, close to 5 lakh shares traded. 20-day average is only around 50,000 shares. So, and trading above all key moving averages as well. But despite this move, the stock has been an underperformer, down 8% so far this year. And lastly, TeamLease, the stock has snapped a 2-day losing streak, but the volumes in just the first couple of hours of the session are at the highest level since March of 2018. And take a look at the volumes here. Almost 8 lakh shares have been traded on TeamLease. The 20-day average is only 4,500 shares. So not a typo, only 4,500 shares. Whereas broken above its 100-day moving average of 1821. And despite this, the stock has been a big underperformer this year, down almost 40% so far, and was down 8% in 2024 as well.
Very much for that. Moving on then to some other stocks. AG Infra and Kalpataru have also surged in trade. This is after a joint venture agreement for the Maharashtra Metro Rail project. Vivek joins in with the details.
Well, that's right. So a JV between AG Infra and Kalpataru projects, a 40-60 JV, where the 40% of ownership is from AG Infra. This particular JV has won or has been declared as the lowest bidder, the L1 bidder, for a Thane Integral Ring Metro project in the state of Maharashtra. The total project is an EPC project. The bid is 1,415 crore rupees. The time period for construction is 3 years or 36 months. And this particular bid was done by the Maharashtra Metro Rail Corporation. Now remember, AG Infra, this is a material order given the fact that the order book was just close to 14,000 crore at the end of Q2. And Kalpataru projects, the order book was a little over 64,800 crores. So overall, a positive development for both of these names in terms of order visibility as for the second half of the year.
Okay, all right. Thank you so much for joining us, Vivek, with all those details. Let's move on. Speaking to CNBC-TV18 on their 125th anniversary, Royal Enfield CEO says that the motorcycle industry is growing at a pace of 8%, while Royal Enfield clocked a 27% growth in the first half of this fiscal year. Listen into this and more.
As of now, I do see the motorcycle industry will continue to grow in the near future. Currently, it is growing almost about some 7-8%. In fact, we have been growing. Even last quarter, we grew almost about 45% compared to last year. And in the whole H1 level, we grew almost about 27%. So our growth also has been good. And I do see the growth momentum will continue. But the powertrain may change. You know, technology disruptions are taking place. Consumer preferences are taking place. The preferences can be on the technology of the powertrain or the way the retail takes place. So as an organization, we are always proud to say we are a 125-year-old startup mentality company. And we are very agile. We enjoy that because fundamentally we feel, you know, we have to continuously improve. This is our first product, which is a C6. And for the City Plus applications. But when you say City Plus, I mean, there is also a possibility for us to do a bit of off-roading and some exploration which is possible. Maybe this caters to one kind of a consumers which we like it. Then we thought that, okay, in that platform, what is that we can do is the S6, which is the scrambler version, and which has a bit more ground clearance. You can see it here. We're just thinking about the strategy of go-to-market. Currently, the thought process which is coming up is probably in India first and followed by Europe. DNA of Royal Enfield, we always look at pricing as it has to be most accessible and create a market. So we will be at the most accessible price point for the consumers to see. That's a value for money that I can't deny like that. That's almost about 400 people as of now who are working exclusively into the electric field. In fact, already we have about 40 patents which we have filed. At a capex level, we have a lab which is set up at our Vallam facility. Almost about 120 crores we have set up for the electric lab. This is a product development lab. And the total capex so far, we have done almost about 400 crores. And we have applied for PLI and along with the VECV together for the mega PLI application. And we are set well for the capex. And we also set up a line which can cater almost about 1.5 lakh capacity for both these products at our Vallam facility. So those lines are also ready now.
That was a rare and exclusive chat with the Royal Enfield CEO, but stay tuned for more excerpts of this interesting chat all day long on CNBC-TV18. Welcome back. As promised, shifting focus to the crypto space, Manisha is here to explain the latest sell-off in the crypto markets. Manisha.
Well, it is the latest sell-off, yes. For 4 weeks, we've been declining when it comes to crypto. This is a 5th week when we are looking at some stability, but the markets are just about reading it a pause with lower sides still open when it comes to this one. So when you look at the Bitcoin itself, we are trading at a 7-month lows for this. We did see a low of $82,000 as well. Remember, Bitcoin has come off all the way from 126,000 of an all-time high on 6th of October to 82,000 at this point in time. So very sharp declines coming in with that. And when you look at that in sense of numbers, well, since October, we've seen $19 billion being wiped off in sense of crypto selling. Overall market cap for crypto, well, that is down by $1.7 trillion from the kind of highs that we've seen in 2025. So sharp sell-offs is what we've seen, not just in Bitcoin, but various other altcoins as well. Is the reason you're looking at most people not even coming in to buy right now. So speculative positions from retail is not really happening. That has led to various other altcoins, including Ethereum, Solana, Cardano, all of those cryptos also declining anywhere between 20 to 45% from the kind of highs that we saw in sense of 2025. Ether itself is down 40% from its August highs therein. Overall, when you look at the markets, well, the digital asset treasuries are struggling because of the decreased NAVs there. You also are looking at funding for the newer investments or retail buying also continuing to go in decline. So even as people might or funds might want to buy it, the funding itself has continued to decline. So there is no buying activity that we've seen for many of these cryptos here. Apart from that, when you look at the MSCI stock market index, well, there is a news that they are considering exclusion of corporate crypto treasuries with balance sheets comprising of over more than 50% in sense of crypto assets. The discussion for this is expected to continue until mid of December, and that whatever comes out of that would yield a lot of impact on the crypto markets there. Well, having said that, there are some developments as well in the last 1 week that we have seen within crypto. Coinbase, for one, has introduced Ether-backed loans for its US users. The consumers can now borrow USDC against their Ether holdings. The DeFi Education Fund, well, they are going to be utilizing DeFi technology to reduce cost and combat poverty in US is what their sheet says. And then you have MasterCard simplifying crypto addresses with the help of Polygon. So there are those headline news as well coming in, but it really is the decline in prices that the street is bothered with.
Thank you very much for that. Get into a break. On the other side, market technicals, Nagraj Shetty from HDFC Securities joins in next. Welcome back. Now it's time for Under the Lens, and Sonal has now moved over to the big wall, and she's going to tell us about Aztec Life Sciences.
Thank you so much for that. Aztec Life Sciences, that is the stock under the lens, and it surged another 12% on Friday after a 20% upper circuit on Thursday, gaining 32% in just 2 days, even though the stock is still down nearly 23% for the year so far. The move came after bulk deal on Thursday, November 20th, of 3.86 lakh shares on the NSE at about 711 rupees, and several brokers were seen doing intra-folio transfers through the session. Let's talk about the company now. The company, which manufactures agrochemical active intermediates, has been struggling with its financial performance. Revenues for the first half of FY26 stood at 165 crore rupees against 81 crore rupees in FY25 and 458 crore rupees in FY24 itself. You can see the numbers on the screen as well. EBITDA, that remained negative at 18 crore rupees in the first half, which compares with a loss of 66 crore rupees last year, while FY24 had posted only a marginal profit. Net losses continued with a 57 crore hit in the first half itself, following a loss of 135 crore rupees in FY25 and around 46 crore rupees in FY24. The management has attributed the weak performance to a cautious stance taken by contract manufacturing customers. Over the last 5 years, sales have declined at a CAGR of 6% for the company. Operating cash flows in FY25 was at a negative 8 crore rupees as well. And the ROCE, that is the return on capital employed for the year, came in at negative 13%. The company also continues to carry net debt of around 375 crore rupees. That's a big number and almost equivalent to the revenues of the company as well. Its financial position received some support through a rights issue of 249 crore rupees in July 2025, which was raised in a 1:7 ratio. However, they have raised it to fund growth initiatives and strengthen the balance sheet. All of it is not enough to actually pay off their debt. They really need to earn more money inside the business, have more cash flows to be able to pay that off. Promoters increased their holding to 72.42% in September from 70.87% in March this year, while mutual funds currently hold just about 4%. But important to note that while the rally has come by, underneath the rally, there are a lot of numbers which are something which would concern the investors.
Concern the investors indeed. Sonal, thank you for that update. We did speak about Aztec Life and the excessive volumes that the stock at which it traded during Thursday and Friday's trading session as well. But well, the index as of now below the mark of 26,100, still off the highs of the day, still holding on to some of the gains. Good time to get in Nagaraj Shetty of HDFC Securities for a quick chart check. Nagaraj, good morning. Thank you for joining in. Some consolidation on the index, but do we see new highs this week? Your call on the index and specific stocks as well.
Hi, good morning, Thomas. Yes, rightly said, market has been consolidating. Though index plays at the higher levels, market breadth is a little bit weak compared to other days normally we see. Nevertheless, market is, with the strength of the market, is the benchmark remains positive. And at the lower levels, around 26,000, 25,900 is going to be a strong support. And I'm expecting eventually Nifty could bounce back from here onwards from the support and could hit the upper range and a new all-time high somewhere around 26,300, 350 levels, at least in the next 1 week. And I'm still positive on the stocks as well. Some frontline and selective stocks are looking very positive. One of them is the Eicher Motors. Chartically, Eicher Motors was in a larger consolidation buying in a range bound action. The recent price action indicates a decisive upside breakout, currently trading around 7268 odd levels. One can look to buy at this point of time. 7650 is going to be the immediate target, and one can place a stop loss at 7000. Second one is from a PSU banking side, the Canara Bank, after witnessing an upside breakout, it has consolidated recently from the highs in the last 2 sessions and placed at the support of 10-day EMA. So currently trading around 147.60. I can recommend these stocks. One can look to buy at this point of time, and the upside target would be around 155, 156 levels. One can place a stop loss at 143.
Nagaraj, thank you for sparing time and joining us with your views on the index and for specific stocks as well. Take a short break, continue our conversation on the markets with Manish Dangi from Mosaic Asset Management on the other side. Stay tuned.
Welcome back. IT is the big gainer today, and remember Motilal Oswal upgraded the Indian IT sector to an overweight, and they've given 3 key reasons for the upgrade. One is the underperformance. This year, in fact, the Nifty IT index is down 12%, so it's underperformed. But even over the last 3 years, the Nifty IT index CAGR is just 3%, starkly underperforming the overall Nifty 50 or Nifty 500. Secondly, and this is interesting, so they're basically saying the global AI infrastructure. Now we could be seeing a shift from infrastructure build out to application and maintenance, which is where the Indian IT companies come in. And thirdly, they also go on to say that the Nifty IT's profit share in the indexes remain constant at 15% for 4 years, but the index weight has dropped to a decadal low of 10%. But moving on now to the futures and options space, Mangalam is now joining in.
But if you look at the markets, we have the frontline indices doing okay-ish. We have the Nifty, we have the Nifty Bank, as well as the IT index that you were talking about, Rima, which is doing well. But if you look at the broader markets, that's where the problem is. If you look at, the advanced decline ratio, and that will tell you that more stocks are declining, 70% more stocks are declining than the number of stocks which are advancing today. And that would make portfolios feel a lot worse than what the frontline index is showing. So that's something we will be watching out for. The good part, however, is that even as we're seeing supply at higher levels, the support for the market has been fairly intact between this 26,000 to 26,050 mark. So we're consolidating as we move higher. Right now, if you look at the last 3 trading sessions, which includes today, the lows on the Nifty have been between 26,050 and 26,060 itself. So that's an important part to watch out for. So even if the market has come off the highs, it is still above the lows, and that's a positive. What is it that the option writers are positioning themselves for the Nifty? And remember, the Nifty November series expiry happens tomorrow, and out there ahead of that, the 26,100 mark seems to be a bit of a fulcrum. So the 26,100 put and the 26,100 call have been the most actively traded straddles, and which implies that those who have written both the 26,100 call and the put are playing for a combined premium of 150 rupees, which again implies that there is support between 25,950 to 26,000 and resistance above 26,250 to 26,300. And that's something that is further confirmed by the Nifty recent high of 26,247 and the call writing that we've seen at the 26,200 mark as well. So those are a couple of things that we will be watching out for. Frontline indices doing well, broader markets not so much, and the Nifty consolidating after having moved higher between 26,000 and 26,250.
Okay, all right. Thank you so much, Mangalam, for joining us with all those cues. But a quick reminder for our viewers, HSBC presents Future Female Forward Season 3, co-presented by Cognizant from New Delhi. We bring you the newest state chapter edition with powerful perspectives, action-focused agendas, and a collective vision for accelerated equity. Tune in on 25th November, Tuesday, 5:30 p.m. onwards for insightful conversations only on CNBC-TV18 and CNBC-TV18.com.
Welcome back. Continuing our conversation on the markets with Manish Dangi from Mosaic Asset Management now, who is joining in. Manish, good morning. Thank you for joining in. And the big global question now is whether or not the Fed cuts rates next month. The general consensus among a lot of the Fed members who have spoken all through the week and the week before that has been that it will be prudent to keep rates on hold next month. But based on the macros that are emerging with the lack of data and the data fog that the Fed's facing, what do you expect the Fed to do this time around next month?
Hi, morning. So the probability of rate cut, of course, given that US is a very transparent system, and now we know, as a matter of fact, that the probability is less than 50. Markets sort of are actually poised to think through this particular event, and I kind of think that for next 6-12 months, markets are pricing in about 50 basis point. My personal view, of course, is that underneath this AI boom, there is sort of a slowdown developing in the US, and that should pave way for deeper rate cuts over the next 6-12 months. But the base case, of course, market expectation is that 50 basis point rate cut coming in 2026.
Manish, hi, morning. What about RBI? You have said the RBI has no choice. Rates have to get crushed much lower. Tell us a little bit more about this. Yeah.
It's to get your attention there. The crush lower, essentially, our markets are baking in about 50 basis point rate cut. India sort of has a decent macro. For a very long time, we really didn't have the place to actually ease rates as dramatically as we can today. And most importantly, as a matter of fact, Indian nominal GDP growth is beginning to converge with the nominal government bond yields. That's not what you and I have seen over the last 25, 30 years. Until about a decade ago, the nominal GDP growth used to be 6, 7, 8% higher than the bond yield. They pretty much are converging right now. And I think, think of it from an equity market partner's standpoint, the nominal GDP growth, which is 7, 8% right now, is like ROE of a country. And the bond yields are like a cost of capital for the country. And, if they convert, of course, they should hit hard in terms of investment intentions or PE ratios, the way you see it. So my sense is that India has a decent playground now to actually ease rates significantly, not from a cyclical standpoint, but actually ease rates in a meaningful fashion that they're actually lower than what we've seen in the previous cycles.
So what are the numbers we're looking at? Not just in the near term, but as you said, this is a structural thing now. Rates over the long term in India have to be much lower.
Yes. I think, because Indian inflation has converged with the West to a certain extent, and a lot of Chinese deflation is entering our geography. Indian dependency rates have now come into this real, demographic dividend era. Our CAD has actually now sort of ex-gold is tracking 0.5% or thereabout. So we have all, potential conditions to actually beginning to converge over next 10, 15 years with, what perhaps you have in China. Our total fertility rate actually is also likely to converge with China in next 20, 25 years. So I think over a longer period of time, all rates almost all the time, converge. And I guess, something would happen to Indian bond markets also. So my sense is that I won't be surprised if the central tendency of bond yields, which is right now at 7%, will go to 4% in 10, 15 years time. But these are very long run views. In this cycle, as I've argued on your channel for last 1.5 years, I see bonds at 5.5 or below on a 10-year bond yield, I mean.
And this inflation in India, what are the numbers we should expect over the next 12 months?
So super low inflation, ex-gold inflation actually is sort of sub to core inflation. I think it will, given now there's a super low base rate now, especially on the food side, some buoyancy will be there in inflation, so this low inflation actually not good for markets. So hopefully with GST cuts, maybe sort of substantial more rate easing, more liquidity, some kind of pickup in inflation should happen over next 12 months. But I wouldn't be betting on inflation more than 4.5% over next 1 year also. So in a sense, yeah, so again, base case is to be close to 4, what RBI wants to achieve. And therefore, the base case is that the repo rate should be 5 or below in 6-12 months' time.
Manish, thank you so much for sparing time and joining us. Running out of time, so we'll continue this conversation when we have you next on the platform. Take a short break. On the other side, our big story, Rituraj Sinha from SIS and Sonu Iyer from EY India join in to discuss the impact of the new labour laws. Stay tuned.
Welcome back. You're still tuned into Trading Hour. For the markets, it's a 52-point uptick on the Nifty. We are at the 26,121 mark. We did see that fall when we started the show, but there was a swift recovery as well. Again, there is some pressure on the Nifty, but again continues to be in the green as we speak. Nifty IT, of course, batting it for the bulls. That remains the top gainer. The banking index too is doing well today, so that index is up around 450 points as we speak. That is one of the reasons why we are seeing that recovery on the Nifty as well. The bank Nifty is at the day's high as we speak. We do have Kotak Mahindra Bank, ICICI Bank, HDFC Bank, all of these stocks which have surged from the lows of the day and are leading to the gains that we are seeing in the Bank Nifty as well. So look at that, Kotak Mahindra Bank at the day's high, HDFC Bank, a big weight on the index, is up around 1.1%. Some stocks which are at the day's high, we do have Bajaj Auto, which is doing well. L&T too is in focus right now. It's at the day's high. We do have Pharma, SBI, some of these stocks which are on our radar and doing well from the lows of the day. But the big story of the day has to be the government's new labour codes. Effective November 21, 2025, bring gig and platform workers under formal social security for the first time. We'll understand the developments and the impact, but first up, let's get in Winnie, who is joining in with the news, and then we go across to Mangalam with stock-specific impact. Winnie, let me start with you first up.
Hi, so yes, an important change that has come in these labour rules. Now, what are the changes? There are 4 labour laws. They are going to now come into 4 codes. This is going to be from the 21st of November 2025. What is it in this in terms of changes? Statutory right to minimum wages for all workers. Gig workers also will come into this play as well. There will be a national floor wage which will be set by the central government. The basic pay now, that must be at least 50% of the total salary. That's an important update. Gig and platform workers will be included under social security. So what are the benefits that actually come in terms for changes in terms of workers? One, there's a fixed term employment that comes in for them. Therefore, contract workers now they'll receive benefits which will be comparable even to permanent employees. While permanent employees used to get these benefits before, whether you look at a PF, whether you look at medical cover, social security, now even gig workers, temporary workers, there will be a sort of a contract that comes in where they will also be applicable to that. Now, in terms of eligibility for gratuity, which was 5 years, will come down to 1 year. There'll be timely payment of wages that will be mandated. Payment during leave also will become compulsory for them. There'll be overtime wages which will be double the normal wage rate as well. And women workers are again gaining explicit right for equal pay. Appointment letters will now become mandatory for all employees. So formalization, that is the important thing, right? You will see more formalization coming into the whole process, employment process as well. There will be free health checkups that is there in requirements. So important updates that have come in here. And paid annual leave eligibility also is reduced to 180 days from 240 days previously for these workers. Now, from the employer's point of view, one, the codes are expected to increase wages, improve social security. There will be simplification in terms of codes. The labor codes and laws that were there before were very complicated. Now, it simplifies as well. This will help them preserving in terms of controlled trade union activities, fixed term employment options also which will come in there, so more flexibility. And obviously in terms of benefits for company as well, one, staffing companies, what does it do? Increases the addressable market share. Other than that, 90% of informal jobs that are there currently, that will start formalizing, so benefit there. So formalization, digitization, simplification, as well as improved productivity are the things that will benefit these companies as well.
Okay. All right, Winnie, thank you so much for that. Let's go across to Mangalam. Mangalam, what about Swiggy and Eternal? They could see major impact?
Well, they will see an impact, but the important part is for all the platform companies which do employ gig workers, gig workers and platform workers being recognized under the Social Security Act for the first time is a positive. And platforms must contribute about 1 to 2% of their annual turnover, which is capped at 5% for gig worker payouts. The Social Security is an important parameter to watch out for. We saw a decline in Eternal and Swiggy's prices earlier in the morning as the stock price is concerned, but thereafter there has been a recovery. Why is that? Because despite a near-term disruption, there's actually going to be a long-term positive for all these platform companies because it actually codifies and simplifies labor laws and importantly also ensures that there is a steady supply of gig workers too. The benefits will be rolled out via state welfare boards and government schemes. Now, Eternal and Swiggy on their part, what we understand from analysts is already provide for health insurance to riders, which amounts to anywhere between 0.7 to 1% of their overall GMV. Now, if the mandate as it provides 2% of sales, the incremental hit could be 150 to 200 crore as far as the GMV is concerned. Now, how much does that amount to overall? Would be no more than 1 to 2 rupees, at best 3 rupees per order that may, the analysts believe, be passed on to the consumer over and above the 10 to 13 rupees that these companies charge as platform fees itself. So a temporary disruption, an increase of 2 to 3 rupees per order, but this is a long-term positive as far as supply for gig workers and platform workers is concerned. On its part, the companies have said that they welcome the government's proposals on gig worker safety, but they will await the final notification before assessing materiality. The street has assessed the materiality. They've seen a temporary hit, which is why the stocks were lower. But because this is a long-term positive, the stocks have recovered. And remember, these companies are all fairly cash-rich.
Thank you very much for explaining that so well. And even the long-term financial impact is very manageable. In fact, let's get in one of the companies which could be impacted. This is a company called SIS, where they staff security guards outside premises. Rituraj Sinha, Group Managing Director of SIS, is joining in, and Sonu Iyer, partner at EY India, also with us. Thank you very much, both of you, for joining in. Mr. Sinha, if I may start with you, if you could tell us, for your company, how do the newly implemented labour codes change the cost structure over the next 12 to 18 months? And two, will you pass on these costs to the clients, or do you think there will be some margin compression?
Thanks for having me, Rima. I think first and foremost, we welcome the implementation of the labour codes, much awaited. And I think it's a big positive for our industry. It's a big positive for SIS in particular as the market leader in our space. Firstly, I'd like to say that it's a fundamental reset. You know, anybody who deals with large number of employees was tackling 29 separate labor laws, some of which were formulated pre-independence, most of which were formulated in 1950s and 60s. So completely out of sync with the current environment of economic activities. So we are very pleased that 29 different acts have been consolidated and simplified into 4 codes. I think this is pro-employee, this is pro-employer, and it is definitely a revenue and margin kicker for SIS.
Okay, can you explain how is it a revenue and margin kicker before we get Sonu in? And what are the numbers you're looking at?
So I think it's still early to talk specific numbers, but let's talk about a simple concept like the Code on Wages discusses a national floor minimum wage. Now, we all know that there is a mega disparity in India with regard to minimum wages. You know, in places like Maharashtra, in Andhra Pradesh, in Karnataka, the minimum wage for the same work starts at 20,000 rupees plus. But if the same job is performed in UP, Bihar, the minimum wage is as low as 12,000 rupees or even 13,000 rupees. So there's a fundamental disparity in the rate of pay depending to the geography in which an individual is working. So for the first time, we have a scientific wage fixation mechanism which factors skill, location, and working conditions. On these 3 criteria, a wage category will be set and a national floor minimum wage will be set, below which nobody can be paid. And I think for businesses like us, where we have a direct pass-through built into our contract, where every single rupee increase in any statutory compliance, it could be wage, it could be PF, it could be ESI, it could be bonus, any statutory change is simply a pass-through to our customers. I think this is a positive for our workers, it's a positive for our business, and I think in the long run, it will help our customers significantly as well.
Okay, all right. We get that point, Rituraj. Thank you for explaining that. It will be a pass-through. That's the word coming from SIS. Ms. Iyer, let me get you in the conversation as well. This is a consolidation of 29 central legislations into 4 rules. Can you give a sense of what your initial thoughts are? Something very specific which you think is an outlier, which would be a benefit, or something that you think could have been done better?
Thanks very much. Thanks for having me on the show. So, you know, as Rituraj said, and as Winnie and Mangalam also kind of prattled out all possible changes that we are seeing in the labor codes unfold, I think these are game changer reforms, long time coming, you know, and at the the point where India is at a cusp of, wanting to take off leverage from the disrupted supply chains globally. I think we just needed this. And I think to hear Rituraj welcome it is also a positive indication from the industry. There will be some pain as we settle into it. But, all in all, about time that we modernized our labor law framework, because we have been sort of suffering from duplication, multiple statutes. So, if you look at it only optically, 29 laws getting compressed into 4 codes. Of course, the rules will come at state levels as well as the central government level, but it is a game changer reform. And we'll see the benefits over the years. Globally, we'll become much more competitive. There's work, and I think Rituraj very well explained the fact that predictability and stability in minimum wages will really help industry become competitive. Look at the, businesses that compete in the global market, where you find in many, many Asian economies, the minimum wages are much lower than what we have. So just for us, the problem is not the minimum wages, but the unpredictability or how often and frequently those get changed. So some harmonization work still pending, but at least the national minimum wage will ensure workers have a decent right to a fair wage. And that fair and equitable workplace is in modern times indispensable. I mean, we really need that to happen.
Indeed. Ms. Iyer, you partly answered the question that I was going to ask you. Any landmark or major law that gets enacted in a country like India, the biggest challenge is its implementation. You partly mentioned that there needs to be some bit of harmonization with regards to its implementation. Yes, but what are some of the other challenges that you foresee when it comes to implementing a law like this, especially in a workforce as big as the Indian workforce and in a country as large as India?
Yes, so what I mentioned, the harmonization with the state rules is going to be a big one. So there needs to be a super consultative and mature approach at the state level also, in ensuring that we don't create, rules which are not in sync with the intention behind these labor codes. Then from a perspective of, again, minimum wages is a big area of work. That's why it is worth mentioning it again here. We will see some pain around gratuity because gratuity will have a retrospective cost as is currently worded in the law in respect of employees who've been in the system for whom provisions have been made in the P&L. So we will see an impact on gratuity provisions that will have to be rewritten considering the new definition of wages. But I want to, I think one thing that's going around in the media that it is gratuity that will be payable for all employees after 1 year, etc. What we need to make a distinction is that 1 year, after 1 year, the entitlement for gratuity from a perspective of equity has come in for fixed term employees. So people who work on a fixed term contract, they will become entitled to gratuity after 1 year, which is typically payable for permanent employees after 4 years or 190 days or 5 years is the rough number that one goes.
Just confirming, Ms. Iyer, you said this is retrospective.
For gratuity, the cost will be recalibrated because the definition of wages has changed. Today, gratuity is computed on basic salary. But in the new definition of wages that has to be used for computation of gratuity, the basic wages plus basic salary plus allowances, except those that are expressly excluded, which means there is a delta that if you are not already at 50% of CTC for computation of gratuity, then those businesses will see some increase in costs.
What?
But it'll be business specific. You'll have to compute for each business.
We'll come back to you for the impacted sectors. But Mr. Sinha, you wanted to come in and make a point?
Thanks for the opportunity. I think, we are getting caught up in the nitty gritty. I think let's look at the big impact. I'll call out 3 for you. Number 1, I see this as a demand stimulus for the Indian economy. Just imagine 13 to 15 crore people who earn between 1.5 lakh rupees a year to 3.5 lakh rupees a year. The entry-level jobs, these people are going to receive a higher pay, better social security, better healthcare because of this act. So I'm talking about 15 crore people who get inducted into the formal work sector, who get the benefits and more disposable income. If this is not demand stimulus, I wonder what would be. Number 1. Number 2, I see this as a stimulus for formal job creation. One of the biggest problems in our economy has been formalization of jobs. People preferred contract workers, part-time workers, a lot of other workarounds because our laws were just draconian. So for the first time, this is going to simplify and catalyze formal job creation in India, which is probably the country's biggest bane. Third, it is a booster dose for ease of doing business. I think anybody who was worried about the number of returns and filings, I must tell you myself, SIS had to comply with 29 acts that resulted in 937 different challans and filings to be submitted on a monthly, quarterly, and annual basis to different government departments. That gets reduced to a single, one registration, one license, one online submission. This is transformational. And I think probably in time, people will realize the true impact of, this reform.
Well put. Thank you. Ms. Iyer, do come in on that. And if you could just quickly tell us what are also the impacted sectors, and particularly, this lack of clarity on how this 1 to 2% contribution as a percentage of your turnover will be implemented. Because say for platform companies, as our colleagues were telling us, there are multiple businesses. There's non-core revenues, ad, etc. So on what base do you apply this 1 to 2% contribution? On the overall turnover or on the gig platform? And go ahead.
Okay, maybe answer your question first. Now, this scheme is still to be formalized. What the law has done is they're enabling provisions that we will create a social security scheme for gig workers and platform workers. But the contours of the scheme, how it would be computed, all of that is still to come out. It is an estimate that 1 to 2% will be required to be contributed towards their reskilling, towards the social security scheme. But the details are still in the works. Okay. That's one. I was going to say the simplification which Rituraj brought out and the ease of doing business is going to be felt immediately, because where you're not going to have a single window for one registration, one license, and not having to do multiple registrations at state level for CLRA, etc. I think that's going to be ease of doing business immediately. And that's where I think we're all hoping that this is going to be a major reform for the company.
Okay. We do have a lot more questions, but completely out of time. But thank you so much, Ms. Iyer and Mr. Sinha, for joining us today, simplifying this for us. Of course, implementation is the next key, and how this code is actually executed is the next big talking point. Thank you so much for tuning in today. With that, it's a wrap on this edition of Trading Hour.
Key indices trade in the green, but the broader markets point to weakness as declines far outnumber advances. IT and financials gain, while industrials, utilities and realty drag.
India adopts a new labour code that rationalizes 29 labour laws, provides minimum wages, formalizes employment, extends social security and eases compliance. The code has significant implications for India Inc. across sectors.
And Royal Enfield is 125 years old company that will, with a startup mindset, says its CEO, who sees the bike maker outpacing industry growth, riding on the GST relief by exporting high CC bikes even as it preps its EV plan. The bike maker is also working on an alternative to importing magnets from China.
MCX CEO Praveena Rai says root cause analysis of the trading disruption has been done and a whole system has been tested for threshold across parameters. She expects to build MCX's capacity to process 10 billion orders per day.
Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Patra and with me is Manglam Malu as well as Vinny Motiwala. Well, it is turning out to be a day where we are seeing some amount of consolidation which is taking place for the markets at this point in time. So extremely quiet as we speak. But what really stands out in today's trading session is the rupee recovery that we've seen. So let's see whether that sustains or not. Remember that we did close at a lifetime low in Friday's trading session. So maybe there is some amount of recovery which is taking place. So 89.19 is currently where the rupee is at. Just want to point out that we also have the bank Nifty which is recovered, so up around 0.6%, currently managing to outperform as we speak. But overall, it is a quiet day, maybe a little bit of wait and watch at this point.
Hi guys, good afternoon. Absolutely a bit of a quiet day that's come in there, but let's also just look at the Nifty IT like you mentioned, right? Managing to hold on to very good gains, and in that when you look at it in terms of a move that is coming in from players, we have seen decent moves coming in from these big names as well. So whether you look at a TechM, whether you look at Infosys, Wipro, Persistent, all of them are managing to hold on to very good gain in today's trading session. So that'll be interesting to watch out for in terms of Nifty IT, which has been doing well in the last few trading sessions, where that is going to be headed. What's not doing well is the realty side. That's down 0.8%, and some pressure comes in there. Along with that, energy, Nifty Energy, that's also seeing some bit of a pressure. Advance decline ratio clearly today is a bit more in the favor of declines versus advances.
Afternoon, a lot of stocks which are declining versus the number of stocks which are advancing. The good part is that heavyweights are coming to the party today. So while the gain is narrow, it has been led by a few strong performances from the heavyweights. So pull up something like an HDFC Bank that is doing extremely well. We have some traction coming in from the Nifty Bank as well, mostly led by HDFC Bank, even as the frontline index is consolidating. The only couple of things that we'll be watching out for as we move forward is how the market moves ahead of November series expiry, and what kind of moves will the other stocks which are not doing too well today will put out as well. Case in point, something like a Reliance, which is down about 0.75%. But a lot of movers and shakers. Let's talk about all of them with Vivek. In fact, HAL is the one which is under pressure after Tejas light combat aircraft crashed during the Dubai Air Show. So we'll talk about that as well. Let's go across to Ria first and then we'll go to Vivek.
Well, yes, Manglam, as you said, HAL today is taking a hit in the markets, down around 3.5% after on Friday the LCA Mark 1A aircraft crashed during the Dubai Air Show. Now, the exact cause of the accident remains unknown, but investigations are underway presently. The engine manufacturer GE Aerospace has also issued a statement after the incident saying that they are offered to prepare their full support to the customer and to the investigation as well. Now, remember, this is the second LCA Mark 1A crash in the last 20 months, and the earlier incident had occurred in Rajasthan in March of last year. And on the back of this, Elara has also come out with a note. They have a positive stance on this. They are maintaining their buy rating, and they've said that they expect no material impact as a result of this crash. They've also said that fighter aircraft crashes are not uncommon, and in fact in the calendar year 25 alone, more than 7 such incidents have occurred across several different fighter jets manufactured by different companies. So this is not an isolated incident. In terms of the expected impact. They have said that they do not expect the news of the crash to impact the total 83 plus 97 unit orders for the LCA Tejas Mark 1A and its delivery schedule as well. They also do not expect the aircraft to be grounded, as this incident did not occur during a mission but in fact occurred during an air show. However, they have highlighted that this incident is the second Tejas crashing in the past 2 years, and this may delay exports for the company going ahead. They've also highlighted that they don't expect any major financial impact on the company in terms of the current order book, inflows and execution as well. Nonetheless, the stock is still down around 3.5% in trade today.
All right, Ria, thank you so much for that. That is HAL for you, as of now down 3% in trade. But Mangalam, we are also keeping an eye out on Swiggy and Eternal. Obviously, this is because of the new changes in the labor law, and they do see an impact coming in on this as well.
I do see an impact coming in, but it's a very near-term impact. In fact, if anything, it's a long-term positive, which is why the stock price impact has been fairly limited all through today's trading session. In fact, we've seen recovery for names like Swiggy as well from the lows, even for Eternal, which is slightly under the red line right now, but still is seen a fair amount of recovery. The government has said that gig workers and platform workers are now officially recognized under the Social Security for the first time, and platforms must contribute anywhere between 1 to 2% of their annual turnover, which is capped at 5% for gig worker payouts for Social Security. The benefits will be rolled out via state welfare boards and government schemes. Analysts say for Eternal and Swiggy, which already provide health insurance to riders, which amounts to about 0.7 to 1% of their GMV, if the mandate provides for 2% of sales, the incremental hit could be no more than 150 to 250 rupees in terms of their GMV. This could lead to an increase 1 to 2 rupees, at best 3 rupees per order, which will eventually be passed on to consumers over and above the 9 to 13 rupees that these companies charge as platform fees as well. But from a long-term standpoint, it ensures good upkeep of the riders, and at the same time good supply of riders as well, because now this comes as recognized under the Social Security. So, which is why the companies have said that they welcome the government proposals on gig worker safety. They've been awaiting the final notification before assessing materiality. So let's see how that pans out. But for now, the street has given its verdict. It is near-term disruption, no more than 2 to 3 rupees per order. But from a long-term standpoint, it is positive for the industry.
Okay, all right, Mangalam. Thanks very much for that. So maybe a little bit of near-term disruption. Next up is Infosys and the entire IT sector, which is buzzing on the back of a positive note by Motilal Oswal. Let's go across to Reema on this. Reema.
Thanks so much for that. So Motilal Oswal today has upgraded the Indian tech sector to an overweight, and there are three key reasons for that. One is the underperformance. This year, the Nifty IT index is down 12%, underperforming the broader market. But even over the last 3 years, the Nifty IT CAGR is meager 8%, much lower than the 13-16% CAGR return that the Nifty 50 or the Nifty 500 clocked in. Number two, global AI hyperscalers are experiencing diminishing marginal utility from infrastructure build-out, which typically signals that the shift, now the attention will move from spending their money on building infrastructure to actual services, application and maintenance, which is where the Indian IT companies come in. And thirdly, on valuations, Motilal Oswal says the profit pool of the IT stocks has remained constant for the last 4 years at 15%. But the weightage of IT stocks has been dropping, and now it's at a decadal low at 10%. So therefore, valuations are attractive, which is why they've raised the rating on Indian IT from an underweight to now a marginal overweight. And their preferred pick is Infosys. They believe this company, Infosys, will be the key beneficiary of the enterprise-wide AI spend, and current valuations of 21.7% make the risk-reward favorable.
All right, Reema, thanks a lot for that. Now, as promised, let's go across to Vivek. He's got the list of stocks that are buzzing and moving around in trade today. Vivek.
Well, good afternoon. It's a slightly muted session. In fact, markets cooling off the highs even as we speak. Advanced decline ratio slightly weakening, especially in the last hour of the session. Now, in terms of the individual stocks, individual sectors, you can't look past the IT pack. Reema highlighted quite a few pointers there. And look at the entire pack. Most of the names are Persistent, Coforge, Tech Mahindra, all of these stocks doing very well in the session. The other stock on the radar is Dilip Bilcon. Just a while ago, the company announced that it had received close to a 5,000 crore MD order. So it's spread out over multiple years. So that particular order, almost 5,000 crore from Nalco, that stock seeing a bit of a perk up, cooled off a little bit. ITI, this particular stock, the top gainer as far as the NSE 500 index is concerned, after a while seeing good volumes here. And Asahi India today, once again hitting a fresh 52-week high. On the other hand, quite a few laggards as well. Ria told us about some of the woes as far as HAL was concerned, and it has dragged down quite a few of the other stocks from the defense pack. So HAL, BL, Garden Reach, most of these names under a bit of pressure, down anywhere between 1.5% to 3.5%. Deepak Fertilizers, the top NSE 500 laggard in the session, good volume, seeing a bit of a sell-off today. Voltas, again, it's been a very volatile ride for Voltas, especially in the last month or so, but today has seen a bit of a sell-off, almost 2.5% lower. And CG Power, an order getting cancelled, a significant order for the company getting cancelled, and that is something that the street has taken note of, has cooled off from the day's highest point, in fact now down over 2.5%.
Okay, all right, Vivek, thanks very much for that. So we have a lot of stocks buzzing in today's trading session. We'll take a break now, but on the other side, we'll get you excerpts from our exclusive conversations with Royal Enfield management on growth, on their growth outlook, and much more. Stay tuned.
What has been your leadership language?
History has what you would call as lessons of history. You also have baggage of history. Therefore, being able to decipher between lessons and baggage is a very important part of leadership.
The name, Kotak Mahindra, I mean, that was your decision, right?
When I read books when I was growing up, it was about some of the leading financial institutions in the world. And the names were Goldman Sachs, JP Morgan, Merrill Lynch, Morgan Stanley, all of whom were family names started by founders and who said we must put our name onto the company's name to give a confidence of trust for all the customers and investors.
What's the perspective that you have on where banks should start to disrupt themselves?
First, I think banks should not think about themselves as banks. They should think about themselves to be in the business of serving customers. The mindset is, oh, we are a bank, and therefore we have the right to be lazy. We have a right to have the moat. I think that is the most dangerous thing because the pool of savings in banking is under threat. The banker of today and the future needs 3 human qualities: prudence, simplicity, and humility. We were never scared about being a small player in a large market. We were ready to take on the big guys, even when we were small. In the 90s, I was one of the 3 junior Ks. The 2 senior Ks were Kothari and Company. And I was this little two-wheeler trying to make his presence in the giant truck market.
But now you're the truck. You're no longer the two-wheelers.
I'm a great believer in this 4-quadrant theory: Ram quadrant, Krishna quadrant, Duryodhan quadrant, and Ravan quadrant.
If you were to start up again today, would you do it?
I would be a digital evangelist, specializing in the domain of finance with deep understanding of risk. First, we have seen a world which was only physical, which then has transformed to phygital. We are now in the world of what I call as digital, and the 4th stage is only digital.
But do you believe that we will move to stage 4, that we'll only be digital, we won't have bank branches?
Let me give you the example of the largest market cap company in Brazil. It is a digital-only bank called Nubank, valued at $80 billion.
We were talking about how 40 is the new 20 and 60 is the new 40. What's keeping you going today?
I am a great believer that the best way of looking at the future is never have FOMO.
So no FOMO about anything.
FOMO.
No FOMO about anything. Is there an Uday Kotak memo that's gone to Jay and Dhaval?
No, I think most of the memos are what they learn on the dining table.
Welcome back to Halftime Report on CNBC-TV18. As of now, when you look at the Nifty, 26,076, slight bit of that green there, but not much of a positive up move that we're seeing. Slight bit of a recovery from the day's point. Let's keep it going then. And as Royal Enfield is celebrating its 125 years, the company CEO takes a ride with CNBC-TV18's Parikshit Luthra on the streets of Goa to take us through the experience of their motorcycle. Take a look and listen to that excerpt of the interview after this.
We'll just go for a spin and then we'll come back and start talking about it.
I think great idea. I'll choose the cruiser. Let's get ready. Let's put our jackets on. We'll take a quick spin and come back.
Come.
All right, let's
Can't
start.
stop. I think during this time, festive season, even government intervention on the GST reduction also has helped because less than 350cc, the rate reduction has really helped. That's a good move by the government and we welcomed it. At the 350cc level, all our products, in fact, we came out with a variant in Hunter and in the Guerrilla 450. And Meteor, we launched the series of products, new color variants. And we also kickstarted our classic campaign. So during this window, that's about 33 days festive window, if I have to tell you, we grew by almost 50% compared to last year festive window of 33 days. And in the quarter, we grew by almost about 41%, primarily because of both ways. There is GST reduction and also a festive thing and our interventions in this. Yeah, it's been a wonderful quarter for us as an organization. And it is continuing. The inquiries are continuing. And the demand is continuing. It's a good sign. In fact, so that now our production have to ramp up and capacity has to come up. That's the deep discussions which are going on now.
Right. To give us a sense of what's the capacity at which you're working right now, what you were working with in the quarter gone by, and what's the ramp-up plan?
So we have 3 manufacturing plants at Chennai now, and one at Oragadam, one at Vallam, and one at Cheyyar. The Cheyyar plant is primarily catering to both the plants, Oragadam and Vallam, as a support plant. These are the world-class manufacturing facilities which we have set up. In these 2 plants, the combined capacity is almost about 1.2 million per annum, is not what we started off. With interventions, automations, and all those things, we racked it up to almost about 1.34. But we have gone ahead with modules because ours are modules, so we crack the code of how do we make modules and enhance the capacity rather than putting heavy capex into this. And we will be working on building it almost about 1.5 million capacity, which is good for our near growth.
By when?
It'll kick on from coming year, first quarter onwards.
You've said in your earnings call that you are engaging, Royal Enfield is engaging with authorities on how to ensure the same GST slab of 18% is on all motorcycles, and there is no difference between 350cc and 350cc and above. So far, there is no change from the side of the government. How is that impacting business? How has the sales for motorcycles above 350cc been impacted?
So, on a Royal Enfield whole on the composition in the domestic market and international market, let us talk about it. In the domestic market, our above 350cc has been almost about 10-12%. So that's the volume which actually got impacted because of this. If I have to tell you impacted, maybe this quarter is not so, fundamentally because when there is a rate change, there is a pre-buy which was taking place. In fact, we sold more motorcycles than the earlier time because of the pre-buy. But yes, there is a bit of inquiry reduction in the 450cc and 650cc which is taking place. But for us at Royal Enfield, because we are present in almost about 65 plus countries outside India, and most of the product is 450cc and 650cc, that's what we export. So we do have some volume. And in which way, as I was saying, that we will represent to the government authorities for a uniform GST of 18%, is that India has a scale. And if in case we get scale more in the 450cc and 650cc in India, and we can take the accessible motorcycles
to outside India, because by far Indian automotive, especially two-wheelers, have been recognized as the best motorcycle providers across the globe. And it's a clean Make in India story. And if government helps us to reduce and bring out 18% as up to 750cc motorcycles, it will really help for the Indian consumer to enjoy the higher cc motorcycles also. Thereby, the manufacturers get a scale and the cost is brought it down and take it to international market at a very accessible price point, wherein we will get quite a good numbers and make more motorcycling culture outside India also will come into this.
But if this GST slab does not change, because currently anything above 350 is being treated as a luxury by the government, would it put some dampener or some long-term changes in how you plan your portfolio ahead? Has some product planning been put on hold as a result of these GST
Royal
changes?
Enfield, no, we haven't put anything on hold. As I mentioned, we are a long-term ambitious company. We don't look at anything short-term, and we have charted our own plan for next 5 years, what are all the pipelines. If I have to tell you, yeah, maybe because of the GST, are we taking time to reflect? Is there something which we have to do for the domestic market? Of course, yes. But we won't do any knee-jerk reaction.
Okay, well, that was the rare and exclusive chat with the Enfield CEO, but stay tuned for more excerpts of that interesting conversation all day today on CNBC-TV18. All right, time for a quick break, but up next, we'll get you all the F&O action this afternoon. Stay tuned.
Welcome back. You're watching us here on Halftime Report. I'm joining you from the F&O desk at the time when the markets actually erased all of its gains to the frontline index as well. So the Nifty is currently moved just into the red, and this despite strong performance coming in from both the IT index as well as the Nifty Bank. The broader markets have been under pressure all through today's trading session. So you look at the Nifty Bank, rather the Nifty Small Cap Index and the Mid Cap Index, both of them are at the low point of trade as well. What's also at its widest distance is the advanced decline ratio. We have 50 stocks, around 2,044 stocks in the red for about 833 stocks which are in the green right now. The index, the last few minutes, what have been the key draggers for the frontline index? We have Reliance, which has moved lower, ITC, a fair weight on the index, also lower, and the metals pack not doing particularly well. So as a result of which, the Nifty has moved into the red despite good support coming in from the banks and the IT stocks. What this means is that ahead of expiry tomorrow, we've seen a lot of call writers active, and that's reflected in the put-call ratio, which has moved from levels of 1.4 sometime last week now to around 0.9, and the call writing is fairly visible at around 26,100, 26,150 and 26,200 as well. So 26,100 call comes up for you. Premium of 64 telling you as we move towards 26,200, 26,150 thereabouts, there could be some supply coming in. 26,200 call writers as well, equally active. The premium an hour ago on this one was around 40, 45 rupees, now come down to 28 rupees. So those call writers too making a fair amount of money, telling you that upwards of 26,200 there would be some supply. But it will be very interesting to see where the put writers of 26,100 go. An hour ago, the premium on this one was close to 60 rupees. Now it's 80 rupees. So those who've written that put are believing that maybe, the support for the market is moving lower around that 26,000 mark. So let's see how that pans out. And secondly, at some point, if these put writers had to unwind their positions, then all the way down to 25,950 is something we could look at as a support. So ahead of expiry tomorrow, if you had to look at a broad range on the frontline index, 25,950 to about 26,250 is what the option writers are playing for.
Okay, all right, Manglam. Thanks very much for that. So that's what's taking place on the F&O space. Just want to point out that a couple of stocks are seeing some amount of traction now. So, for example, Poly Medicure is seeing a good amount of traction in today's trading session, both on the volume as well as the pricing front. So that stock is up around 6.5% at this point in time. So do watch out for that. Well, from the Nifty space, IT continues to gain. So we have TechM, which is up around 2.8%. Eicher Motors, we just heard the management. That stock is up around 1.7%. In fact, autos has been doing well last week, and the follow-on buying has continued into this week. So that stands out. We have Bajaj Auto, which is up around 1.3% as well. The IT outperformance also continues from last week into today at least. We'll take a short break, but on the other side, we'll get to a conversation that our colleague Manisha Gupta had with MCX. Stay tuned.
Welcome back to Halftime Report on CNBC TV18. Now, let's get you an important voice from the commodities market. Praveena Rai, MD at MCX, tells my colleague Manisha Gupta that their goalpost is to reach 10 billion orders a day. Adds that the company has taken several measures in response to the recent trading glitches. Listening.
We are growing at about 40% on the operating revenue side and 50% odd on the EBITDA side. This is a result, of course, of first and foremost the headline numbers we spoke about. But behind that is also all the enabling factors, right? The strong technology, the strong compliance framework, and certainly I would say the factors around the macro trends, right, that really drive the fit for purpose across all segments. So the energy segment is a strong one, continues to do well. The bullion segment, which has been a strong segment, has really performed above par. And the metal segment, has also, we are looking at sort of doubling in some of the metals there. And agree, while it's a much smaller space, also does its own role being fit for purpose there.
Electricity futures is another introduction that you've done in this year. We do understand that it is a long gestation product. How much of a readiness do you see in the markets for that, whether it is from the retail or the company part of it itself?
So electricity is something that we absolutely need in India. If we look at global markets, be it US, Europe, Asian markets like Japan, it's one of the new emerging commodity sectors across all markets. This product has been designed taking into consideration the requirements we have in India. The renewable sector is growing. In fact, I think we are really beyond plan when we look at the policy numbers on where we need to be for the renewable sector. So all of this comes together to say that this product, is a requirement for the purpose of hedging across producers, consumers, and the entire value chain there. So we are seeing strong interest. The momentum is right. It will take some time because it's about, financial players understanding electricity and electricity ecosystem, looking at hedging. A lot of internal corporate and governance enablement activities are also in play. We are looking at an average ADT nowadays of about 40-50 crores.
Okay.
And I think within 3 months of launch, these are good numbers. So I think we are positive that the product is designed for market. It's simple, easy, works on what we call the day ahead market prices. With a lot of data, back data, coming from a very established spot exchange reference. And all of this makes it good in terms of how it will play out in the long run.
But it isn't gold and silver and copper. I mean, it's slightly a difficult product in that sense and a market too. How long do you think and how much time are you giving yourself or your team to ensure that it reaches a point or a target that you would have envisioned?
It is very different from the other segments because they are tightly correlated globally, right? They are related and correlated, primarily because we also tend to be an importer in many of those segments. Electricity is ours, we produce it, we consume it, right? So it's really about India as a market and how that gets created. So it will take a little bit more time than what the other sort of segments have taken. But it's something that we need as a country. And I think we are positive about it. So we'll see these numbers certainly look much better by the end of the year. And I would say that within 2 to 3 years, we should see it starting to make its presence felt in the portfolio.
Talk to us now about a difficult subject that you had to go through in the month of October, 28th October. And while you did continue to send out communications on what was really happening around that, but take us through on what really conspired and how have your communications with the regulator been on this right now?
Needless to say, it's not something that we want to happen again. So there are some very strong measures we've taken, in addition to all the work that we do on technology. So if I just run you through them. So first and foremost was the root cause analysis that got done immediately. I think by within a day or two, we knew what it was and we communicated that as well. In addition to that, we've also gone to market and we've brought in a third-party assessment of the root cause so that in case there's something getting missed internally, it gets picked up. So that is also completed and it has corroborated the root cause that was identified earlier.
Okay.
The next step is to say, hey, this is looking at the root cause, but why don't we actually put the whole system through a testing so that with real volumes, we are able to identify any other such threshold parameters. So that's something that is currently in process, will get completed very soon. The third is to look at a sort of expert panel along with third-party assessors to have a fresh look at where we stand from a scalability and resilience standpoint. So yes, the platform has been continuously upgraded to come to where it is today, but we have to make sure that it's fit for purpose as we look at scale going forward. And I will say, as we continue to invest in technology, the most important thing is the voice of the customer. And in our interactions, and we've had a number of interactions with our stakeholders. Most important stakeholders are our members and participants. So what I heard is, you have to be ready for 10x, right? And I think that was really a rallying cry.
A ringing thing, huh?
Yeah, and I said, and I think all of us agreed within MCX that I think that really is our goalpost now. So I think we are going for 10x. And we sort of ballpark numbers looking at something like maybe 10 billion orders a day. So that's what we're getting prepared for now.
Yes, as you said, your conversations with the industry, the stakeholders, the intermediaries has been on the positive side. But having said that, there were always also various statements saying, or, memes and WhatsApp messages suggesting, oh, the exchange isn't working. Maybe you can go to another exchange. MCX is perhaps 98 to 99% of what it does in this market share. Dealing with that day wouldn't have been easier. What have your also been engagements with this year? That's another thing that the markets are very, very curious about.
Yeah, so I think first and foremost, engaging with our participants, right? And we spoke about that. I think that was super important, and we've given that top priority.
And they've stuck with you all these years.
Yeah, I mean, they have stuck with us, and I think we are very happy and privileged to be part of that, ecosystem. Now, as far as the regulator is concerned, there are some processes, there are methods and timelines within which certain submissions have to be made and so on and so forth. So all of that will following process, and will sort of, play out in due course.
What has been the engagement till time? What is it that is going back and forth with the regulator on that?
I think those are part of the standard, SOP discussions. And I think pretty much in line with whatever I have explained till now.
You also earlier spoken about the 5-point mitigation plan. What are the key actions therein? What is it that you're looking at in sense of a capacity building? You talked about 10x there. What work is being done there? What are the other timelines that you have in place?
Yeah, I think this is the 5 points that I mentioned some time back. And when we look at timelines and we say, look, we want to target to 10x, 10x may not be like a single short jump, right? So probably it's going to have 2 or 3 milestones. If I look at very headline numbers, and we've sort of quadrupled in the last 2 years. So if we say, hey, if I look at that as a potential run rate, and there could be best case, there can be like a better case, and so on and so forth. Looking at all of this, I would say we should look at a first benchmark in about 12 to 18 months. As a milestone, and in 2 to 3 years, really be at the kind of levels we're talking about now.
Welcome back. Well, on to a CNBC TV18 exclusive. While speaking at the M&M Town Hall, Tech Mahindra's Mohit Joshi spoke on their margin aspiration and target for FY30. Listen in to a slice of that conversation.
We spoke about a plan for margins and productivity. And when we made that plan for 15%, when we said we'd do 15, we were at 7.5 in terms of exit. We have now had 6 quarters of expansion from a margin perspective. Gartner has rated us as a leader for AI and Gen AI, but in terms of the future vision for AI, we're number 1 globally, right? Ahead of all of our Indian peers, our American peers, our European peers. So I do feel that we've made good progress over...
when you say you're number 1 globally, what do you
Yes.
mean exactly?
So they have 2 axes to measure performance, right? One of the axes is, one is current functionality, where we're in the leaders quadrant. But the second quadrant is future vision for AI. What can AI accomplish for enterprise clients? And there we're number 1 globally. Very confident, and we're completely committed to our F27 goals. And then beyond that, we'll sketch out vision for, for the next 3 years.
Yeah, so give us a glimpse of what the vision for the next 3 years could potentially look like.
I left my crystal ball at home, unfortunately.
You don't need a crystal ball. I'm sure you've got a vision board that sets out those numbers for you. But Mohit,
I'm not going to. So look, I think the thing is, right, that I don't want to start manifesting my FY30 vision over here. But I do feel that, look, the first part of the journey has been about becoming world-class, right? Really a catch-up with the peers in terms of growth, in terms of margins, in terms of deep capability, while building on the strengths of the company. FY30 is going to be about becoming world-beating, right? How do we figure out what are the things that we do exceptionally well, and how does that start to show up in our financial results?
Welcome back to Halftime Report on CNBC TV18. Nifty, from where we started the show, has seen some bit of a recovery, or actually back to where we started the show with. But 26,070 levels is what the Nifty is managing to hold on to, flip-flopping between the red and the green. So we'll keep an eye out on that one. And Nifty IT continues to be the top sectoral gainer, broader end of the market. That's not doing well, and that is why that advance decline ratio clearly in the favor of declines versus advances. Nifty Bank also managing to hold on to gains. But yes, that's the market setup that we're looking out for right now. 26,070 is what the Nifty is holding on to. You have Business Lunch up next to take you through all the market action, so don't go anywhere.
Key indices trade in the green, but the broader markets points to weakness as declines outnumber the advances. IT and financials gain while industrials, utility and realty stocks drag. India adopts a new labour code that rationalizes 29 labour laws, provides minimum wages, formalizes employment, extends social security and eases compliance. The code has significant implications for India Inc. across sectors. Royal Enfield is a 125-year-old company with a startup mindset, says its CEO, who sees the bike maker outpacing industry growth, riding on the GST relief and by exporting high-cc bikes, even as it preps its EV plan. The bike maker is also working on an alternative to importing magnets from China. MCX CEO Praveena Rai says that a root cause analysis of the trading disruption has been done and the whole system has been tested for thresholds across parameters. She expects to build MCX's capacity to process 10 billion orders a day. And second quarter GDP numbers that are due on Friday may be as eye-popping. A CNBC-TV18 poll sees Q2 GDP growth at 7.4% compared to 7.8% in the first quarter. Economists have now raised their full-year GDP growth forecast to above 7%. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormas Patakia. It's a quiet day of trade, if you could call it that. It's very range-bound on the index currently. It's just a 100-point range in which the Nifty has been trading all through the day. 26,046 being the intraday low, 26,142 being the intraday high. Keeping the Nifty in the green are IT names, be it Infosys, Tech Mahindra, and some big financials such as HDFC Bank and Axis Bank. Putting pressure on the index though are Reliance Industries, Mahindra and Mahindra, ITC. But the real picture though is in the broader markets, and the advanced decline ratio has been skewed towards the declines for last few sessions now, and today's picture is no different. The mid-cap index is at the lowest point of the day. The advanced decline ratio line is only widening. It's becoming a wider yawn now compared to what it was at the start of the trading session. So we'll have 2,000 stocks in the red compared to just over 850 stocks that are in the green. Leading the losses on the broader markets are the defense names, Garden Reach, be it Zen Technologies. Most of them are trading with losses of anywhere between 2 to 3%. But the big story packed with Vinny, who is joining in with a complete breakdown of the new labor laws. Vinny.
Hi, afternoon, Urma. So obviously, let's just talk about what this is first. Like, there were 4 labor laws which are going to be merged into 4 codes, and this is going to be from November 21st, 2025. This is a statutory right to minimum wage for all workers that will come into play. There's going to be with a national floor wage that will be set by the central government as well. The basic pay also must be at least 50% of the total salary, which is much lower right now. So that 50% number for basic salary obviously comes into play, and gig and platform workers are included under Social Security. So this is a big change that comes in for all these gig workers. Now, key benefits that one should talk about, what it comes in for these workers, gig workers or employees as such. One, fixed term employees and contract workers now will receive benefit comparable that to permanent employees. So that is including leave, medical cover, social security, PF, all that gets included even for the normal contract workers as well. Now, obviously, reduces eligibility in terms of the 5-year gratuity that was there. So that is also going to be reduced now to 1 year. That's a big change there. Timely payments of wages will be mandated. Overtime wages will be paid double of the normal rate that is there as well. Appointment letters will now become mandatory. So what do all these changes actually do is, one, obviously this will formalize, digitize and simplify and improve the productivity as well. Now, from the employer point of view also, these all changes will benefit because it becomes more formalized, simplified laws that come in. Codes are expected to increase wages and improve that social security, and fixed term employment option also provides them flexibility in terms of hiring without long-term permanent commitments that come in, but there is still a fixed term employment option that comes in. So obviously this will benefit staffing companies as such, whether you look at TeamLease, Quest Corp, because more formalization comes in. When you look at it, staffing industry currently has around 65 lakh workers under their purview, right, who come through them. While gig workers as such are just 1 crore and above that in terms of the number that comes in of gig workers. So that is the addressable market share which increases for them. TeamLease, Quest Corp, all of these are something that are in focus. On the flip side, obviously Zomato and Swiggy do face some near-term challenges because they're dependent on these gig workers. But otherwise, this is the focus that comes in, and a change that everyone in the industry was watching out for is at least what the highlight is coming in.
Indeed, some big major reforms with regards to the labour laws. Vinny, thank you for that update. Now, we also spoke to industry experts on what this means for the various sectors and the economy at large. Listen in.
I think these are game changer reforms, long time coming, and at the point where India is at a cusp of, wanting to take off leverage from the disrupted supply chains globally. I think we just needed this. We will see some pain around gratuity because gratuity will have a retrospective cost as is currently worded in the law in respect of employees who've been in the system for whom provisions have been made in the P&L. So we will see an impact on gratuity provisions that will have to be rewritten.
Now, as Royal Enfield celebrates 125 years, the company CEO takes a ride with CNBC TV18's Parikshit Luthra on the streets of Goa to take us through the experience of their motorcycles. Now, in an exclusive interaction, Royal Enfield CEO said that they will continue to focus on middleweight motorcycles and also take us through the journey over the years.
The higher CC motorcycles, the era is slightly going off. I don't think people are really enjoying. If given a chance, even I won't enjoy that sort of a bigger motorcycles. And I want a motorcycle which has to be interacting with me. And I control the motorcycle and I enjoy the motorcycle. And that's why we said middleweight, Rashid, is what we will focus as a company. And the middleweight, our definition is 250cc to 750cc motorcycle. And currently we have 350cc, 450cc, 650cc platform. And I do believe strongly that even this market can grow because premiumization in India is the thing. And we are by far the motorcycles which is very accessible price point which we have brought in and gorgeous looking motorcycles and everybody is loving. And I do see there is a good growth even in this platform which we can bring in for future. This is our first product which is a C6 and for the City Plus applications. But when you say City Plus, I mean there is also a possibility for us to do a bit of off-roading and some exploration which is possible. Maybe this caters to one kind of a consumers which we like it. Then we thought that, okay, in that platform, what is that we can do is the S6, which is the scrambler version, and which has a bit more ground clearance. You can see it here. We're just thinking about the strategy of go-to-market. Currently, the thought process which is coming up is probably in India first and followed by Europe. DNA of Royal Enfield, we always look at pricing as it has to be most accessible and create a market. So we will be at the most accessible price point for the consumers to see. That's a value for money that I can't deny like that.
That was the rare and exclusive chat with the Royal Enfield CEO. But you can stay tuned for more excerpts of this very interesting chat all day long today, only on CNBC TV18. And as we take a short break, here's a quick reminder for our viewers. HSBC presents Future Female Forward Season 3, co-presented by Cognizant from New Delhi. We bring to you the newest state chapter edition with powerful perspectives, action-focused ideas, and a collective vision for accelerated equity. Tune in on the 25th of November, Tuesday, 5:30 p.m. onwards for an insightful conversations only on CNBC TV18 and CNBC-TV18.com. Welcome back. Now, the second quarter GDP numbers may be almost as eye-popping as the first quarter. A CNBC-TV18 poll sees the second quarter GDP growth figure at 7.4% compared to 7.8% in the first quarter. And therefore, most economists have raised their full-year GDP growth forecasts above 7%. Lata is here with more on this. Lata.
Yes, actually, 7.4% is what our poll says we will get to hear on Friday when the July-September numbers are announced. One reason why it's good is look at the year-ago number, 5.6%. That was a terrible second quarter we had. So it's perhaps easy to look good because of that. And it's a tad lower than the 7.8%, which was a genuinely eye-popping number which we got for Q1. However, this is real GDP is what we are talking about. That is, we are taking away the price effect. We're only looking at the rise in goods and services. If you add the price effect, what you call nominal GDP, that's growing at only 8% versus 8.3 year ago and versus 8.8 in Q1 and versus a union budget assumption of 10.8%. So clearly there are going to be problems because of that. The growth at the moment, let us look at the good news. The real GDP growing by 7.4 is going to be helped by all sectors. That is agri, manufacturing and services. Agriculture is seen growing at 3.5, which is very good for agriculture. You know, there are limits. You can't expect it to grow at 8%. Manufacturing, very good, expected to grow at 8.9%, partly because of the front loading of exports and a very good capex spend by the government. Both those helped manufacturing, and services also doing very well at 8.1. Largely finance, real estate, trade, all of them did well. The poll for Q3 and Q4 are also in, but they're preliminary numbers. Q3 is expected to grow, that is the current quarter, at 6.7% and Q4 at 6.3%. For one thing, they also have a high base, especially Q4. But most of the economists said these are subject to change after we look at the Q2 numbers. Overall, if you average it out, the full year number comes now at 7.02, which is very good because if you remember the CEA, when he presented the economic survey before the budget, he said he expected 6.3 to 6.8. The most optimistic number was 6.8, but now economists are saying it can be above 7%. Again, nominal GDP is the worry. It is going to grow by 8% according to our poll. You know, nominal GDP is important because that is what gets counted in the budget. That is what gets counted in earnings forecasts of companies. You don't take out the price effect. You just take the profit. Now that, if it is overall is growing only at 8%, you have a problem. There could be an earnings growth problem if nominal GDP is that low.
We'll have to keep an eye out on the nominal GDP number, more so on Friday as well for that second quarter GDP data. Lata, thank you for that explanation. Moving on, and a major boost to India's defense capabilities, the Indian Navy has commissioned INS Mahi, the first of the 8 Mahi-class anti-submarine warfare shallow watercraft. Army Chief General Upendra Dwivedi was the chief guest at the commissioning of the INS Mahi, which was delivered to the Indian Navy on the 23rd of October. With over 80% indigenous content, INS Mahi showcases India's growing mastery in warship construction and integration. Once fully inducted, the Mahi class will replace the Navy's older Abhay class corvettes. Meanwhile, Justice Suryakant was sworn in as India's 53rd Chief Justice on Monday. President Draupadi Murmu administered the oath of office and secrecy to Justice Suryakant, who will remain in office at least until February 2027. He is succeeding Justice B.R. Gavai, India's first Buddhist Chief Justice, who was in office only for 6 months. Prime Minister Narendra Modi met Canadian Prime Minister Mark Carney on the sidelines of the G20 Leaders Summit in South Africa. Following the bilateral meeting, both the leaders agreed to formally launch negotiations for an ambitious, comprehensive economic partnership agreement. The leaders expressed confidence that the agreement will serve as a powerful economic anchor and help more than double two-way trade to $70 billion by 2030. Prime Minister Carney has also accepted Prime Minister Modi's invitation to visit India in early 2026. We'll take a short break. Back with more news and updates on the other side. Stay tuned. Welcome back. Now, the United States and Ukraine have announced an updated framework for peace with Russia. The next report has more on this.
The United States and Ukraine announced an updated peace framework to end the war with Russia, revising an earlier Trump-era plan criticized as being too favorable to Moscow. After talks in Geneva, US and Ukrainian delegations called discussions highly productive and said they would be continued in the coming days. The White House said the revised plan includes stronger security assurances and reflects Ukraine's national interests. Ukrainian officials offered no separate comment and were not immediately available.
We had a very good day today. I think we made a tremendous amount of progress.
US Secretary of State Marco Rubio said on Sunday that significant progress was made on a plan to end the war in Ukraine, but no agreement was reached on how to guarantee Kyiv's security amid concerns about the threat posed by Russia.
Clearly, I think we all recognize that part of getting a final end to this war will require for Ukraine to feel as if it is safe and it is never going to be invaded or attacked again.
Ukrainian, US and European officials met in Geneva on Sunday to discuss a draft US plan to end the war, after Kyiv and its allies voiced alarm over what they saw as major concessions to Russia. The 28-point plan includes calls for Ukraine to cede some territory, accept limits on its military, and renounce ambitions to join NATO. For many Ukrainians, such terms would amount to capitulation after nearly 4 years of fighting in Europe's deadliest conflict since World War II. European officials, who said they had not been consulted on the plan, on Sunday offered a modified version that pushed back on some of those proposed limits on Kyiv's armed forces and territorial concessions. US President Donald Trump had given Ukrainian President Volodymyr Zelensky until this Thursday to approve the plan, but on Saturday said the proposal was not his final offer. On Sunday, Trump posted that Ukraine had, quote, zero gratitude for America's efforts to end the war. Soon after, Andriy Yermak, head of the Ukrainian delegation, thanked Trump for his commitment to Kyiv.
We thank our big friends, United States and personal President Trump and his team to their commitment to bring this peace.
Minutes later, Zelensky also thanked Trump in a social media post. Two sources told Reuters that US and Ukrainian officials were discussing the possibility of Zelensky traveling to the US, maybe as early as this week, to discuss the US peace plan with Trump.
Meanwhile, in the US, the Department of Government Efficiency has been disbanded with 8 months left to its mandate. Now, this marks the end of an initiative launched with fanfare as a symbol of Trump's pledge to slash the government's size. The Office of Personnel Management said that the DOGE is no longer a centralized entity. In fact, a lot of DOGE's responsibilities have already been taken over by the Office of Personnel Management. Australia and Turkey have finalized a deal to share responsibilities for hosting the next year's UN Climate Summit, resolving a long-running standoff over the event. CNBC's Dan Murphy with more details.
Meantime, Turkey and Australia have finally reached a deal on who will next host COP31, which comes up next year. After a long standoff, both sides agreed that Turkey will host the summit in 2026, while Australia will lead the negotiations. Australia's Prime Minister Anthony Albanese says his country will have exclusive authority over the talks, and a special pre-COP meeting will be held in the Pacific to highlight climate threats facing the island nations. The annual COP summit remains the world's key platform for global climate action. Turkey's President Erdogan called the deal with Australia a meaningful victory for multilateralism.
We plan to hold the 31st conference of the parties to the United Nations Framework Convention on Climate Change in Turkey in November next year. Taking into consideration that multilateralism has lost ground in recent times, I find this agreement that we reached with Australia to be much more meaningful.
With that, we take a leave on this edition of Business Lunch. From me and the team, thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. And we started off in the green. We are still in the green, but considerably off the highs of the day, almost a 60-point cut from there. Mid-caps are lagging, and that index did not do so well last week as well. So that is a trend that continues. But there's so much to talk about, a lot of trends that's taking shape in the industry and overall for the markets as well, Vivek.
That's right. It's a subdued start for the markets, this particular week. Remember, today is an important day given the fact that especially in the last hour, we will see some flows coming in from the MSCI index rejig as well. But a lot line up on the show, so let's start off with the top headlines. Key indices trade in the green, but the broader market points to weakness as declines outnumber advances. IT and PSU banks gain, while metal and FMCG drag. Mid-caps in line.
India adopts as a new labour code that rationalizes 25 labour laws, provides minimum wages, formalizes employment, extends social security and eases compliance. The code has significant implications for India Inc. across sectors. Companies like SIS, Teamly, Swiggy and Zomato are under focus on the back of that.
The rally in IT stocks continues as Motilal Oswal upgrades the sector to an overweight rating, expecting stocks to benefit following sustained underperformance and a shift from AI infra to application and service layers.
HAL trades under pressure after its light combat aircraft Tejas crashed at the Dubai Air Show on Friday, making it the second Tejas crash in the last 20 months. But the company assures there is no impact on business operation or financials. The stock is lower by 3%. All right, those are the top headlines that we are tracking for you today. The Nifty, which is up around 11 odd points, but sharply off the highs of the day. We have the mid-caps, which are trading lower. So that should be the focus point because the advanced decline ratio is comfortably in favor of the declines. That index was down 1% in the week gone by and continues its down move as well. The small cap index, that should come up for you on the screen because that is the other one which is indicating what the broader markets are doing right now. So that index too is lower in trade. It is at the day's low as we speak, a sharp fall from the highs of the day. But the big story today has to be the change in new labour codes. The government's new labour codes, effective November 21, 2025, bring gig and platform workers under formal social security for the first time. Anuj Puri, Chairman, Anurag Property Consultants, is joining us now to discuss more on this, to understand what the impact on the real estate sector be overall. We also have Ghulam Zia, who's joining in from Knight Frank India. He's the Senior Executive Director. Ghulam and Anuj, good afternoon. Thank you so much for joining in today. While we talk about the labour codes, one of the most labour-intensive sectors has to be the real estate and the construction space, right? Ghulam, let me start with you. How big is labour cost as a percentage of the overall construction costs or real estate costs? What could the impact be of this particular change?
First of all, let me put across a very clear understanding that in real estate, land value is the biggest cost, especially in cities like Mumbai. You may have more than 50% of your product cost going through the land value. And labor, in that case, is much lesser in proportion to maybe in, say, Pune or Chennai, etc. So labor cost actually varies from city to city in your overall cost. But that said, the impact typically is from 15 to 30%. Like in a city like Mumbai, I would expect the labor cost to be to the tune of 15-18 odd %. Going to another city like Hyderabad, Chennai, etc., this will change, go more towards 25 to 30%. That is how it is. And this the new labor codes we're talking about will definitely have an impact much lesser in Mumbai compared to the other part of the country.
Okay. Mr. Anuj, welcome and thank you so much for joining us. Well, the other part, is just a bit of a clarification. Now, a whole host of real estate companies also go ahead and appoint third-party contractors. In that case, do third-party contractors have a clause in the contract saying that any unforeseen cost escalations like the one that we're seeing currently will be passed on? Who will take the hit in that case? And if you could also give us a sense of the quantum of the impact that the companies will see.
Good afternoon, Vivek and Sonal. Always nice to be on your show. So, just like what Ghulam said, is that if you were to take out the cost of land, then the overall labor cost impact on real estate in India is about 20 to 25%. In some cases, in smaller cities, maybe 20%, bigger cities, about 25% of the total construction cost. So with the new labor laws, this baseline labor cost we believe is expected to go up by 10 to 15%, which will translate, maybe 3 to 4% increase in the total development cost. And, there's sort of a breakup of how this is going to happen. Much of it is in the basic construction labor, but it is also in the labor overheads. We've seen the changes that are being made in the gratuity, in the provident fund, in the wage revision, and the rest of it is really indirect labor cost, maybe 1 or 2%, which is on safety, amenities, health, etc. So overall, we believe is that the cost that is going to have an impact is about 20-25%, leading to maybe 3-4% on the cost of construction and increase. Majority of the vendors will have an agreement signed with the developers that if there are any government charges which increase or due to any change in the law, then the developer needs to pay for this. So the vendors will not take this into account in their own balance sheet. They would necessarily have the clause to pass it on to the developer. And the developers would, for their unsold inventory, pass this on to the buyer. Clearly, we've seen the balance sheets of the developers. They don't have ability to be able to absorb the additional cost of construction given the profit margins where they are at this moment in time. So ultimately, this increase in the cost will get passed on, 3 to 4% to the home buyer.
So this cost could be passed on to the buyers. That's very important from a buyer perspective, because while the hit is coming on the balance sheet of a real estate developer, ultimately it's the buyer who could be impacted, considering that it'll be passed on. Ghulam, if you can give us a sense of if there are any labor shortages that the industry is currently seeing, and if this particular change could resolve the industry of that problem, because this was an indication that was suggested by some of the real estate companies as well, that labor has become a big issue. Is that true, first up? And if that is true, do you think these laws, if implemented properly, could get rid of this issue?
For sure. Labor, the shortage of labor is a big problem for the industry for last, at least, in fact, post-COVID, we've seen this actually worsening. Many of the players that have actually going towards automation, using AIs, etc., trying to find ways to manage it, but it only means additional cost. But the old ways of getting skilled and unskilled laborers whenever you need it is a big problem. That story is bygone. So today, when we are talking about this big change, at least in the interim, as Anuj was talking about, with an additional impact on cost, etc., and of course, it will require so much of compliance. So we are going to be actually going through a transit phase during which the shortage will be felt much more, because when the developers would be putting their records in order, trying to be fully compliant, there will be a period of at least a year, if not more, during which this, the new ways of doing business will also have a huge impact. So not just labor shortage, but becoming full compliant also will take time. So in times to come, at least a year and a half, we shall see a huge amount of concern coming from developers, especially focusing on availability of labor.
Right. Anuj, coming to you, a two-part question. First up, currently, what is it that construction players actually offer in terms of compensation in case of accidents or any untoward incidents that do take place? And secondly, there's actually been quite a lot of opposition when it comes to unions towards this particular move. That's a bit surprising. So how do you think, their concerns can be addressed?
So clearly, the good quality developers, have all the schemes, not only that, they will pay market rate to the labor, but in many cases where the skilled labor is there for RCC framework or for carpentry, plumbing, electrical work, they will pay maybe 10 to 15% premium for the labor. And clearly, we've seen is that, during COVID and post-COVID, the way that the good quality developers are providing worker welfare, housing, safety, amenities, health benefits. Many of these have taken insurance from the insurance companies. They would not only do that, they will also train them. They will be very, very compliant, because they're seeing that if you are investing in the laborers at the site and, you're giving them better quality conditions, and better housekeeping, you give them food, the productivity of the laborer is going up. Just like what you asked in the previous question is there a labor shortage? Yes. Now, is there a possibility maybe with these changes you are going to be able to bring some of these labor back, from the villages? Possibly. But also what is important is to see how you can increase the productivity of these laborers. And that is what these developers really do, is that they invest in the welfare and make sure that there is all, things provided to the laborer, from housekeeping to housing to safety to training and the entire compliance of the labor laws.
Okay, we take that point. Ghulam and Anuj, always a pleasure speaking with you. Thank you so much for joining us today and explaining to us the impact the change in these laws could have on the real estate sector as a whole and the buyers as well. Very important to note that. So thank you so much for joining us with that. All right, with that, we'll do one thing. We'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action. Stay tuned for that.
Welcome back to Mid Cap Radar. Well, the markets are as flat as can be. The Nifty, extremely trading at the flat line. 26,082 is where the Nifty has. Look at the Bank Nifty up by 0.6%. But the broader end of the market, both the mid cap as well as the small cap, are underperforming. And within that space, look at a name like CG Power. significant order win getting cancelled. Street doesn't like it. That particular stock down over 3.5%. Have a look at a capital market name like Nuvama. That particular stock down over 2%. Some of the defense names on the back of some of the negative news flow that came in post-market hours on Friday. So names like HAL, BAL, all of these names are under pressure today. But with that, we'll slip in a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. You're still tuned in Mid-Cap Radar. Apollo Hospitals, that's the stock on our radar. It has inaugurated its newest Pune facility. The unit will initially open with 250 beds as a part of a phased launch. We are now joined by Sunita Reddy, who is the managing director at the company, to take a few questions on this one. Ms. Reddy, good afternoon. Thank you so much for joining in. Well, a new facility and in a new city as well. So if you can give us a sense of what is this phase launch looking like? 250 beds initially. When do you complete the entire project? And what is the expected occupancy in the initial phase?
So we expect to reach 50% occupancy within the next 5 months. And I'm glad to say we're fully equipped to reach that. We've also onboarded specialists to make sure that our beds are filled because our entry into Pune is not just about today's hospital. It's also about the fact that we already have a daycare center and we're building a network of clinics. So clearly, with our presence in the West, it takes us to a bed capacity of 1,000 beds, which include Navi Mumbai, Pune, Nashik. So it's actually a network that we're building out.
So it'll be 1,000 beds overall, and what kind of contribution will be coming in from Western India in that?
No, 1,000 beds in Western India.
Okay.
Right.
With today's opening. We will add another 250 beds over the next 2 years in this hospital.
Right. Ms. Reddy, what we want to understand from you is, number one, typically when a new hospital comes on board, what is the average revenue per occupied bed and when you compare it to the overall portfolio? And typically, what is the break-even time for a new hospital? You mentioned within 5 months, you gave us a target for 5 months, but if you could expand on that further.
So technically, our ARPOB depends on its changes from city to city, and of course is based on case mix. But we believe that we will achieve an ARPOB of close to 50,000 with the high-end specialties that we're currently offering in Pune. In terms of break-even, we expect break-even to happen in 10 months.
Okay, you expect the break-even to happen in 10 months. Ms. Reddy, wanted to understand before I ask you more about the expansion plans in Western India, because we also have another important news to track, the impact of labor laws changes that we have seen. Have you been able to look at that? What kind of changes do you think it will have on the industry, the hospital industry, and any big takeaway from that?
Yes, I think that definitely it will create, an awareness for good health. Because when you start doing the checkups and with the penetration of insurance where you're giving access to more people, clearly it will increase volumes, not just, in big corporate players, but I think even in smaller nursing homes. So this is good for all people and it's good for the hospital sector as well.
Right. Ms. Reddy, so just to clarify, you don't expect any impact on your operations because we assume that you do not have any contract laborers. Is that accurate?
Yes. We have very little contract labor.
Right.
So no impact in that sense.
Right. Ma'am, we want to understand, some of the markets that you've entered recently, the competition there is quite high. In that case, do you expect a certain amount of EBITDA drag, both in terms of cost of operations, what is it that you can charge the customer? And secondly, are you also finding it tough to find talent? Especially we understand that, the cost of acquiring new doctors has been quite high recently.
So in terms of competition, I think we should recognize that first of all, India is very underbedded. So the structural demand remains. If I were to look at the actual numbers, we need to add over around 4 lakh beds. And we need to do that very quickly. We do have 65% of India's care is in the private sector, which is around 12.5 lakh beds. And there is only 1.5 lakh which is organized. And in that 1.5 lakhs, there's only 50,000 beds in the corporate sector. So if you think of India's affordability, the fact that, with the last budget, people have more money in their hands, in terms of reduced taxation and the GST which has come for insurance, people will have access to good health care. And here in the corporate, we're only talking about 70,000 beds. So I think the structural demand exists. In terms of competition for good talent, Apollo has always had the ability, because we have a pipeline of talent that we build internally. We continue to get doctors from overseas. So we have a pipeline of external talent. And in terms of, what does it do for doctor compensation? Yes, there has been a slight increase in doctor compensation. In terms of that, our model has changed slightly. But this is a total 2% increase. And I think that the volumes will make sure that it remains less than 22% of revenue.
Okay, all right. So there has been an increase in doctor compensation because you've been getting some of them from other countries as well, and competition is not such a big worry for Apollo, and you're maintaining that 22% mark there as well. You do have plans to spend 8,000 crore on capex, 4,300 beds over the next 4 years. Can you give us a split in terms of which geography you'll be focusing on that as well? Because 1,000 beds here in Western India, you must be focusing pan-India as well, if there are any plans there.
Yeah. Yes. So I think a lot of this expansion is happening in the north, which we had not done earlier. So if you look at what we're currently doing, we have a hospital opening in Kolkata, which is in East India. Sonapur, we're adding 250 beds. Soon we'll open a hospital in Hyderabad, which is in Gachibowli, again adding 350 beds. In February, March, we'll open the acquisition that we made in Bangalore, which is a 180-bed hospital. And by the end of the year, we are quite sure that we will have Mysore, Brownfield in Mysore, and Sheshadipuram opening up. So if you look at this year, I think we will be commissioning over 700 to 800 beds. Commissioning another 800 beds, including Gurgaon, in the next financial year.
Right.
And calibrated opening of 800 beds every year for the next 5 years.
Ms. Reddy, we can't let you go without asking the one question that all the analysts on the street have. What is the status of the conversations that you've had with the insurance companies? FY27, have you all decided on a number in which you will take a price hike across the portfolio, or is that discussion still ongoing?
I think we've had a very good discussion with insurance. We realize that we are partners and that each one of us are crucial for the value chain, which is all around providing healthcare for the consumer. Having said that, I think the appropriate time we will come out with maybe a joint statement. But let me just reassure you that we have a very good working relationship with insurers, and we are providing cashless facilities.
All right, Ms. Reddy, always a pleasure speaking with you. Thank you so much for joining in. We'll, of course, understand more implications of what the conversations are with the insurance company in the later conversation. But thank you for joining us today. That's the word coming in from Apollo Hospitals. But with that, we'll take your leave on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in, as always. In terms of the markets, it's been a dull sort of a day for the markets, right? Not much of an up move or a down move that we're seeing. And Nifty has been around the 26,070 levels. Not any sharp recovery that we've seen. You know, from the day's highest point, it's just then moving around 26,050, 60 levels and just going up to somewhere 80. So yes, that's what we'll be keeping an eye out on. IT continues to hold on to strong gains. Banks are doing well. So Nifty Bank also is managing to hold on to gains of 0.6%. What's not doing well is the broader end of the market, right? When they look at the Nifty mid cap or the small cap, both of these are trading with cuts of almost 0.2% for the Nifty mid cap. Even the small cap is trading with cuts of almost 0.5%. So broader end of the market is seeing clear pressure. And look at the Nifty small cap, 0.6% now, and it's trading at the day's lowest point. That, you know, advanced decline ratio, the wide is seeing a larger gap now. At 12 o'clock last time when we were looking at it, it's still there. But now it's increased, intensified the gap. 2,000 stocks on the decline side versus somewhere around 800 stocks on the advances. But that's the market setup for today. But this is the show where we solve all your stock-related queries. And we're going to be doing just that today with Ashish Kayal, CMT author at Wave Strategy Advisors, as well as Gaurang Shah, Senior Vice President, Geojit Investments, to answer all the stock-related queries. Ashish as well as Gaurang, good afternoon, happy Monday, and thank you so much as always for joining in on the show. Let's get started with the queries then. The first query for today is coming from PC Achaya, who's writing to us from Bangalore. Now, he's holding 300 shares of Infosys. This is priced at around 1,500 rupees is the purchase price. Wants to know the outlook on the stock for the long term. Infosys, what is the bet coming in here? Gaurang, today we had a note that came in from some brokerages as well on the IT pack. But Infosys, what are we keeping an eye out on?
It's always good to be on your show. Thank you so much for having me. Good afternoon to all the viewers of CNBC-TV18, to you and to my good friend Ashish Kayal. A small disclosure before I go further, which is mandatory, that all recommendations that I'll be sharing with you on your show, these are part of our research team fundamental recommendations from a long-term point of view. Our company, Geojit or I, we do not have any personal investments, no conflict of interest, no financial interest, but we give recommendations to our clients on similar lines. They might hold their investment interest. Now, about Infosys, I think a lot of people on the street were wary about the Q2 earnings for the IT sector. Fortunately, we maintained a positive stance even when the announcement regarding tariff was made by President Trump on 80 plus countries, and we had 25 plus 25, 50% tariff. Expectation was that it's going to be a downplay. Numbers are not going to be as per line. It's going to come under pressure. But Q2 number was much better than what the street has estimated. Future looks quite strong. We have a hold stroke buy recommendation on Infosys. Hold on to it. And in case if on a bad market, if you see the stock slipping sub 1,500 or below that, you can possibly even add more to your long-term investments.
Okay, sure. Thanks so much for that, Gaurang. But just to look at the bottom of your screens, and in some somber news coming in, veteran actor Dharmendra has passed away at the age of 89 in Mumbai. And obviously, this is some sad news coming in. He was fighting with age-related issues for some time now. And today, he, passed away. 89 was his age in Mumbai. So that is the update there. Some somber news coming in from the Bollywood industry. But let's keep it going then with that stock related query. And Ashish, coming to you for Infosys.
First of all, rest in peace, Dharmendra ji. बहुत सारी movies देखी, I've watched a lot of them, and it's always sad to see something like this happening. But that's life, and we have to move on. So with respect to the stock query on Infosys, if you look at the overall Infosys pattern, it has been consolidating in a very broad range for quite some time. And after that, it has shown an attempt to give a breakout on the upside. There is some selling pressure from the higher levels, but overall, I think the entire IT cycle is going to turn back on the upside. That's what my take is. And we should head towards the level of 1650 and eventually 1700 levels on Infosys. Also, there was a buyback offer for the tender, which has been over, I think, right now. And this is going to support the prices. So overall, technically speaking, the stock was consolidating between 1550 and 1450 for quite some time, gave a breakout, and now sustaining there, I think it's going to head towards 1700 and eventually 1800 levels.
Okay, we'll be keeping an eye out on those levels over there. Let's move on to the next query. Again, an IT one, because Rajkumar is writing to us from Vishakhapatnam. He's talking about TCS. 50 shares of TCS, prices 1,800 rupees per share. Should they continue stay or exit? Gaurang, your view for TCS?
Well, I'll definitely stay invested. I think the acquisition price is 1,800, if I read that right, Vinny. Decent level of investment in a stock and a sector which is likely to perform extremely well as we go into the future. My friend Ashish Kayal mentioned about buyback about Infosys. My humble request to all the viewers who have got invested in IT stocks, large cap like Infosys, TCS, Vinny, stay invested. Don't get attracted to the buyback offers by the company, because there is a lot more that lies in terms of performance and stock price appreciation and earnings visibility. So again, on TCS, we have a buy stroke hold recommendation. Hold on to it. If you want to add to it, use dips to add on to the stock.
Okay. Use dips to add on to the stock. That also can come in here. Ashish, your view for TCS?
See, TCS view remains bullish. We can clearly see the entire IT cycle is turning up slowly and steadily. Possibly we are in an accumulation phase and we should start a wave up from here on. TCS also, we can expect a target of around 3,400 to 3,500 levels on the upside over near term. And on the downside, the support for the stock is going to be 3,000. So use any dips as a buying opportunity and accumulate the stock.
Okay, that's a view there for TCS on the fundamentals and technicals. Next query for today is from Surya, who's writing to us from New Delhi. He wants to know if he can invest in stocks like Suzlon Energy and NCC. Gaurang, your view? It's an investment query, NCC and Suzlon Energy.
And so on both Suzlon and NCC, we do have a positive coverage. But my humble request to the viewer stroke investor is that have a longish time horizon. Don't expect any kind of miracles to happen if you eventually decide, after understanding and rationalizing your investment approach in Suzlon and NCC. Now, Suzlon happens to be a company that we all know the history, but now things have changed for better. Q2 numbers were better than what the street estimates were. Orders coming in as far as the government focus in clean and green energy, specifically with solar and wind energy, likely to do well. You can definitely buy it from a long-term point of view. NCC, a stock associated with infrastructure, has a decent order book, and equally capable is the management in terms of experience and capability to execute that order book. And as we go into the future, Vinny, there is going to be a lot in terms of infrastructure creation, both at the center, the government at the center, and state level government. So again, but have at least 1.5 2 year plus kind of time.
Okay, have at least 1.5 year to kind of a 2 year kind of a time period when you're looking at investing in this NCC stock as well. But you know, Ashish, is this the correct level maybe to enter Suzlon and NCC, or maybe wait out for some bit of time?
See, if you look at Suzlon and NCC, both the stocks. So first talking about Suzlon, the stock started correcting over near term. If you look at it from 61.70 level, and it is still going down. We haven't seen any kind of positive traction. So my suggestion would be, instead of entering now, maybe around the levels of 52, 2.50, if you want to time it that much. That's the price action support zone. Enter there and then maintain a stop loss of around 48. That can be a good risk reward trade setup as well. Expecting a target on the upside over 62 to 64. That's a short term take I'm talking about. As far as NCC is concerned, NCC started correcting from 215 levels, and it has been nearly, I think, nearly 10 or 12 trading sessions. Since then, it has not given a single close above prior day high, which suggests that there is some kind of a selling pressure in the stock as of now. My suggestion would be to hold NCC from buying fresh positions as of now. Let's see a few more days, and if it can manage to break back about that 181 hurdle zone. So above 181, there is a possibility we might start seeing reversal in NCC.
Okay, we'll keep an eye out on the levels over there. Let's move on to the next query for today. We have Marun, who is writing to us from Mumbai, holding 73 shares of Coromandel, and this is at a price of 2,202 rupees per share, making a profit on this one. Wants to know the future prospects of his investment. Should they continue to hold this for the long term, or is it a short term bet that now comes in here? Gaurang?
Well, I hope it is long term, to be very honest, and we do have a positive coverage on Coromandel International. Government policies are auguring well for fertilizer stroke urea related companies. And I think as we go into the future, more productivity will translate into positivities for companies like Coromandel International. Holding 73 odd shares, well, you can definitely increase your investment if you have investable amount from a long-term point of view. Maybe at current levels or maybe at closer to 2,200 where he initially invested the amount. But yeah, definitely hold and add Coromandel.
Okay, hold and add Coromandel. That's a view there. And Ashish, your view for Coromandel International, continue to hold it, or if you're looking to add also, what levels?
Yes, I would suggest to add at the current levels also, because the stock had already shown correction over past 3 months and is now showing some kind of a reversal sign. So one can continue to add or average at the current levels. We can expect the stock to move up toward the levels of around 2,500 eventually. And on the downside, the support is going to be around 2,170.
Okay, keeping an eye out on those levels over there for Coromandel International. But on that note, we're going to actually slip into a very short break. But here's a reminder for our viewers. HSBC presents Future Female Forward Season 3, co-presented by Cognizant. From New Delhi, we bring you the newest state chapter edition with powerful perspective, action-focused agendas, and a collective vision for accelerated equity. Tune in to at 25th of November at 5:30 p.m. onwards for insightful conversations on CNBC-TV18 and CNBC-TV18.com. Welcome back to your stocks on CNBC-TV18. Markets are just where we started our show with just a slight bit of a decline, right? 26,050 around that mark is what the Nifty is trading at. But let's keep it going with the stock-related queries. The next query for today has come from Ramesh, who's writing to us from Mumbai, holding 10,000 shares of IDFC First Bank. This is at a price of rupees 80. Wants to know the long-term outlook of the stock. Gaurang, your view for the stock for a long-term story, IDFC First Bank.
Well, Vinny, first of all, I hope it's not a short-term trade turned into long-term because of the quantity that I said. And of course, 10,000 shares. I hope he's got some other investments also because a single sector or maybe a large concentration on one company is also not advisable on the fundamental side. Having said that, we have a hold stroke ad recommendation on IDFC First Bank. A couple of things, Vinny. First of all, I think the pressure from the MFI segment seems to be a thing of the past and is now in the rearview mirror. Post Q2 numbers, the verbatim given by the management is going to be focused on improving margins and, of course, improving the asset quality and, of course, the bottom line. And there is a very strong commentary on that particular part. And we expect the improvement to reflect in the third and the fourth quarter in the next financial year. Long term, continue to hold on to it.
Okay, long term continue to hold. That's the view there. But on the technicals, what's the word for IDFC First Bank?
See, the prior peak, which was the resistance at that point of time in July, was around 77 levels. And this, as per polarity reversal, this peak should now act as a support. So prices are very near to that level. So I think 77 is a very important level that IDFC First Bank can protect. And the overall undertone for the stock is bullish. We can clearly see from the lows of April, when it was 54, it's still trading at 80 levels. And there is a potential for the stock to go up. So my suggestion is hold on over here. And we can expect a target of around 90. On the downside, the support for the stock is going to be around 77.
Okay, we'll keep an eye out on those levels over there. Let's move on to the next query for today. We have S. Sankara Narayan, who's writing to us from Chennai, holding 15 shares of CAMS. This is at an average price of 3,972, making a slight bit of a loss here. And the other one is 15 shares of NSDL at a price of 1,080. Here they're making a profit now, side bit of a profit here. Long-term investor, so wants to know long-term, should he continue to hold both these stocks? What should be the target that they should keep also now? Gaurang?
So both are capital markets related stocks, Vinny. Basically services oriented, CAMS and NSDL. So on CAMS, again, we have a hold and an add recommendation from a long-term point of view. And if you're a believer that Indian stock markets are going to do well over the next 3 years, 5 years, or maybe more, strong companies, fundamentally strong companies, which are associated with the Indian capital markets are also likely to perform. So on CAMS, we have a hold and add recommendation. On NSDL, we had come out with a IPO note, Vinny, and we had given a subscribe from a long-term point of view. Continue to hold as well.
Okay, that's a word there. On the technicals, CAMS and NSDL?
See, as far as CAMS is concerned, the stock looks to be forming a triangle pattern in a range of 4,100 on the upside as a hurdle, and support at around 3,650. I think there is a possibility the stock can give an upside breakout from here on. And that can lead to a third wave, which can be a very sharp move on the upside. So hold on is the recommendation. The upside target can be around 4,600 or higher levels for the stock. And as far as NSDL is concerned, we can again see that NSDL, there is not much of a price data, but overall performance looks to be positive given that CAMS, NSDL, I think, will move more in tandem together. And NSDL can also inch higher towards the level of 1,250. Hold over here, the support for the stock is around 1,050 levels.
Okay, keeping an eye out on that. Let's move on to the next query. We have Shruti Mishra, who's writing to us from New Delhi, holding 100 shares of growth. This is at a price, at 100 rupees per share as well. Wants to know the long-term outlook of the stock. Gaurang, what's your view for Grow? After listing, we've seen that run-up that came in just in a week, almost doubled, right? So then, and then that slight bit of a correction came in. What should they be doing now?
And there was some news article about some delivery, etc., 30 lakh shares. I don't know how far that is true. Again, unfortunately, we did not cover Grow during the IPO, nor do we have any fundamental coverage. Won't be give any specific buy, sell, and hold. But, like I said, for CAMS and NSDL, strong and fundamental companies which are associated with stock market will definitely perform well.
Okay. Ashish, I don't know whether there's charts or anything to look at right now, but in that 1 or 2 weeks, they've managed to just run up. So you have any view on this or anything that you would like to tell our viewers?
See, my suggestion is there's not much of a price action data, and the way the stock has moved, making millionaires in one day and then taking it all away in another day. So it's better to avoid. I would suggest if rather park with something like a BAC, which looks much better, and it has shown strong kind of returns, and it has given also committed to the investors' wealth growth. So BAC is what I would suggest to switch to.
Okay. And Ashish, this is a technical query that we have. This next one, Shashank Bhardwaj is writing to us from New Delhi. 200 shares of SBI he's holding at a price of 190 rupees per share. Wants to know the levels to add more at. So he looks to add more. He's holding it at 190, so holding it for a long period of time. What's your view?
So if SBI at 190, currently trading at 970, if I'm understanding it correctly, that's a crazy level that he is holding on. My suggestion would be, why do you want to get out of this stock when you have hold on and seen a multi-bagger returns in such a period of time? Continue to hold on. Do not do anything stupid now, because we have ride all the trend, and I think Bank Nifty, PSU banks, and also the private sector banks are going to do very well in the coming few years as well. So overall tone is positive with respect to levels. I think 899 is a very important support zone for SBI, and on the upside the stock can even move towards 1200 or higher levels.
Okay. We'll keep an eye out on those levels over there. Thanks so much for that. Thank you so much, Gaurang, as well as Ashish, for always joining in with us on the show and helping our viewers with their stock-related queries. But with that, we're going to wind down this edition of Your Stocks. But in somber news, for thousands of fans, veteran actor Dharmendra has passed away at the age of 89 following a prolonged illness. And, 89 years, and he is the He-Man, is what we call him in Bollywood as well. So in very somber news there, he passed away at the age of 89. But with that, we'll wind down this edition of Your Stocks. Thank you so much.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hang Seng up 1%. The Taiwanese index also up 0.4%.
The 20-day for the Nifty is moved up to 25,844.
Outside India, we are holding a market share of almost 9% in the middleweight, but still we see there's a huge scope for us to create one more success story, what we have created in India.
Market open coming up on your screens is up about 0.2% in the Nifty, 0.2 on the Nifty Bank.
I don't think you have globally diversified just because you have bought a NASDAQ or S&P.
We open in the green, but we are off the highs of the day. So it's a 40-point uptick as we speak.
Renewable sector is growing. In fact, I think we are really beyond plan when we look at the policy numbers.
Nominal GDP, that's growing at only 8% versus 8.3 year ago.
Now, we are still in the green, but considerably off the highs of the day, almost a 60-point cut from there.
Okay, well, that is the day so far, and markets have been sluggish, difficult, can use all kinds of adjectives. 35 points down on the Nifty, but the broader market is looking much tougher. This is Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Prashant. With me, my colleagues Nigel and Rima, as we've been telling you from the morning, it's back from Japan.
Yes.
Arigato. Arigato.
Still waiting for that mail though, Please come for...
I think I'm the good luck charm for IT. IT is doing well today. The Nifty IT index is supporting, and banks too have picked up now.
Yeah, that's right. But the Nifty, not a good luck charm. I mean, at the low point of the day, Rima. But, we keep debating about this all-time highs or not. I mean, portfolios are not feeling anything like that. The breadth of the market is terrible. I think there is some big liquidation that's taking place. Last two sessions, maybe a few more sessions, and maybe, just maybe, if it's just liquidation of positions and, maybe people clearing out before the end of the year, as Prashant made that point about PNL, you want to protect the PNL towards the end of the year, and maybe we could expect an equally sharp bounce as well on some of these names. But otherwise, the broader markets are in immense pain all through the trading session.
But we're already talking about year-end portfolio.
Yes, 750 hours. After that, I'm not in the studio.
Well, we've got a month to go before I thought.
72,
about
3 weeks, right?
Yeah, 22, 23 days, right? Trading working days. Trading.
Closer than that is the monthly expiry this week.
Yeah. No, but it's the broader market, right, which is looking pretty bad actually.
Yeah. Painful.
And it's kind of there you go. That's the advanced decline, and it's only gone one way. So almost 2,200 down and about 750 up. That's the overall picture. And what is up small. Except maybe the IT services, and we'll talk more about that one as well. Let me just quickly run you through what's lined up here on Closing Bell over the next 1 hour or so. So we've got, the markets, of course, in focus. What next? The question remains. 26,000 is the level where we're at. Closer to 26 than 26,100 now. And a lot of mid caps and small caps are under selling pressure. IT, Motilal has, I think, upgraded their view. JP Morgan likes the IT space as well. So more on this. The new labor code is now effective, and there are lots of changes afoot for many sectors like IT services and, of course, many other areas. And I think we'll tell you some of the impact, but I reckon not all of it, as this will be understood over the next few trading sessions, next few days. MCX, you rarely hear the new CEO, the new MD, Praveena Rai, but she spoke with us, and we'll play out some sound bites in terms of what the ambitions really are for the dominant commodity exchange. Excerpts from that chat coming up a little after 3 o'clock today. How should you position yourself is the question. Mitesh is with us to answer that. Mitesh, good afternoon. Good to have you with us here. Where are you looking for trades, and what are you seeing out there?
Good afternoon, Prashant. So, in the morning I was saying this, that if we don't get past the earlier highs, the previous all-time highs, then I think there could be more of a pullback, and the Nifty would give you a better entry point. I think that process is going on, and I would still suspect that 25,800, 850 is the area, where I think the Nifty might take support, and then we might see a reversal or an attempt to move on the upside. So till then, I think on the index, wait it out. On the stock side also, we've kind of reduced long exposure, suggested people to explore some shorting opportunities. And I have 2 sell calls right now. IRCTC is a sell with a stop at 694. Look for targets of 660. And Bajaj Finance, it was a sell earlier as well, but the stock was sideways. Today is breaking that sideways range on the downside. So sell with a stop at 1011 for targets of 960.
Okay, all right. Got that. Now, Mitesh, we'll come back to you for more a little later. But let's get to the first story that we want to address right now. As some newspapers are saying, that the winter session of Parliament is expected to be a substantial one, with many bills which are likely to be passed, especially in the economic sphere. One area is going to be insurance, the Insurance Amendment Bill. It's listed as a bill which will be taken up. But what is within the bill is essentially what we want to talk about. There are two things. There are things like 100% FDI, composite license, and those things are understood that they will be taken up. But there were two specific issues. One, of course, was open architecture for individual agents, which is important for LIC, which we reported on. Yash got you that story a couple of hours back. The second one is now flashing at the bottom of the screen, which is with regards to the government likely in the bill to propose permitting merger between insurance and non-insurance companies. Yash is here. Yash, let's start with the second one first, if we can.
Well, that's correct, Prashant. First of all, let me just tell you, it was 4 years ago when the amendments to the Insurance Act were first introduced. It's taken about 4 years, a lot of back and forth, a lot of committees, a lot of consultation papers. Finally, the winter session of the Parliament, the upcoming session, is expected to be to table the Insurance Amendment Bill, and that has been made a list of business for the winter session of the Parliament. As you said, the second one first, a big positive expected as far as Max Financial Services is concerned, because what we're picking up from our sources is that the government is likely to, of course, table the Insurance Amendment Bill, and under that, it is expected to allow mergers between insurance companies and non-insurance companies. Max Financial Services, Axis Max Life have been talking about, wanting to do this reverse merger between Axis Max Life and Max Financial Services for simplification of the corporate structure and removal of that holding company discount from Max Financial Services. And the government this time around in the winter session, according to our sources, may very well allow that merger between insurance company and non-insurance company. As I said, this will pave the way for the merger between Axis Max Life into Max Financial Services, simplify the corporate structure between the entities, and removing the holdco discount as far as Max Financial Services is concerned, which owns about 80% stake when it comes to Axis Max Life. Currently, the Section 35 of Insurance Act restricts mergers between insurance companies and non-insurance companies. But once the government allows this particular merger, which is expected to happen in the winter session, that Section 35 would be removed and the mergers between insurance companies and non-insurance companies would be allowed. What we've also been given to understand, and it seems that, mergers and acquisitions would not require IRDAI approval, as IRDAI's role would be of framing regulations and granting registration to new insurance companies from the point of view of better corporate governance.
Okay, all right. Yash, thanks very much for that. This is, of course, important because we'll need to, for Max Finance especially, this is an important one. Yash, very, very quickly, in 30 seconds, the open architecture bit which we've already reported on, because LIC is the one which is affected the most, right? I mean, 90% of the premium they collect is via agents. I mean, that's the channel. So take us through it.
Well, as you said, two important numbers. LIC collects more than 90% of its new business premium from agents, and SBI Life collects 28% of its new business premium from agents. And that agency network for both these companies could come under threat if open architecture is indeed allowed, which we are given to understand from our sources that the government, as a part of the same Insurance Amendment Bill, is expected to allow open architecture. What does open architecture for individual agents mean? Essentially, currently, these agents can only tie up with one life, one general and one health insurance companies. But once open architecture gets allowed, then individual agents will be allowed to tie up with multiple life, multiple health and multiple general insurance companies. What happens in that case is that if any other insurance company is paying slightly higher commission to an agent as against its primary insurer, then the agent, in search of that better commission, could switch to that other insurance company. And in that case, the primary insurer might have to pay higher commission to match up with the second insurer to retain the agent, or maybe lose out on that business. Why is it only a big negative for LIC and SBI Life? Because large part of their businesses do come from the agents, and hence the maximum impact of this on the negative side goes to them as well.
Okay, all right. Yash, thank you very much for that. We'll get Mitesh is with us, and we'll ask him for his views on Max Financial, LIC and SBI Life in just a bit. Mitesh, you want to weigh in if these three, anything looks interesting here?
Yeah, I actually, have been looking at the chart of LIC, and because that's where, we've seen a range of about 925 to roughly about 880, 875. And now, there are early signs that the range may break on the downside. So that's one worry. SBI Life, I haven't looked at it in detail, but the stock after a run-up, is down today. And this could purely be because of the fact that the stock is overbought and just giving a pullback to the averages. So between all the three, I think the one which I'm really looking at, which could give some kind of a negative movement is LIC if it starts breaking below 880.
Okay, all right. Breakdown perhaps, right, in LIC out of the three. Mitesh, thanks very much for that. One more exclusive. Now, sources suggest that a large transaction may be in the offing in the Indian QSR space. Vivek is here with details. Vivek, take it away.
Well, that's right. This is one particular deal that was most likely going to happen last year, but what actually transpired was that multiple PAs who were interested in buying out Everstone Capital's stake in Restaurants Brand Asia pulled out at the last minute. But what we are understanding from our sources is that Everstone Capital, which is the private equity which manages Restaurants Brand Asia, which runs both Popeyes as well as the more famous Burger King, they have reinitiated efforts to go ahead and exit their stake in Restaurant Brand Asia. They are now in talks with multiple interested parties. We understand that amongst the interested parties are a clutch of private equity investors, and along with that, a large family office of a listed company in India has also evinced interest. They appear to have some amount of interest as far as the QSR space is concerned. So this will be a logical extension for that particular family office. Now, what we are understanding is that the negotiations are at an advanced stage. The bids received are at a premium to the current prevailing market price. And very interestingly, now according to SEBI's rules, there will be an open offer that is triggered, despite the fact that Everstone Capital just holds close to 11.2% stake in the company. This is on account of the fact that there will be a change as far as the control of management of Restaurant Brand Asia is concerned. Now, we reached out both to Everstone Capital. They did not give any comments, and we are still awaiting a comment from the management of Restaurant Brand Asia. But this will be an interesting development. Remember, earlier efforts were there, but we understand that this time around, talks are at an advanced stage, and before the end of the year, we could hear some development as far as RBA is concerned.
Thank you very much for that. Gurmeet Chadha is now joining in from Complete Circle. Gurmeet, thank you very much for joining in. You want to come in on the story that Vivek was talking about?
No, so Rima, we don't have this portfolio, neither do we track. I've been hearing things around it on the show, so we don't track this one.
Gurmeet, hi, afternoon. The insurance story that Yash was talking about, any thoughts?
Yeah, so long-awaited, Prashant, and I think it's much needed, especially individual guys being allowed to source multiple. I think what it could impact is larger guys like bank-backed life insurance companies who are heavily dependent on banca as a larger mix. From the premium they source, especially the new business premium, and that's where they get more surety, both in terms of fresh as well as renewal. So, but overall pretty positive. One name which we like is the Max Life, which will become Axis as ownership changes. I think they're registering good growth, both in terms of value as well as new policy source. And with the new management in place, that's something we are tracking very closely. Other than that, we have ICICI Lombard in the portfolio. Incrementally, the total ratio is now coming around 100. Below 100 is where you make more money from underwriting profit and not just investment income. So that's something these both names is what we have in our investment universe.
Okay, all right. Hi, Gurmeet. Good to see you on the show, Gurmeet. My colleague Parikshit, he went ahead and interviewed Royal Enfield, a rare interview, interesting one out there. 125 years is what they've completed. From the two-wheeler pack, what do you like? I think personally as well, you've owned a Royal Enfield, if I'm not mistaken. But what do you like in terms of stock preference?
So proud owner of Royal Enfield, Nigel, like you, but portfolio we have TVS in the portfolio. I think it's doing well on across front, domestic numbers, gaining market share in the premium segment. The EV version doing very well. In fact, they're now the leading player there. Exports picking up and very good capital allocation. The stock is consolidated after a very good run up, but continues to do well. Slightly at a premium, valuation premium compared to, let's say, a Hero MotoCorp or even, let's say, Bajaj Auto. But, market in this kind of market, it's rewarding growth. So that is something we like in the portfolio. And we continue to add more auto ancillaries in the portfolio. We're tracking, Sandhar Technologies. We are tracking Raj Ratan Global, which is into bead wires into tires. Obviously, I spoke about KPIT Tech. I think with IT rebounding and auto rebounding and globally auto looking a little better, I think that's something which could be important. So we continue to be bullish on the entire space. We would probably be at about 14-15% weightage on auto and auto ancillaries.
Okay, all right. Gurmeet, so you're riding the Royal Enfield, but in terms of stock preference, TVS Motors is something that you like. Just a half hour back, I wrote a piece about how I bought my first Royal Enfield, on my LinkedIn profile as well. But since you spoke about tech, I think that's a good time to go across to Rima. Rima, you're back. Good luck, charm for the tech space. And Motilal Oswal as well believes that things are turning around out there.
They do. So they have upgraded the Indian tech sector from an underweight to a mild overweight. And there are three key reasons for that. One, the recent underperformance. The Nifty IT index has underperformed not just this year, but over the last 3 years. Secondly, even on the global hyperscalers front, now increasingly they believe that we're seeing diminishing marginal utility from infrastructure build out, and the attention will shift from building to perhaps more maintenance and application, which is where the Indian IT companies fit in. And they also, support the valuation argument by saying that in the Nifty 50, the profit pool of IT companies has remained unchanged at 15% for 4 years. But the weightage of IT stocks in the index has been coming down, and it now stands at a decade low of 10%. So all that makes them confident that perhaps the cycle is now turning, and they have upgraded it to a mild overweight. Infosys is supposed to be one of their top winners. They've upgraded it to a buy. They believe the current valuations are fairly attractive. But even outside of that, they've upgraded Infosys to a buy. Wipro has become a neutral. Zensar, they've upgraded it to a buy. And in the mid-cap space, Hexaware and Coforge are some of the other IT stocks that they like. And generally on this labor pool, the labor laws in the code, it's not going to impact the Indian IT companies too much. So that is not a headwind, though the industry is one of the largest employers of the formalized workforce, and the wage bill is, about 70-80% of the overall expenses. But even then, I spoke to a few analysts, and they don't expect the labor code to have any material impact on any of these IT companies. Gurmeet, do you think the cycle has turned from IT, from an underweight, maybe you can go overweight?
So, as a contrarian bet, as I spoke Rima earlier, we have HCL Tech in large cap in the portfolio. We have KPIT Technology, which I mentioned just a while back. And I think we will tactically look at adding few more names in case, there is a closure to the US trade deal, because I think it's very underowned. And as you rightly mentioned in the brokerage note, completely out of favor. And valuations have turned reasonable. I would not say that they're very cheap, because you still have large cap IT at about 90-20 times. But as I said, it could be a good trade in case things ease off. And, at later stage when the AI adoption picks up, I personally think the mid-cap, small cap ones are more agile in terms of making that pivot versus large cap names. So we like Persistent. We're tracking Coforge. There is Newgen Software, which is on our radar. So I would prefer to do it through the small and mid cap IT. In large cap, as I said, we have HCL Tech, because that's more diversified. It's not just IT services. There is the software business, which is now more than 25% margin, which they acquired, and now it's really turning around. And obviously the ERD business as well.
All right, Gurmeet, what about from the NBFC space? We had Chola this morning, and management sounded reasonably optimistic. They're talking about 20% growth. they're sticking to that 20 to 22%, which is scale back a little bit. ROAs, they're looking at around 2.2% to around 2.4% odd. They're saying asset quality is pretty okay, and the credit cost will be ballpark 1.5% or thereabouts. But one of the stocks on the NBFC, if I'm trying to look at stocks that have gained big time from the financiers, Mahindra and Mahindra Financial Services stock is up 20% in the last 1 month or so in a market that's been jittery. We're talking about the mid-cap index not performing. This one, in fact, has woken up. What's your view on this name and from the NBFC space? Or what do you like?
Nigel, of late, there has been a liking to some of the smaller NBFCs, all smaller banks, wherever there is some signs of credit cost normalizing, ROA expanding, and turnaround happening. We've seen with a lot of equity infusion in tier 2 banks, whether it is RBL, Federal, etc., Yes Bank. We've seen that with some of the NBFCs like Samman Capital, etc. So I think there is interest there, and I think valuation comfort has been there, and they've come off from after a rough cycle in 2019 and COVID when the entire IL&FS episode happened. So I think L&T Finance and M&M actually have shown that kind of a turnaround. I think even in some of these small finance banks, some of the, something like a Credit Access Grameen, etc., there might also be some more juice left if the market believes that the stress has, easen out. So we have a combination of it. We have ICICI SFC in amongst the top banks. We have Federal and RBL in tier 2 banks. And amongst NBFCs, we have a gold NBFC player, which is Muthoot. And we have Chola and Poonawalla. So we are looking at, as I said, across the spectrum. This again, along with auto. So with financials and auto, continue to be the two most overweight positions for us in the portfolio.
Okay, Gurmeet, thanks a lot for that. And I recall you commenting on NSDL, I think, so that, in the unlisted market, it was trading at very, very elevated levels. Listed, the IPO price was much lower than what it was in the unlisted market. So that was a good word of caution out there. I think it was around 1100 rupees. The IPO came at far lower levels. And after the run we have seen, it's back at around 1100 rupees as well. So kudos on that call on NSDL when it was in the unlisted market. Thanks a lot, Gurmeet, for joining in. Well, time to slip into a short break. On the other side, we have Ankit Jain from Mirae Asset Mutual Fund, who will be joining in.
NBFC.
Welcome back. Let's put the spotlight now on the top movers in the market. Hormis is now joining in. Hormis.
Some interesting names that have come up in today's session. There's a sharp spike seen in Muthoot Microfinance, not just in the stock price after 1 o'clock, but in terms of volume activity as well, more so. The stock is up 6%. It's the biggest single day gain since April. The volumes are the highest in just over a month, but this is the third instance in the last 7 sessions where more than 5 lakh shares have been traded in a single day. Now, after around about 1 o'clock, there was a sharp spike in volumes. We have already had close to 18 lakh shares that have been traded on Muthoot Microfinance today. The 20-day average is just over a lakh. And this one is turning out to be the third straight month of gains for the stock. VLS Finance, we spoke about it all through the morning as well. So 7th out of the last 8 sessions now that the stock is gained. It has announced a 100 crore rupee share buyback, which is around about a quarter of its free float market cap. We had 11 lakh shares of the company that have been traded now, well above the 9 odd lakh shares that traded last Monday when the earlier intimation of the buyback had come. The 20-day average is just around 98,000 shares, trading above all key moving averages. And despite this month turning out to be the best since June of 2021, the stock is still down 8% on a year-to-date basis. ITI is the other mover within the broader markets today, 12% higher. It's tapped a 6-day losing streak in today's session. The volumes are the highest in nearly 2 months. We have had over 2.5 crore shares that have been traded on ITI today. The 20-day average is just around 4.5 lakh shares. The stock trades above its 50-day moving average now convincingly at that. 50 DMA was around 321. Still falls into that less free float stock. So the government shareholding at 90%, another fund holding 8% as well, has been an underperformer this year, down 16% so far. And lastly, Oriental Hotels, that too has snapped a 4-day losing streak in today's session. The volumes here are the highest in nearly 3 months for the stock. We've had 8.5 lakh shares of Oriental Hotels that have been traded compared to the 20-day average of just around 1.5 lakh. So that's around 6x the 20-day average. But despite this kind of up move today, the stock still remains below its key moving averages and has given negative returns now for 5 months in a row, and hence the underperformance on a year-to-date basis as well. The stock down 29% so far this year, the first negative annual return that the stock may deliver in the last 5 years.
Okay, all right. Thanks very much, Hormus, for that interesting list as always. Ankit Jain is Senior Fund Manager at Mirae Asset Mutual Fund. Ankit, good afternoon. Good to have you with us here. Thanks for joining us. Prashant this side. It's a tough-looking screen, Ankit, across the board, right? I mean, lately, and especially if you're tracking things day to day, it has been, I mean, a few wins along the way. What do you suspect is happening? And is the market once again kind of trying to, discount out the possibility of this US-India deal? Who knows when it happens? But every now and then you get this euphoric thing that, well, it's very close. And then it doesn't happen, and then the market kind of sort of gets disappointed.
Yeah. Hi. No, Prashant, you are absolutely right. If you look into market, has seen a pretty good consolidation last 15 months. Last 15, 20 days also, there has been a bit of a volatility. But it is last 15 months, if we try to look into it, is around concerns around growth slowdown, given tight liquidity environment, slower capex, and weak rural consumption. And also, if you look into the starting point of valuation, sometimes, let's say last year itself was very expensive, particularly in mid and small cap space, because it was trading at 40-50% premium to historical average, and that too on an optimistic earnings assumptions as such. But as things stand, if you look into most of these sectors are seeing an improvement. And a large amount of this is to do with significant policy impetus we have seen both around fiscal as well as monetary. Fiscal side, if you look into almost $35 billion relief has come by way of GST 2.0 and direct tax cut. And on the monetary side, also significant heavy lifting has been done, right? Almost 100 bips rate cut and $70-80 billion liquidity infusion through CRR cut and all. So this is clearly now reflecting in a brief cycle of earning downgrade, which we have seen over the last 4 to 5 quarters. This is coming to an end as per our view. And we do see earnings growth trajectory to actually improve from mid-single digit, which has been the trajectory last 3-4 quarters, to strong double digit going forward. And even if you look into in this context, the quarter gone by, we saw a pretty decent earnings sort of a delivery. If you look into NSE 500 index, there has been almost 15% earnings growth. And even on the top line side, there has been a good jump from 6-9% range to, to almost 8 to 9 odd percent. And if you exclude financials and all, growth is even looking bit better. So I will say that whatever factors which has impacted market to consolidate last 15-18 months, I think we are seeing a pretty good progress on most of those counts, and even additional point being that valuations are now relatively more more attractive. If you look into large cap, mid cap, whichever way, the valuations are now in the range of 10-15% premium versus historical average. So to that extent, I think we are quite constructive on the market at this point in time.
All right,
on your point around, just to conclude on your point around this trade deal and all, difficult to pinpoint the timelines and all, but definitely India at this point in time confronts the highest effective US tariff rate at 34%. And while overall US goods export quantum is relatively low at around 1.5-2% of GDP, but this is also one of the fastest growing geography before the tariff coming into the picture. So to that extent, needs to be seen, but hopefully, let's see, maybe a couple of months down the line, we might hear something on this count. But clearly, as a result of this, we have seen FI outflow has been very, very high, and that is also partly one of the reason why actually markets are consolidating despite of incremental earnings downgrade coming down.
All right, hi Ankit, good afternoon, good to see you. And I agree on that point on the headline index. But if you tell someone, the fact of the matter is after many, many months, the Indian markets have outperformed the globe, which is a very, very encouraging sign. But if you tell someone about this, they'll be like, what are you talking about? Look at the month of November, the small cap index, I think, is down close to around 4%. And stocks are down 10, 15, 20% as well. So you would not be worried with the kind of selling that you see in the broader markets. Would you attribute it just to lightening of positions towards the end of the year? Maybe some large HNIs as well, taking some money off the table? Because the last few days has been a little bit worrying, I think, on that front. Your comment?
Yeah, Nigel, in the short term, there might always be this sort of a disconnect where actually small cap and mid cap underperforming meaningfully to that of large cap. But if I look into bit of a medium term, sort of a picture, mid cap and small cap is one space where earnings compounding potential remains far higher. And we have seen at any time frame on rolling basis, the earnings compounding can be pretty healthy at around mid-teens level, right? So to that extent, I will not be worried. Yes, near term, there might be different factors at play. But having said that, even if you look into bit more medium term basis, some of this space has done exceedingly well, right? Despite of consistent earnings downgrade over last 15-18 months, Indian market has held up reasonably well, I will say. Yes, try to compare globally, we might have underperformed, but there is right reason behind it of the starting valuations being high. But I will say at this point in time, most of the factors are looking in our favor, and we are quite constructive.
Right. What is the top sector, Ankit, you would bet on then? We have gone through a time-wise correction on the headline index. As you're saying, you're still constructive. You believe market is going through phases, but that's par for the course. Ultimately, earnings will be the driver. So if you had to tell me the top two sectors that you're bullish on, which one would it be?
Yeah, so if you look into, we are quite constructive on large private sector banks because there we are clearly seeing earnings, in fact, tracking relatively better than the expectation, and valuations are reasonable. In fact, it's trading at bit of a discount or maybe average in the historical context. Second, we are quite constructive on the pharmaceutical side of it, which includes CRO and CDMO, contract manufacturing as a space. So no, and third might be, let's say, industrial consumable as such. So these three pockets we will be quite constructive upon.
Ankit, on technology, I was reading some notes. Today Motilal Oswal came up with a note. And they've turned bullish. But even in their bullish argument, they're saying that by FY28, which is when we see enterprise-wide AI adoption, the industry growth rates are only going to be 8 to 9%. So if the key driver for picking stocks now is going to be earnings, now tech companies are not going to give you double-digit, earnings. Some mid-cap companies, of course, have been and will continue to do that. But on a broader scale, tech, even 3 years down the line, perhaps is going to give you a high single-digit kind of return. So then where do you stand on tech? Or do you think the valuations make it compelling enough to look into the sector?
Yeah, no, so IT sector, yes, I mean, it has sort of underperformed, but for the right reason, again, because given the AI is sort of a disruption, while, I mean, clearly will be deflationary for the sector as such. And to that extent, growth profile, any which way, given Indian IT services market share in global IT spending has already base growth profile as any which way sort of a coming off. And in that context, yes, I mean, currently sector growth is tracking maybe for large caps, maybe at around low single digit, which might improve to mid single digit going forward. And in that context, yes, I mean, 4-5% sort of a free cash flow yield do act as a floor. But having said that, I mean, until and unless, I mean, the growth visibility improves to high single digit, it becomes very difficult to make a very significant overweight stance on the sector.
Ankit, thank you very much for joining in. Prashant, when I met NTT, the Japanese company, and they said that they're already seeing 50% productivity in the software development cycle on account of AI.
Increase.
Yes, a 50% productivity benefit or increase, not a cost reduction, a productivity increase on account of AI in the software, the entire software development, not just coding, but the entire segment. And they're saying in 2 years that number will be 70%. And that's quite, sizable in terms of, productivity benefits. And the question is this going to be deflationary?
No, this is per capita productivity. I mean,
no, per person.
So then basically you need lesser people.
I asked them, I said, does that mean that, you are involving fewer people in coding? And I think we'll play out that interview tomorrow. But again, I don't think any company is going to come out and say that, yeah, now we'll, hire 70% fewer people. But he says, no, there is work. So, we continue to hire and we need people. But there is productivity benefit and it's quantifiable.
You need people, but I think much lesser, right?
That's what I asked him. But but I was just surprised by the number. 50%, I think it's quite incredible.
Okay, well, let's move back to the markets and what's the futures and options positioning looking like? Nigel has walked across to the F&O desk. Nigel, take it away.
Well, if you look at the Nifty, the last few minutes, it's suddenly taken a very, very sharp leg down. I think there's an expiry-related factor as well, gearing up for tomorrow's expiry. And there has been some lightening of positions, which is clearly evident from the morning itself, particularly in the broader markets. But this kind of a fall, it appears that it could be more linked to this expiry that will play out in the next 24 hours or so. Sharp downtick in the last few minutes. But as of now, things are still not very, very worrying because that 25,500 level is still holding out. The 20 DME as well, which is ballpark around 25,800, that's still holding out. And the VIX is cooling off. Remember, it had a big surge in Friday's trading session. But the Nifty as well as the VIX, they normally have an indirect correlation. When the Nifty is down, the VIX moves up. This time around, that's not happened. So that's one reason why I'm not still very, very concerned. And the PCR, the last time I checked, it's moved down to around 0.8. Remember, just 2 sessions ago, it had gone to around 1.5. The PCR normally sees some kind of basing out at around 0.65 to around 0.7. So both those two indicators, a cooling off of the VIX, as well as the PCR holding at around 0.8 towards the lower end of the range, that will give the bull some kind of comfort, though the fall is a little bit worrying. And the reason that the PCR has come down, because call writing, it's very, very aggressive from the word go itself. Even when the Nifty was in the green, you saw the premium on the calls getting eroded. 26,100, 26,150 call, 26,200 call. On all those 3 strikes, you're seeing massive amount of open interest built up and the premium getting eroded. Remember, there is a factor of a time value of money, part of the premium. And because the expiry is approaching, that's why that's getting eroded out there. Individual stocks, though, Wipro was one of the stocks that came in for a short covering bounce. That is a little bit higher, and the open interest is down. There are rolls as well that are taking place. There's a sense of some short covering even on tech Mahindra. From the broader markets, few stocks are doing well, but NBCC, massive volumes out there, and there's a hint of cash market buying as well as short covering out there.
while on Kalyan Jewellers, surge on open interest in the current contract itself, there is some shorts that's piling on the system. So the Nifty at the low point of the day, the bulls will take heart from the fact that at least the VIX hasn't spiked up and the PCR is moving to the lower end of the range. But last few minutes has been a very, very sharp decline on the Nifty itself.
Yeah, that's a big downdraft that you're seeing in the markets, now down more than 100 points. Thank you, Nigel, for that update. Get into a break. We'll come back and get you a few BTST calls from our technical experts. Welcome back. As we've been pointing out, it looks like expiry-related jitters are dragging the markets down 100 points lower, and the Nifty is now closer to 25,950. Perfect time then to get in, Mitesh. Do you want to quickly update any trade on the basis of the fall that we're seeing right now, and then the stock-specific ideas?
Yeah, I think, at the beginning of the show, I said, we might be starting a pullback from the earlier high, so which means that the market in the short term could trend lower. And I would like to add two STVT calls. So Manappuram is one of them. Keep a stop at about 277. Look for targets of around 270 or below. And IRIDA is another one which has come on the negative side. It's continuing its decline of the last 3-4 days. So sell or STVT here with a stop at 144.5 for targets of 139.
Okay, now STBT calls and cautious in the markets. Thank you, Mitesh, for joining in. Let's get you some important corporate bites. Now, amid growing fervor in the derivative space, here is an important voice from the commodities market. Praveena Rai, MD at MCX, tells that their goal post is to reach 10 billion orders per day. She also shares her outlook for the company. Listen in.
What I heard is, you have to be ready for 10x, right? And I think that was really a a rallying cry.
A ringing thing, huh?
Yeah, and I said, and I think all of us agreed within MCX that I think that really is our goalpost now. So I think we are going for 10x, and we sort of ballpark numbers looking at something like maybe 10 billion orders a day. So that's what we're getting prepared for now. And when we look at timelines and we say, look, we want to target to 10x, 10x may not be like a single short jump, right? So probably it's going to have 2 or 3 milestones. If I look at very headline numbers, and we've sort of quadrupled in the last 2 years. So if we say, hey, if I look at that as a potential run rate, and there could be best case, there can be like a better case, and so on and so forth. Looking at all of this, I would say we should look at a first benchmark in about 12 to 18 months as a milestone, and in 2 to 3 years, really be at the kind of levels we're talking about now.
Well, and the big story of the day, the government's new labour codes effective November 21st, 2025 bring gig as well as platform workers under formal social security for the first time. We'll understand the development and the impact. Vinny has been doing all the crunching of numbers, listening into managements as well. She joins us to give us a complete wrap. Hey, Vinny.
Hi, yes, so in terms of, obviously, first let's talk about the changes that will come in with this new code, right? There'll be a minimum wage that will come in for all workers, and there'll be a national floor wage as well that will be set by the central government. Gig and platform workers will be included under the social security. So that's the biggest change, that everyone is talking about as well. And obviously, there's going to be a basic pay that basic salary which you have in your CTC, that is going to be 50% of the total salary as an amount. So that is something that is interesting in terms of changes. Now, how does this actually benefit workers? One, fixed term employees as well as contract workers, they will receive similar benefits that a permanent employee would receive. The eligibility period for gratuity, which was 5 years, now will come down to 1 year. Overtime wages, obviously, that will be paid at double the normal rate. Appointment letters will be given and will be mandatory for all employees. So even if they are on just a short-term employee, they will still get those letters as well. It is more simplified in terms of compliances that will come through as well, and they'll get a lot of benefits that come in terms of PFs, in terms of other medicals. That also comes in for temporary employees as well. Now, what is the benefit coming in for the employer side, or what are the implications for the employers? One, it becomes simplified in terms of the matters that they have to handle. They expect to increase wages, will improve social security for the employees as well. That will help preserve them controlled in terms of trade union activities. So they'll have more control on that front as well. And in one more change that is an implication for employers would be fixed term employment options that provides a flexibility in hiring without long-term permanent commitments. Now, in terms of labor rules that is there for staffing companies, how does it benefit them? It increases the total addressable market, right? As of now, in staffing companies industry, there are around 65 lakh employees, while gig workers themselves alone account to around 1 crore employees. So that gets formalized. So formalization is something that will increase their market share. Other than that, in terms of 90% of the informal jobs will now come into formal sector. So this will lead to formalization, digitization, simplification, as well as improved productivity. Even for Swiggy and Eternal, yes, there is a somewhat of a short-term negative impact that one could see in, and analysts are also saying that companies, now will start providing health insurance to riders. And as of now, the change that has come in is that platforms must contribute 1 to 2% of the annual turnover for social security. So maybe because of this short-term impact, but long-term still a positive for these companies as well.
Thank you very much for that. Sudeep Bandyopadhyay is now joining in on the show. Sudeep, have you all done any analysis? Is there any company you would turn cautious on because of a potential increase in costs which they may not be able to pass through? For instance, you're seeing Urban Company down close to about 4%. You pull up that intraday chart of a Team Lease or Quest, and you can see a very sharp decline in the stock price from the day's high.
Well, I think you mentioned the 3 companies. I think I'm a little bit worried on Urban Company as far as the cost implication is concerned, because their model itself, envisages a huge army of, part-time or temporary or gig workers getting employed for getting the jobs done. So obviously, in the short term, their costs are going to go up, and how much of it they'll be able to pass on to the consumers is a little difficult to assess at this stage. but it will be challenging for them to pass on because it's a competitive market. But I will say one thing here is that certainty of these laws, rules, and codes is definitely a long-term positive for the entire industry. Today, there is a lot of gray areas, a lot of uncertainty, and a huge amount of confusion on account of most of these issues. So certain certainty will definitely augur well from a long-term stable business perspective. So even an urban company will know exactly what they're going to spend, and they will be able to handle things better in the long term. But yes, there will be a short-term implication. As far as team lease and other manpower consultants or manpower contractors, for lack of better word, I would say there would be an immediate impact. But long term, again, I don't think too much of a problem. Codification and simplification of the rules definitely will help the industry.
Do you want to make sense of Swiggy? That's up 5%, while Eternal is flattish. A little bit of a downtake. But why is Swiggy up? Is it just expiry factors or the fact that they're armed with such a large kitty after the fundraise, so they're better equipped to handle any cost increases?
Well, I think it's got to do with the expiry. I don't think it's got to do with either the labor code, because both of them are in the same boat. As far as fundraise is concerned, Eternal has enough in their kitty as well. So I don't think the Swiggy's fundraise will kind of create a negative impact on Eternal. So it's predominantly got to do with what's happening on the expiry side. So I don't think we should read anything beyond that. Between the two, we do like Eternal, and I think from an investment point of view, from a slightly longish term, Eternal does look good even at current valuations.
Okay, all right. Sudeep, just stay with us. Just one quick word. I think we should get, Siemens Energy up for you on the screen. Pull up the intraday chart. I think it was one of the stocks that were due for the MSCI rejig. I think, that suddenly moved to the low point of the day. Very, very volatile. It went down, I think, to around 3,080 odd. And then it saw a bit of a pullback. But quite a few stocks are bouncing around. Maybe we could get Vivek. He had that list of stocks that were likely to move around. I think Siemens was one of the stocks as well that were part of the list. But it was in the inclusions, actually as per what the Nuvoma note is. So that one is seeing some bit of volatility. Sometimes some of this play takes place a little in the run-up to the particular event, and the event is today. I'll tell you what, slip into a short break, come back, we'll continue our chat with Sudeep. We'll also get you an update on some of these stocks. Well, it's not stopping actually. The Nifty is down now 140 points. You'll have to attribute this to actually, the expiry-related factor. The HDFC Bank stock that was actually holding one end up, that's given all of that away. Remember, that was the one that in fact was, well in the green. That's taken a bit of a slippy slide down. Eternal is another stock that's taken a leg down, and Nestle India as well. These are all frontline names, and they have seen a lot of selling. And if to be fair, actually, from the broader markets, at the start of the show, there were around 750 stocks that were advancing from the stocks that were trading on the NSE. And currently as well, there are around 740 stocks on. So the breadth of the market has stayed as bad as it was at the start of the show. But let's focus on one of the gainers from the Nifty. Royal Enfield celebrated 125 years. The company's CEO took a ride with CNBC-TV18's Parikshit on the streets of Goa to take us through the experience of their motorcycles. Let's listen in to what the CEO had to say.
As of now, I do see the motorcycle industry will continue to grow in the near future. Currently, it is growing almost about some 7-8%. In fact, we have been growing. Even last quarter, we grew almost about 45% compared to last year. And in the whole H1 level, we grew almost about 27%. So our growth also has been good. And I do see the growth momentum will continue. But the powertrain may change. Technology disruptions are taking place. Consumer preferences are taking place. The preferences can be on the technology of the powertrain or the way the retail takes place. So as an organization, we are always proud to say we are a 125-year-old startup mentality company. And we are very agile. We enjoy that because fundamentally we feel, we have to continuously improve. The higher CC motorcycles, the era is slightly going off. I don't think people are really enjoying. If given a chance, even I won't enjoy that sort of a bigger motorcycles. And I want a motorcycle which has to be interacting with me. And I control the motorcycle and I enjoy the motorcycle. And that's why we said middleweight, Rashid, is what we will focus as a company. And the middleweight, our definition is 250cc to 750cc motorcycle. And currently we have 350cc, 450cc, 650cc platform. And I do believe strongly that even this market can grow because premiumization in India is the thing. And we are by far the motorcycles which is very accessible price point which we have brought in and gorgeous looking motorcycles and everybody is loving. And I do see there is a good growth even in this platform which we can bring in for future.
All right, well, that was the management of Royal Enfield in a very, very rare chat. But actually from the broader markets, we are saying that, things are looking jittery. Pull up the intraday chart of Prudent Corporate Advisory Services. Stock actually is flying away. Big uptick is what we're seeing on that particular name. Even I think, from the tech pack itself, I think a stock like Orient Pro suddenly moved to the high point of the day. So there are select stocks that are doing a thing of their own. Even RVNL, let's get that stock up for you on the screen. That stock, in fact, has suddenly seen a big spike up in the last few minutes. Big move is what we're seeing on RVNL as well. Let's get the intraday chart actually of that counter as well up for you on the screen. RVNL. Okay, yeah, that's that's the one. Sudeep, give us any stock. I'm throwing it open to you. We already had a chart on Royal Enfield. You want to come in on that, but I'm sure these sort of times give you good entry opportunity where you get the stock of your choice at the price of your choice. You want to name a few?
Well, I will go to a completely different segment, Nigel. I know you like the Royal Enfield product, but I won't go there. At this stage, I will look at PSU banks. I think there are significant opportunities sitting in PSU banks, particularly even the smaller PSU banks. So I do like Bank of Maharashtra quite a bit at current level. And this got nothing to do with the potential merger, consolidation, blah, blah. Just look at the valuation and compare it with maybe an equal-sized peer in the private sector, either in a banking space or an NBFC space. And, the answer is very glaring in front of us. And I'm just talking about one. I think you can pick up Central Bank of India. You can pick up many other smaller PSU banks, and they do look very, very good on comparison. For that matter, even if you look at SBI, State Bank of India, it's quoting about 1.1 book, whereas NBFCs like Bajaj and all are quoting at 5-6 time book. So I think there is a glaring gap, and somewhere this gap needs to be bridged, and it will be. I'm not saying they will become equal, but a significant bridging of the gap should and would happen.
Okay, all right. By the way, just one more stock, ACC, a big underperformer. All of a sudden, that stock has suddenly spiked up. Just pull the intraday chart out there. ACC is the one that's bursting away. a rank underperformer actually. If I look at it from the cement basket, the market was not willing to give it valuations. Even after the 7% spike, if you take a look at the last 1 year chart, actually the stock is still down close to around 10%. So unsure what's going on there, but ACC is one of those names that have really bucked the trend today. But let's wind down the markets then. Last minute or so left. Stocks that did well today. Tech did very, very well. So the IT index was a relative outperformer. Motilal Oswal, they had come out with a note earlier today. They believe it's time to buy tech. So tech was one of the few indices that went the green. And if you had a two-wheeler index, well, then that as well would be in the green. Because stocks like Royal Enfield as well as Bajaj Auto, both of them did pretty well, giving company to stocks like Tech Mahindra as well as Wipro on the upside. Losers, well, they came in from the metal pack as well as from the real estate pack. So you had JSW Steel, Tata Steel, both of them under pressure. And defense-related names as well were a little bit under the weather today. BEL was one of the top losers on the Nifty. And from the real estate basket, Prestige Estates did come in for some selling. CG Power did have an order cancellation. The street was jittery on that front. That stock, in fact, ended with a cut. And Sammaan Capital management has been clarifying, but the street is still a little skeptical on their action on the erstwhile promoter. So that went home with a cut of around 4%. We talk about the Nifty doing well this month and outperforming, but the small cap index is still down close to around 4%. Telling you there is pain in the broader market. So net, you could attribute some part of today's fall to actually expiry-related factor as well as MSCI rejig. But otherwise, there's been a sharp fall in today's trading session. Last tick, closer to the low point of the day.
Disappointing mid-cap performance and the advanced decline ratio in particular. While the mid-cap index declined 0.5% in line with the frontline indices, look at the advanced decline ratio. Down at 1:3, and the gap between the two only widening. Some of the drags, notable ones include, Billion Brains Grow, that declined nearly 4.5%. Physicswala also recent listing last week, stock under pressure. You had softness coming in a couple of these banks like a Yes Bank, IOC, PNB, IDFC First Bank. So some of these mid-cap banks we can trade. On the way up, Federal Bank did well, so did Canara Bank, and Redington was a big mover, stands out for the kind of volumes it did. All in all, disappointing session, perhaps the expiry at play. The Nifty ends below 25,950, a cut of 0.5%. Don't go anywhere. We're going to take a leave and closing bell, but on the other side, Markets Forward comes up next.
A last hour fall saw the Nifty and Sensex lose 0.5% ahead of monthly expiry. Nifty slips below 26,000. Nearly 40 Nifty stocks end in the red. Broader markets were mildly better.
Real estate companies could see labor cost increase by 10 to 15% due to the new labor codes. Gig workers get legal recognition, and platform companies could see limited short-term financial impact. 50 lakh IT sector employees likely to see reduction in their in-hand salary, but cost to the companies remains unchanged.
40% GST rate will deter Royal Enfield from investing in bigger motorcycles, says company CEO Govind Rajan. Plans to adopt a startup mentality to minimize the GST impact. Doubles down on exports and plans to ramp up capacity. That's an exclusive. Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Sonal Bhutra and with me is my colleague Vivek Eicher. Vivek, good afternoon. What a fall in the last couple of trading minutes itself. We ended at the day's low almost at that level below the 26,000 mark and 108 points lower on the Nifty as well. Nifty IT was the sole gainer in trade, but we did have 40 Nifty stocks trading in the red. Tomorrow is the monthly expiry, so we'll watch out for big moves on the Nifty tomorrow as well. But the advanced decline ratio in the favor of declines 1:3. So basically for every one stock in the green, there were 3 stocks in the red today, where the Bank Nifty would mildly outperform the benchmarks, but the mid caps again down 0.4%.
That's right. Good afternoon, Sonal. And as you can see on your screen, that crisscross line clearly in favor of the declines, clearly indicating why we had such negative market breadth and why we had so much of selling pressure, especially in the second part of the session. What didn't do so well today and what dragged the market? Well, it was the entire defense pack and the PSU bank, some negative news flow regarding HAL, and you saw the defense pack under a lot of pressure. But we have a lot lined up on the show. So let's see what we have in store for you today. We'll start off with the top movers and shakers of the day with Hormuz Fatakia. India implements new labor codes. We break down the impact of the real estate sector and the gig economy. HAL fell in trade after its Tejas aircraft crashed at the Dubai Air Show. Finally, we take stock of the key market events to watch out for during tomorrow's trading session. Now on to our first segment of the day. Hormuz joins in from the big wall, the top movers and shakers of the day. Hormuz, over to you.
Well, the Nifty may have ended at the lowest point of the day, but the bigger talking point was the pressure in the broader markets, and there were sectors that were leading this fall. Real estate was one of them, and barring one, all of the stocks on the Nifty Realty Index ended with losses today. And take a look at those losses. Anantraj was down 6.5%. Most of the other names also trading with losses of anywhere between 2 to 3% in today's trading session. The other sector that was sulking today was the defense space, and almost every defense name, Garden Reach was down almost 4, Zen Technologies, BDL, Data Patterns, all of them seeing losses of anywhere between 2 to 4% in today's session as well. If defense PSUs were declining, the other PSUs, the non-defense names, were not too far behind either, with NHPC, BHEL, almost all other names on the Nifty PSE index also were down and out in today's trading session. Also, stocks that are at a 52-week low in today's trade from the broader markets. You take a look at Tarson's Products, Exicom Tele, Oswal Pumps, Rain Industries are at 52-week low, a 6% fall in today's trade. And lastly, stocks that bucked the trend in today's trading session. We spoke about VLS Finance and closing bell, but Aztec Life Sciences as well. Sonal put the spotlight on that in the morning and in our Under the Lens segment. Muthoot Micro, Karnataka Bank continued to move higher as well. So these were some names that bucked the trend, but overall a disappointing day for the markets.
No doubt about that. Disappointing for the bulls. Thank you, Hormuz, for joining us with that list as always. Let's take this discussion forward. We are now joined by Sudeep Bandopadhyay, Group Chairman at IndiTrade Capital, and Jay Thakkar, Head of Derivatives and Quant Research at ICICI Securities. Gentlemen, good afternoon. Thank you so much for joining in. Sudeep, what are the markets factoring in? We did have an indication from GIFT Nifty for a decent start. IT Pack did well. Bank supported at a point in time as well. What do you think was the cause of nervousness in the markets?
Well, I think it's got to do primarily with the expiry tomorrow. And, there are a lot of things happened during the last hour, half an hour to an hour. And this is definitely because of the expiry. Of course, the market already is factoring in some favorable announcement on US-India trade deal, sometimes during this week itself. And that's a big announcement. I hope it does come because a lot of it is already factored in by the market. There was a bit of nervousness on this new labor code notification on real estate as well as some of these platform companies because they will have some immediate impact. Definitely, long term it's positive, but short to medium term there will be some impact on their profitability, and it depends on how much they can pass on to the consumers, whether they can pass on or not. We'll have to wait and watch that. By and large, I think the market overall, I don't see much negative. Of course, we'll have to very carefully monitor what's happening in the US, particularly the trade deal, as well as US Fed decision on 10th of December.
Well, thank you so much, Sudeep. But I request both gentlemen to stay on. We have quite a few interesting stocks that we want to discuss. Jay, okay, let me come across to you first. 26,000 appears to be that particular level that the Nifty is struggling to go past. Do you feel that the Nifty can scale it in the next attempt, or do you see further downside from the current levels?
Good afternoon to you, Vivek and Sonal. See, today was the MSCI rejig as well. I mean, closed today, right? Semi-annual one. So, generally you have this kind of movement, during, whether it is FTSE rebalancing or maybe, MSCI rejig or rebalancing as well. And 26,000 breaking, closing below those levels, not much. It's just few points below 26,000. So if at all Nifty manages to reclaim those levels tomorrow, Vivek, then yes, there is a good chance that Nifty probably thereafter could continue its upward journey, but failing to surpass 26,000, stay about 26,000 on the day of the monthly expiry, Vivek, then I think the probability of a downside will be there, at least on the expiry day. I don't see a much bigger downside as well. I think that 25,750, 800, where the monthly VWAP is, that would act as a support. So, by and large, I think not more than 1.25 kind of percentage kind of a move. That is 300 points range of Nifty could be there. 25,750 to 26,000, and if those levels get taken off, then probably 26,100 to probably 25,900. But if you ask me that will 26,000 will be taken off or not, so I would say that the only chance for that will be if there is a good support again from Bank Nifty and Nifty IT. So today Nifty IT was well up more than 1% or so. And it gave up its gains. Most of the IT stocks gave up their gains, and the Bank Nifty as well. I mean, HDFC was struggling around 1,000 levels again. So most of the banking names have good call base at their 1,000 levels on HDFC, 1,000 levels on SBI, all of that. So if these critical levels don't take off tomorrow, if 59,000 levels of Bank Nifty doesn't get taken off tomorrow, then 26,000 will be difficult. Else, if there is a good support from Nifty Bank and Nifty IT, then as 26,000 again can be reclaimed.
Take that point, Jay. Thank you so much for explaining to us those levels. Let's get stock specific now. HAL was the stock on our radar, fell over 2% after its light combat aircraft Tejas crashed at the Dubai Air Show, resulting in the death of a pilot. This is the second Tejas crash in the last 20 months. Let's get in Ria Bhatia. She's joining in with what this would mean for the company. And Ria, also tell us what is the management saying about this incident?
Well, yes, HAL has remained under pressure today, down around 3 to 3.5% after an LCA Mark 1A aircraft crashed at the Dubai Air Show on the 21st of November. Now, the exact cause of the accident remains unknown and investigations are underway, which is what the company has highlighted. And it is important to note that this is the second LCA Mark 1A aircraft crash in the last 20 months, and the earlier incident had occurred in Rajasthan in March of last year. Now, on the back of this, Elara has also penned out a note on HAL. They have maintained their buy rating on the stock, saying that they do not expect any material impact from this crash, and they've also highlighted that fighter aircraft crashes are not uncommon, and there have been more than 7 incidents in calendar year 25 alone from several different jets that have been manufactured from different companies. Now, in terms of the expected impact, they have said that they are not expecting news of the crash to have any major financial impact on the current order book, inflows or execution of the company. However, there may be some delays faced in exports by the company, but however, the stock was still down around 3.5% in trade.
Well, thank you so much, Ria, for joining in and giving us all the details as far as HAL and why that particular stock was in focus today. Well, moving on, Swiggy and Zomato were in focus after the centre implemented the new labour code, which formally recognizes gig workers for social security benefits. Mangala Malu is here with what it means for the gig economy and how these new laws will impact the sector. Mangalam, over to you.
Well, they will see an impact, but the important part is for all the platform companies which do employ gig workers, gig workers and platform workers being recognized under the Social Security Act for the first time is a positive. And platforms must contribute about 1 to 2% of their annual turnover, which is capped at 5% for gig worker payouts. The Social Security is an important parameter to watch out for. We saw a decline in Eternal and Swiggy's prices earlier in the morning as the stock price is concerned, but thereafter there has been a recovery. Why is that? Because despite a near-term disruption, there's actually going to be a long-term positive for all these platform companies because it actually codifies and simplifies labor laws and importantly also ensures that there is a steady supply of gig workers too. The benefits will be rolled out via state welfare boards and government schemes. Now Eternal and Swiggy on their part, what we understand from analysts is already provide for health insurance to riders, which amounts to anywhere between 0.7 to 1% of their overall GMV. Now if the mandate as it provides 2% of sales, the incremental hit could be 150 to 200 crore as far as the GMV is concerned. Now how much does that amount to overall? Would be no more than 1 to 2 rupees, at best 3 rupees per order that may, the analysts believe, be passed on to the consumer over and above the 10 to 13 rupees that these companies charge as platform fees itself. So a temporary disruption, an increase of 2 to 3 rupees per order, but this is a long-term positive as far as supply for gig workers and platform workers is concerned. On its part, the companies have said that they welcome the government's proposals on gig worker safety, but they will await the final notification before assessing materiality. The street has assessed the materiality. They've seen a temporary hit, which is why the stocks were lower, but because this is a long-term positive, the stocks have recovered. And remember, these companies are all fairly cash-rich.
Okay, all right, take that point. Thank you so much for explaining that to us, Mangalam. Let's also understand how these new labor laws could impact the real estate space, because do remember, it is a labor-heavy industry and a lot of their costs come in from labor itself. Now, it is around 15 to 30% of the overall cost, depending on which city you are. If you're in Mumbai, the land cost will be more than the labor cost. So, the impact of this could be lesser in Mumbai, but more in other cities, the likes of Hyderabad, Kolkata, etc. X cost of land, labor costs are around 20 to 25% of the total construction cost for any developer. We did speak to some experts and they indicated that labor costs can increase by 10 to 15% because of this change, and overall cost, and from the development cost, it could be an increase of 3 to 4%. If that happens, the developers will pass it on to the buyers because they do not have enough strength in the balance sheet to take it upon themselves. They will not charge it to the P&L as well. So this could be detrimental to the buyers overall. Knight Frank said that there is a shortage of labor, which is a big issue for the industry. So if new labor laws come, they will solve this issue. However, the industry will still take a year to implement these new laws properly. But of course, there's a lot of clarity required otherwise as well, right? For implementation and execution, becoming compliant is one of them, which could take another year. And that is something that the street is watching out for. But if it does happen, this could be the impact for buyers and developers.
Well, thank you so much for explaining that. The execution timeline as well as the cost to the eventual home buyer is something that we will keep a track on. Well, Sudeep, you heard both Mangalam as well as Sonal explain the impact both for the gig economy, companies like Zomato as well as Swiggy, and also the impact on the realty pack. Especially, when you're coming to the new age companies like Eternal as well as Swiggy, what is your view? Do you feel that they would be able to easily pass on these added costs to the customers?
They will be definitely able to pass on. It's a temporary disruption as far as these platform companies are concerned. But in the medium to long term, they will be able to pass on the cost. And this will be actually a positive for these companies because this brings stability and certainty on the labor laws and gig worker engagement. So that's a positive. There may be some challenge on certain other segments of the platform business, which is like urban clap. I think their main so all the services are provided through contract laborers and gig workers, and in that case, the cost to the customer will increase. It's an extremely competitive space, and I'll be watching what happens as far as that particular space is concerned. There may be some impact on the manpower companies as well, and we need to watch that, whether it's TeamLease or some other competitors of TeamLease. We'll have to watch that space. As far as real estate is concerned, I'm reasonably sure that these will be passed on to the consumers, and the way their real estate demand is currently shaping up across the country, I think it will be get absorbed. there will be some disruption for the next couple of quarters once the rules are notified. But beyond that, I think this will be passed on to the consumers definitely.
Okay, all right. Jay, have you looked at any of these stocks from a technical viewpoint? Something that stands out, real estate or these gig worker, Zomato or Swiggy for that matter?
Sure, no, Sonal, most of the realty names had witnessed good short covering earlier this series, but then, coming to the later part of the series, or maybe, the second part of the series, second half of the series, we again saw the short getting built up in most of this realty names. So the overall trend was down in Nifty realty, and that was one of the underperformers, Sonal, if I would say, as far as Nifty is concerned, Nifty components are concerned. So the biggest underperformer so far has been Nifty IT, and which was followed up by Nifty realty thereafter. Nifty realty did see some short covering, but then again the stocks have started to give up, and we have again seen stocks getting short build up. So my view in the short term for Nifty realty names, most of them is sideways to negative right now. So one would be avoiding, or one should be avoiding this. And as far as Zomato is concerned, that's also one of the stock which is there in the F&O segment. I would say that this stock last month in the October series had technically formed a shooting star pattern, which is bearish reversal pattern as far as the candlestick pattern is concerned. And from a derivative perspective, we have seen short build up here too. So there are a lot of shorts built on Zomato, as well as technical setup seems to be negative in the short term because of the reversal from the overbought territory. So I think the stock can still slip further till the levels of 280. That is where one can find a support on Zomato. So the short term outlook is negative, and there are a lot of shorts out here as well. Probably there could be short rollover here from November to December series as well.
Well, thank you so much, Jay, for joining us and giving us a sense both on the realty names, which you say continue to remain under pressure, and Swiggy or Zomato is the name where you may look to add on dips. But moving on, there was an IPO rush on Dalal Street in 2025. Let's take a look at the public offers where retail shareholding allocation exceeded SEBI's 35% minimum requirement, and yet all of them are now trading below their issue price. Hormaz Fatakia is here with more details.
This interesting analysis from Prime Database, NSE, and of course our own CNBC-TV18 analysis. 6 issues. The normal minimum requirement for retail shareholder quota in an IPO, of course, is 35%. But for certain companies that are loss-making, that can go down to 10, as evident from the recent listings as well. But we've listed out 6 companies here where the retail shareholder quota was more than 35%. And all 6 of them are trading below their issue price. Now, highway infrastructure is one of them. Here the retail quota was 40%. Now at 70 rupees a share, this IPO received bumper subscription at 130 crore IPO issue size. The IPO was subscribed almost 300 times. The retail shareholder portion too was subscribed over 150 times during the bidding process. But despite this bumper subscription, as of Friday's close, the stock is down 5% from its issue price. Now the other one is Patel Retail, where the retail shareholder quota was 45%. And this too received bumper subscription. The issue was subscribed almost 96 times. The retail shareholding was subscribed well over 40 times as well compared to the shares on offer. That stock too, despite this subscription, was down 8% from its issue price as of last Friday's closing. Now during this IPO frenzy between August and September, there were 3 IPOs that came out almost at the same time, and all of them were in the news from the fall that they saw from the issue price right from the time of listing. BMW Ventures is one such example. Here the retail quota was the highest at 75%. The issue saw subdued response. In fact, the retail portion, which had the maximum reservation, was not even fully subscribed. It was subscribed only 99%. And as of Friday's close, the stock was down almost 30% from its IPO price. Now, the other one, of course, was Om Freight Forwarders. Here too, and here the retail quota was 47%. The IPO saw subdued subscription. The retail portion somehow managed to see full subscription. But even after this, the stock as of Friday's closing was down around 32% when compared to its issue price. The second last one on this list is Glottis, and this one is where the retail shareholders have had the biggest loss. The retail quota here was 40% for a 307 crore IPO. Subdued response to its IPO as well. The retail portion saw subscription of somewhere around about 1.5 times. But as of Friday's closing, the stock was almost down 50% from its issue price. And lastly, VMS TMT, where the retail retail quota was around 50%. Here too, the subscription was bumper. The retail portion was subscribed close to 48 times. And despite this, the stock is down well over 35% as of Friday's closing. So higher subscription to IPOs or a higher retail quota may not necessarily translate into better returns. These stocks are proof of that.
All right, Hormuz, thank you so much for joining in with all those important details. And we would also like to thank our guests, Sudeep and Jeff, for joining today with their fundamental and technical analysis. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get to the top corporate voices along with the key market events to watch out for on the other side.
Welcome back to Market Forward. Well, it's now time to shift our focus to all the big corporate voices of the day. SI's Group Enterprises Management told CNBC-TV18 that the company welcomes the implementation of the much-awaited labour code, calling it a major positive for the company. The management said that the reform will act as a revenue and margin kicker for their company, especially given the large disparity in minimum wages across India.
And India's largest derivative exchange, MCX's top boss, Praveena Rai, told CNBC-TV18 that the company is growing quickly. Addressing the October technical glitch, she said that the root cause analysis they knew the problem within a day or two. They added that the whole system was put through a testing to be able to identify any other threshold parameters. Also said that the goalpost at MCX was to do a 10 billion orders per day mark.
Well, now on to a CNBC-TV18 exclusive. Royal Enfield plans to launch its first electric bike by April next year. CNBC-TV18's Parikshit Luthra caught up with the company's CEO, B. Govindarajan, on the streets of Goa to take stock of the brand's 125-year-old legacy and India's plans. Govindarajan said that the 40% GST rate will deter Royal Enfield from investing in bigger motorcycles. He also said that the bike maker plans to adopt a startup mentality to minimize the GST impact while it doubles down on exports.
The higher CC motorcycles, the era is slightly going off. I don't think people are really enjoying. If given a chance, even I won't enjoy that sort of a bigger motorcycles. And I want a motorcycle which has to be interacting with me. And I control the motorcycle and I enjoy the motorcycle. And that's why we said middleweight, Rashid, is what we will focus as a company. And the middleweight, our definition is 250cc to 750cc motorcycle. And currently we have 350cc, 450cc, 650cc platform. And I do believe strongly that even this market can grow because premiumization in India is the thing. And we are by far the motorcycles which is very accessible price point which we have brought in and gorgeous looking motorcycles and everybody is loving. And I do see there is a good growth even in this platform which we can bring in for future.
All right, that's the word coming in from Royal Enfield. And before we wrap on this show, we bring you some key market events to watch out for. Ria is standing by with the key events to focus for tomorrow. Ria.
Well, yes, Sonal, let's take a look at the events to watch out for tomorrow. First up in the US, we have the core retail sales, the PPI data, as well as the consumer confidence data coming out. Back home in India, watch out for the IPO of Sudeep Pharma, which closes tomorrow. Also watch out for Go Digit General Insurance, for which the lock-in period ends tomorrow. Envido Infra will also be in focus since they will be holding a board meeting to consider a fundraise tomorrow. And lastly, the China International Semiconductor Expo will conclude in Beijing on the 25th of November.
Well, thank you so much, Riya. We'll definitely keep our eye out for all of these events that are expected to transpire in tomorrow's trading session. But with that, it's a wrap on this edition of Markets Forward. We will be back with more news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. A late sell-off on the Lal Street. The Nifty drops below 26,000, ending at the low point of the day. The Sensex loses over 440 points. Mid-caps continue to come under pressure. India's new labour code makes minimum wage a universal right for every worker. The central government will fix a floor wage, which may differ across geographies but allows states to fix the minimum wage, mandates gratuity for fixed-term employees after they complete a year. Trade unions call the codes a deceptive fraud and announce nationwide protests. Real estate companies could see labour costs increase by 10 to 15% due to the new labour codes. Gig workers get legal recognition and platform companies could see limited short-term financial impact. 50 lakh IT sector employees likely to see a reduction to their in-hand salary, but cost to companies remains unchanged. Hindustan Aeronautics calls the Tejas fighter jet crash in Dubai on Friday an isolated occurrence arising out of exceptional circumstances, says it would have no impact on the company's business operations or financial performance or future deliveries. The stock falls up to 9% in trade before recovering. 40% GST rate will deter Royal Enfield from investing in bigger motorcycles as the company's CEO Govind Rajan plans to adopt a startup mentality to minimize the GST impact, doubles down on exports and plans to ramp up capacity. That's an exclusive. After 6 quarters of margin expansion, Tech Mahindra CEO Mohit Joshi expects business transformation to be completed in FY27, puts the spotlight on profitability, delivery optimization and scaling of AI services. The US and Ukraine update the framework to end the war with Russia after talks in Geneva. Zelensky says conceding territory to Russia is the main problem, but promises to work with the US on compromises that strengthen the country. President Trump's Department of Government Efficiency, DOGE, has disbanded with 8 months left to its mandate. Elon Musk led the initiative in the first few months after it was launched with much fanfare to slash the size of the government. Justice Surya Kant takes oath as the 53rd Chief Justice of India. He will have a tenure of 14 months, promises to focus on reducing the pendency of cases. The Indian Navy commissions INS Mahe, built by Cochin Shipyard. The ship is designed to hunt submarines, conduct coastal patrols and secure vital maritime routes. Legendary film actor Dharmendra dies at 89 after a prolonged illness. With a career spanning 6 decades and a crowd favourite for his debonair appearance, Dharmendra straddled action, comedy and romantic roles with equal ease. He was honoured with the Padma Bhushan in 2012 and also served as a BJP MP for a term. Well, let's start with the day's market action. The Lal Street witnessing an all-round fall in the last hour of trade, with the Nifty slipping below the 26,000 mark. IT and bank stocks supported the market in the first half, but then witnessed a sell-off in the later half of the trading session. So that's the Nifty down 100 points for you, 330 lower on the Sensex. The Nifty Bank closing flat off its intraday highs. The Nifty Mid-Cap Index down by about 200 points, nearly 40 of the Nifty stocks closing in the red today. Nigel standing by now to wrap up the day's trading action. Nigel, pressure in the afternoon.
Well, the Nifty slipped and ended closer to the day's low, a day ahead of the monthly expiry. And there were some jitters that we saw in the headline index itself. But it could be more attributed to the monthly expiry that will play out in tomorrow's trading session. However, the breadth of the market favored the number of stocks that were declining, and there was aggressive selling from the word go itself. And that's what led the broader markets to underperform. The tech index, though, that was the outperformer. Remember, it's underperformed in the last 1 year or so, and there were various brokerage calls coming in from the likes of Motilal Oswal that suggested that the time has come now to get into tech, and some of the stocks reacted quite favorably. And if you look at the Nifty itself, the top winners came in from a mix of tech as well as two-wheeler makers. You had Royal Enfield, in fact, that completed 125 years, and the bulls celebrated in today's trading session. On the flip side, you had high beta. That came in for a bit of a hit. Steel stocks from the Nifty pack did take a hit. JSW Steel, Tata Steel, both of them were under pressure. And select defense names like BEL as well did take a bit of a knock today. The broader market losers, though, included the likes of Saman Capital, post that action on the erstwhile promoters. Last week itself, CG Power, well, that stock got hit after an order was cancelled. And since, high beta took a hit, metals were down. You had a real estate stock like Prestige Estates as well that was under pressure, in today's trading session. Net-net, the month of November, the Indian markets have actually outperformed. However, the breadth of the market has been negative, and that's where you're seeing that the small cap index is down close to around 4%, and that's why portfolios aren't feeling very, very good. So the outlook from the Nifty from here on, well, the US-India trade deal, that's what's awaited. However, till that crucial support zone of 25,500 to 25,800, which is around the 20 DMA, that gets protected, the bulls will feel they're still in the game, and they'll attribute today's fall to expiry-related factor out there. The bigger question is, can the broader markets recover? That's something that the street will track very closely.
All right, Nigel, many thanks for joining us. And from the equity action to the currency, the Indian rupee posting its biggest one-day gain in a month today. This as the central bank intervention helped the rupee rebound from the all-time low it hit on Friday. However, the currency is still above the 89 mark against the dollar, so 89.23 is the dollar rupee for you. Now, India's largest commodity exchange, MCX, says it has found the cause of the technical glitch that halted trading for 4 hours on the 28th of October. Speaking to CNBC-TV18 exclusively, MCX's CEO Praveena Rai did not reveal what caused the glitch, though. She said the exchange employed a third party to assess the root cause of the incident, and the whole system was then tested to identify any other potential issues.
First and foremost was the root cause analysis that got done immediately. I think within a day or two, we knew what it was, and we communicated that as well. In addition to that, we've also gone to market and we've brought in a third-party assessment of the root cause, so that in case there's something getting missed internally, it gets picked up. So that is also completed. The next step is to say, hey, this is looking at the root cause, but why don't we actually put the whole system through a testing so that with real volumes, we are able to identify any other such threshold parameters. So that's something that is currently in process.
Well, that's MCX, and S&P Global Ratings has forecast that the Indian economy will grow at a rate of 6.5% in FY26 and 6.7% in the next fiscal. In its latest economic outlook, the rating firm has said the GST rate rationalization and easing monetary policy will drive consumption-led growth. The report also states that domestic demand continues to support growth, even though US tariffs have impacted exports. Now, Hindustan Aeronautics shares dropped after a Tejas fighter jet crashed during a Dubai air show on Friday. The Indian Air Force pilot wing commander Naman Sayal was killed in that crash. HAL has called the incident an isolated occurrence arising out of exceptional circumstances. In a statement, the company said the incident will not impact the company's financial performance or future deliveries. The big story this evening, India has a new labour law regime in place. 29 colonial-era laws have now been repealed or rationalised into 4 new labour codes. The stated aim is to modernise the legal framework, extend social security to a wider workforce and ensure universal wage protection. However, trade unions affiliated with opposition parties have announced nationwide protests. So how do the new labour codes change the labour landscape? Let's focus on some of the big changes. First up, the central government will be fixing what it calls, and I quote, the floor wage, taking into account minimum living standards across geographies. States, however, will have the power to fix the minimum wage rate, which shall not be lesser than the floor wage fixed by the centre. So that becomes the floor. States can do more than that, but not lower than that if they like. Second, this has been a major bone of contention for trade unions. The law gives smaller companies more flexibility when it comes to laying off workers. Companies that employ more than 100 people needed government approval before laying people off. That threshold has now been increased to companies that employ over 300 people. Number 3, the gratuity eligibility timeline has been eased as well. Fixed-term employees who've completed a year of continuous service are eligible for gratuity. Earlier, the provision mandated 5 years of service. And lastly, the new code gives gig workers, people who work for the likes of Zomato, Swiggy, etc., legal recognition. This had been a long-standing industry demand. Platform companies could, however, see short-term financial impact on account of it. Let's now bring you a sector-by-sector analysis of the new codes. My colleagues are standing by, Reema, Shilpa and Sonal here with us to decode what the new labour codes mean for different sectors. Sonal, to you first. Real estate is a labour-intensive sector. How is the real estate sector reading into these developments? What is the likely impact?
That's right. There will be an impact on real estate industry and buyers as well because of changes that we are seeing in the labour laws. Now, do remember, labour costs are different for different cities. For something like a Mumbai, we have more percentage going to land costs in the total developmental cost versus a city like Hyderabad where labour costs will be higher. On an average, labour costs are anywhere between 15 to 30% of the total developmental cost for a real estate builder. And also, if we talk about cost X of land, it is anywhere between 20 to 25% of the total construction costs. Now, what would the impact be of these changes? Now, we spoke to Anurag. They indicated that labour costs would increase by 10 to 15% due to these new laws, and of the total developmental costs, it would mean an increase of 3 to 4%. Would the developers be able to absorb that? Not really, because their balance sheets are very stretched currently, and they will not take it on their P&L as well. And these costs will be passed on to the buyers, so there could be an impact of 3 to 4% on buyers' buying costs as well. We also spoke to Knight Frank, and they said that shortage of labour has been a serious issue in the real estate industry, and if these labour laws are implemented, there could be a massive shift. The labour shortage could not be an issue anymore, and it will be solved for this industry. However, he did indicate that yes, this implementation by builders could take more than a year, and to formalize this process as well completely. So this could be the impact of these new labour laws on the real estate industry, ultimately coming down to the buyer cost as well.
Well, that's right, Sonu. Let's bring in Shilpa now with what these rules mean for India's gig economy. Shilpa, what does it mean for platforms like Eternal, Swiggy, etc., and those who are employed by them?
Well, you know, these new labor codes, for the first time, they give all those who deliver our food, our online orders, and drive our cabs a formal worker status. Now, a gig worker has been defined for the first time as anyone working outside a traditional employer-employee setup, and a platform worker is someone who provides a service via an online app. Now, formally coming under the Code of Social Security, gig and platform workers will get life, accidental, and disability insurance, health cover, and maternity benefits, old age protection or pension, and a lot more. Now, they will also receive an Aadhaar-linked universal account number, which will allow them to access welfare benefits irrespective of which state they are in, removing the issue of migration as well. Now, a dedicated social security fund that will be financed by the governments, platform companies, and CSR contributions will be supporting these schemes. Now, this brings in a big change for platforms with a mandatory contribution of 1 to 2% of their annual turnover to the Social Security Fund, and it's capped at 5% of payouts that are made to these workers. Now, analysts estimate that this could increase costs for the like of Swiggy and Eternal by anywhere between 2 to 3 rupees per order, with an incremental burden of about 150 to 200 crores on their GMV. Now, Eternal and Swiggy already provide benefits worth around 1% of their revenue. Now, from Swiggy to Eternal to Uber, Amazon, others, all of them have welcomed these changes. Both Swiggy and Eternal say that they don't expect any material long-term financial impact and are strengthening their internal systems for compliance. Online shopping apps like Amazon and Flipkart are also evaluating changes required, and all these companies are engaging with the government as the final rules are drafted. Now, remember, what are all these companies? It covers all the major platforms: Swiggy, Eternal, Zepto, Amazon, Flipkart, Urban Company, Ola, Uber, Rapido, you know, every other online ordering platform that you and I use. Now, analysts expect that these companies will pass on most or all of the cost to us consumers because they're already working with very stretched, thin margins. So this could mean a slight 2 to 3% increase per online order that we make, and this will likely be added to an existing platform or handling or convenience fee going forward. But this will go towards giving a much needed social security benefits to the 40 crore plus gig workers that we depend on almost every day. Back to you.
Well, it is a large number and the gig economy is growing. Thanks very much, Shilpa, for joining us. And let's go across to Rima now and what these codes could mean for the IT sector. Rima, you've been speaking with companies. What's the likely impact?
Thanks so much for that. So the overall impact on the IT industry is not expected to be material. Now, even though the IT industry is one of the largest employers of the formalized workforce, more than 5 million people are employed in the IT and IT-enabled services, which includes BPO, and a large chunk of the IT services expenses, you know, some estimate 75%, some go as high as 85%, is on account of the wage bill. But the overall impact is not expected to be material. Where the costs could go up perhaps is on account of this mandatory health checkup for employees above 40, because IT companies, you know, some of these legacy old companies would have a sizable number of employees above the age of 40. But that other big change, where there is a mandatory PF-linked basic pay increase to 50%, is not going to impact the IT companies, because while it may reduce the in-hand amount for the employees, the overall cost to the company remains unchanged. So for a company, the CTC is not going to change. It's just the composition of the basic pay versus other allowances will change. So for an IT company, there is no impact on account of the basic pay increasing to 50%, unless they say that, okay, you know, the company, the employees are going to get less money in their hand and therefore we'll increase the overall CTC. And there could be a minor increase in the cost on account of the overall compliance burden, etc.
Okay, Rima, many thanks. So, sectoral analysis of what the labor codes could mean for employers and employees. Meanwhile, trade unions affiliated with opposition parties have criticized the notification of the 4 labor codes. In a statement, 10 central trade unions and various independent federations have called the move a deceptive fraud committed against India's working people. The unions have called for a nationwide protest on Wednesday and called on all members to wear black badges to their workplaces. On to a CNBC-TV18 exclusive. Royal Enfield plans to launch its first electric motorcycle by April next year. Parikshit Luthra caught up with the company's CEO B. Govindarajan on the streets of Goa to take stock of the brand's 125-year-old legacy and its future plans. Govindarajan said the 40% GST rate will deter Royal Enfield from investing in bigger motorcycles. He also said the bike maker plans to adopt a startup mentality to minimize the GST impact while it doubles down on exports.
The higher CC motorcycles, the era is slightly going off. I don't think people are really enjoying. If given a chance, even I won't enjoy that sort of a bigger motorcycles. And I want a motorcycle which has to be interacting with me. And I control the motorcycle and I enjoy the motorcycle. And that's why we said middleweight is what we will focus as a company. And the middleweight, our definition is 250cc to 750cc motorcycle. And currently we have 350cc, 450cc, 650cc platform. And I do believe strongly that even this market can grow because premiumization in India is the thing. And we are by far the motorcycles which is very accessible price point which we have brought in and gorgeous looking motorcycles and everybody is loving. And I do see there is a good growth even in this platform which we can bring in for future.
Well, that's Royal Enfield on their launch plans. Here's another exclusive this evening. After 6 quarters of margin expansion, Tech Mahindra CEO Mohit Joshi expects business transformation to be completed in FY27. This as the heads of 14 group companies came together on television for the first time at their annual Investor Day. Speaking to CNBC-TV18, Joshi also said the company will prioritize profitability, delivery optimization and scaling of AI services. Take a look.
Very confident and we're completely committed to our F27 goals, and then beyond that, we'll sketch out a vision for for the next 3 years.
Yeah, so give us a glimpse of what the vision for the next 3 years could potentially look like.
I left my crystal ball at home, unfortunately.
You don't need a crystal ball. I'm sure you've got a vision board that sets out those numbers for you. But Mohit,
I'm not going to. So look, I think the thing is right that I don't want to start manifesting my FY30 vision over here, but. I do feel that, look, the first part of the journey has been about becoming world-class, right? Really a catch-up with the peers in terms of growth, in terms of margins, in terms of deep capability, while building on the strengths of the company. FY30 is going to be about becoming world-beating, right? How do we figure out what are the things that we do exceptionally well, and how does that start to show up in our financial results?
Well, that's Tech Mahindra, and time for us to take a break. But up next, India and Israel are set to fast-track the first phase of free trade agreement. Commerce Minister Piyush Goyal has said both countries have agreed to focus on getting sensitive issues off the table. That and more when we return. Prime Minister Modi met Canadian Prime Minister Mark Carney on the sidelines of the G20 Leaders Summit in South Africa. Both leaders have agreed to formally launch negotiations for a comprehensive economic partnership agreement. This agreement will include goods, services, investment, agriculture and digital trade. Modi and Carney expressed confidence that the agreement will help more than double bilateral trade between the two countries to $70 billion by 2030. Commerce Minister Piyush Goyal is upbeat about a trade deal with Israel. The minister is in Tel Aviv, where both nations agreed to the framework based on which the negotiations will be held. Speaking to our colleague Abhimanyu Sharma, Goyal said the discussions will focus on increasing investment, R&D and partnership in the agriculture sector. Take a look.
Yesterday, I had very extensive discussions with my counterpart, the Honourable Commerce and Industry Minister. And we have both agreed that we will focus on low-hanging fruits, get the sensitive issues off the table on both sides, look at how innovation and R&D can drive greater investments in each other's countries, work at joint projects where we can leverage on their skill sets, they can leverage on the economies of scale that a large market like India gives, whether we can do infrastructure projects or provide them youthful, skilled and talented manpower to support the Israeli economy. So it's a very multifaceted partnership that we are crafting with Israel. And it's quite possible that we may come out with a first phase of an FTA so that we can kickstart the benefits faster.
Are there any actionable insights from the meetings which you had with several leaders and the meetings you are slated to have with several leaders? Any targets being looked at with respect to mutual investment opportunities and with respect to other opportunities with respect to manufacturing?
Well, I've met their finance minister and we are looking at a joint protocol which will help encourage import and export of goods and services from each other's countries. I've had very good meetings with the agriculture minister, who's a very, very good friend of India and is looking to expand relations on the agri field with India. I'll be meeting their senior leaders tomorrow to further discuss how this partnership can be taken to the next level. All in all, I think the country, the people of Israel have showered a lot of respect on the entire business delegation that came with me, and I see tremendous potential in this partnership going forward.
So a final question now. Several FTAs India has already signed with developed economies. Are they going to serve as a template for future FTA negotiations? Because as you indicated earlier too, several red lines cannot be crossed. So all FTAs which are being negotiated with different economies, be it the US, the EU, or even the Mercosur for that matter, or GCC, what kind of targets can be looked at? What kind of timelines can be looked at in near future?
Well, there are always red lines, there are always sensitive issues, but every agreement stands on its own ground. Every agreement has its own positives, benefits, and you really create a balance at the aggregate, considering all aspects of a relationship. Keeping that in mind, we decide what would be included in an FTA, what would not be included. What may be sensitive for one country may not be sensitive in another country. There are many products that are desirable for us to have in India at low cost for our own economic growth and development. So it's on a case-to-case basis. You have to decide what you will open up and what you will not.
Well, that's Commerce Minister Piyush Goyal in Israel. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more.
Hello and welcome. You're watching Commodity Champions. I'm Manisha Gupta, and today we have a very special guest joining us right here in studios. Praveena Rai is MD and CEO at MCX. Ms. Rai, hi, thank you so much for coming by. And it has been a great year for you, year 2025. I mean, if I look at the numbers, it has been the biggest ever turnover that we've seen, an average of 4.11 lakh crores. What really has led to these very strong numbers?
Yeah, the numbers are very exciting, and it's wonderful to be here, Manisha. I think we've actually practically quadrupled our numbers. So last year we doubled from about 1 lakh crore to 2 lakh crore, and this year we are already looking at 4 lakh crore as an average for H1. And I think this is really on the back of some tremendous work in the market. There has been a slew of launches, especially in the bullion segment, and these have been products that were created specific to market needs. And when the market requirement really cropped up in the last few months, it's played an important role there. We've also seen very active participation. So on the back of the larger macroeconomic trends, how India is doing, I think it's really the market participants who've also stepped in, and we are seeing higher levels of participation that our teams are also very heavily engaged with.
Well, yes. I also have your numbers in front of me. And when you look at the second quarter and the first half numbers, it shows strong growth, revenue, EBITDA, PAT. What really is driving all of these numbers, and how much of that really is structural?
So, we are growing at about 40% on the operating revenue side and 50% odd on the EBITDA side. This is a result, of course, of first and foremost the headline numbers we spoke about. But behind that is also all the enabling factors, right? The strong technology, the strong compliance framework, and certainly I would say the factors around the macro trends, right, that really drive the fit for purpose across all segments. So the energy segment is a strong one, continues to do well. The bullion segment, which has been a strong segment, has really performed above par. And the metal segment, has also, we are looking at sort of doubling in some of the metals there. And agree, while it's a much smaller space, also does its own role being fit for purpose there.
Electricity futures is another introduction that you've done in this year. We do understand that it is a long gestation product. How much of a readiness do you see in the markets for that, whether it is from the retail or the company part of it itself?
So electricity is something that we absolutely need in India. If we look at global markets, be it US, Europe, Asian markets like Japan, it's one of the new emerging commodity sectors across all markets. This product has been designed taking into consideration the requirements we have in India. The renewable sector is growing. In fact, I think we are really beyond plan when we look at the policy numbers on where we need to be for the renewable sector. So all of this comes together to say that this product, is a requirement for the purpose of hedging across producers, consumers, and the entire value chain there. So we're seeing strong interest. The momentum is right. It will take some time because it's about, financial players understanding electricity and electricity ecosystem, looking at hedging. A lot of internal corporate and governance enablement activities are also in play. We are looking at an average ADT nowadays of about 40-50 crores. Okay. And I think within 3 months of launch, these are good numbers. So I think we are positive that the product is designed for market. It's simple, easy, works on what we call the day ahead market prices, with a lot of data, back data, coming from a very established spot exchange reference. And all of this makes it good in terms of how it will play out in the long run.
But it isn't gold and silver and copper. I mean, it's slightly a difficult product in that sense and a market too. How long do you think and how much time are you giving yourself or your team to ensure that it reaches a point or a target that you would have envisioned?
It is very different from the other segments because they are tightly correlated globally, right? They are related and correlated, primarily because we also tend to be an importer in many of those segments. Electricity is ours, we produce it, we consume it, right? So it's really about India as a market and how that gets created. So it will take a little bit more time than what the other sort of segments have taken. But it's something that we need as a country. And I think we are positive about it. So we'll see these numbers certainly look much better by the end of the year. And I would say that within 2 to 3 years, we should see it starting to make its presence felt in the portfolio.
When you talk about electricity and there are various other products, that the conversation has been about whether it is about weather and renewables and carbon credit as a market as well. Is that something MCX is looking at actively too?
There will be a number of related products for sure. And I think I don't want to comment on it because we are looking at a pipeline of products. So, we spoke about what we've done on bullion with gold and silver, the new sub-products that have been launched across the spectrum. In the energy vertical, we've launched electricity in addition to crude oil and natural gas. If we look at metals, we've done a relaunch on nickel because that was a very liquid and successful product in the past till there was a global situation during the COVID time. So that's something we've relaunched, taking a lot of feedback from the market on how that needs to be designed. And then looking at agriculture, where we've launched cardamom, so which has its own niche space, but very important for the spice segment and, the players there. So I think these are going to be very important factors here.
So can safely say that there is an array of newer products and commodities that are in the pipeline that MCX is looking at?
Yeah. So I think these are examples of what we've done. There is a healthy pipeline and timed well, paced well, looking at when the market is ready. These will all come to market slowly.
Talk to us now about a difficult subject that you had to go through in the month of October, 28th October. And while you did continue to send out communications on what was really happening around that, but take us through on what really conspired and how have your communications with the regulator been on this right now?
Yeah. So I think if you look at context, right, and I'll just spend a few seconds on that. Our volumes and, we spoke about quadrupling of throughput. And similarly, over the last 2 years, there has been a quadrupling of volumes as well, right? When you look at parameters like orders per day, orders per second. So MCX has been continuously investing in technology because we can see the momentum, we can see the growth, and one has to be prepared for it ahead of the curve. And what really has happened is not really the headline sort of numbers that we look at, but one of the parameters, the parameter definition, that created this bottleneck. So it created a threshold, unexpected, unanticipated, which created the issue that day. So it took our team, and I would say, thanks to good efforts of a lot of trial and error that happened that day, that really led to the identification of the problem on the fly and a resolution in the time it took. Needless to say, it's not something that we want to happen again. So there are some very strong measures we've taken, in addition to all the work that we do on technology. So if I just run you through them. So first and foremost was the root cause analysis that got done immediately. I think by within a day or two, we knew what it was and we communicated that as well. In addition to that, we've also gone to market and we've brought in a third-party assessment of the root cause so that in case there's something getting missed internally, it gets picked up. So that is also completed and it has corroborated the root cause that was identified earlier. The next step is to say, hey, this is looking at the root cause, but why don't we actually put the whole system through a testing so that with real volumes, we are able to identify any other such threshold parameters. So that's something that is currently in process, will get completed very soon. The third is to look at a sort of expert panel along with third-party assessors to have a fresh look at where we stand from a scalability and resilience standpoint. So yes, the platform has been continuously upgraded to come to where it is today, but we have to make sure that it's fit for purpose as we look at scale going forward. And I will say, as we continue to invest in technology, the most important thing is the voice of the customer. And in our interactions, and we've had a number of interactions with our stakeholders. Most important stakeholders are our members and participants. So what I heard is, you have to be ready for 10x, right? And I think that was really a rallying cry.
A ringing thing, huh?
Yeah, and I said, and I think all of us agreed within MCX that I think that really is our goalpost now. So I think we are going for 10x, and we sort of ballpark numbers looking at something like maybe 10 billion orders a day. So that's what we're getting prepared for now.
Yes, as you said, your conversations with the industry, the stakeholders, the intermediaries has been on the positive side. But having said that, there were always also various statements saying, or, memes and WhatsApp messages suggesting, oh, the exchange isn't working. Maybe you can go to another exchange. MCX is perhaps 98 to 99% of what it does in this market share. Dealing with that day wouldn't have been easier. What have your also been engagements with this year? That's another thing that the markets are very, very curious about.
Yeah, so I think first and foremost, engaging with our participants, right? And we spoke about that. I think that was super important, and we've given that top priority.
And they've stuck with you all these years.
Yeah, I mean, they have stuck with us, and I think we are very happy and privileged to be part of that, ecosystem. Now, as far as the regulator is concerned, there are some processes. There are methods and timelines within which certain submissions have to be made, and so on and so forth. So all of that will following process, and will sort of play out in due course.
What has been the engagement till time? What is it that is going back and forth with the regulator on that?
I think those are part of the standard, SOP discussions. And I think pretty much in line with whatever I have explained till now.
You also earlier spoken about the 5-point mitigation plan. What are the key actions therein? What is it that you're looking at in sense of capacity building? You talked about 10x there. What work is being done there? What are the other timelines that you have in place?
Yeah, I think this is the 5 points that I mentioned some time back. And when we look at timelines and we say, look, we want to target to 10x, 10x may not be like a single short jump, right? So probably it's going to have 2 or 3 milestones. If I look at very headline numbers, and we've sort of quadrupled in the last 2 years. So if we say, hey, if I look at that as a potential run rate, and there could be best case, there can be like a better case, and so on and so forth. Looking at all of this, I would say we should look at a first benchmark in about 12 to 18 months as a milestone, and in 2 to 3 years, really be at the kind of levels we're talking about now.
I also want to talk about other products. The other launch that you had this year was Buldex, and a great year to have it because the gold and silver prices were doing best what they do. Very volatile, best year, all-time highs into that one. How are you looking to sustain it in a year, perhaps next year itself, when we may not be looking at that kind of volatility or price moves for that matter?
I think the commodity sector is at an early growth phase. When we look at global markets and we compare to where we are in India, we're still at an early growth phase. So I think when we look at the kind of products that India needs beyond what we have today, and when we look at the kind of participation that is also available and required, the measures to bring in more commercial corporate participation via hedging. If you look at all of these, so yes, there is a headline macro parameters that will always play a role, but across 4 segments and the product and participation, I think we are in a good place.
All right. Mr. Rai, please do stay on with us. We have to take a very quick commercial break, but we'll come back and we'll talk to MCX MD Praveena Rai on her plans going forward on how do the next 3 to 5 years look, what are the visions from here, and especially what is the next year looking like in 2026 after this very short break. Welcome back. You're with us at CNBC-TV18. We have with us in our studios Praveena Rai, who's MD and CEO at MCX. Mr. Rai, we spoke about gold and silver, and you spoke about metals as well, on how they have done quite well in sense of consolidations. The efficiencies are building great, and you're looking at participation coming in on the stronger side there. What is it that you're looking at to growing from here on when it comes to the existing products? We've seen you introduce more financial products within the instruments itself, whether it has been about quarterly, monthly, options also. What is it that you're trying to do now with the existing commodities? Where do we go from here?
I think our existing commodities are doing well. For example, one of the steps we've taken on metals, hearing the feedback from our market, is to consolidate warehouses, right? Because there are some challenges around GST when you have multiple warehouses. And this is more about procedural challenges. And it's important that the warehouse is located for suitability of supply and consumption. And we have data because these have been around for a while. So we've really looked at where it matters, taken feedback from the industry, and consolidated. So for example, in copper, there is a single warehouse now in Thane. Same with zinc, aluminum, etc. So they've also been consolidated. Some warehouses which were not required have been reduced. So we've looked at a difference between the trading unit and the delivery unit with the new nickel launch. This will make sure that there is access and availability reach for the small, medium sector participants for whom large sort of capacity is not either required or affordable. So I think these are some of the steps that we've taken when it comes to the metal segment. And similarly, work is on across all the segments. I think we are very fortunate to have participants, members, great teams, within MCX, all of whom understand the domain very well. And I think that's when the magic happens, when they all come together, and that's how the creation will be. So I think it will be a co-creation exercise. It will be a consultation exercise. It will be a collaborative exercise.
Okay.
And so we may have some theoretical ideas, looking at commodities and product design based on scale, based on volatility, based on global studies, based on what we think India needs. But ultimately, it will be the coming together of all of this that will answer this question of yours.
So there are three P's really, prices, which you won't talk about, and products you have spoken about. The third really is about participation. How are you looking to deepen that one? Because if you look at SEBI regulator, and he's been talking on various forums, he's talked about pension funds perhaps going to be allowed in commodities. There has been conversation about on how we can perhaps be price makers and not price takers. A lot of conversation really going around. How are you looking at that part? And the second, of course, is about hedging mechanism, allowing or enhancing or ensuring that you have SMEs and MSMEs being part of this.
Yeah. No, I think let me pick up on the price benchmark first, right? Being price makers, that's very close to heart, very close to my heart. Because in India, if you look at, for example, bullion, pretty much, I think MCX gold prices, for example, are the
benchmark right
now. They tend to be used across the industry, so on and so forth. But we do still have international benchmarks, right, getting used within our industry as references. So I think there's been a consultation paper. Of course, we've given our input, so has the industry, and we are looking for some of that to play out. And I would think bullion is a starting point, and we should be looking at this across the spectrum. Because when we look at international prices, ultimately India prices are, duties and sort of logistics, but ultimately there is a India demand supply element that comes in that creates that premium discount. So no matter how correlated we are with international markets, there's nothing like creating our own price benchmarks. Your question on participation, there is scope for expanding participation. Today there is good participation when it comes to proprietary firms, when it comes to HFTs, when it comes to traders who are trading on various commodities, when it comes to retail. The scope, right, to really expand participation across many other segments who are extremely active on the equity side is strong. And we see that working globally, but it's also a big and important opportunity for India. It will have to happen in a calibrated manner, looking at what are the rules and sort of frameworks within which they have to operate. So I believe that we'll be looking at some, we hope that we'll be looking at some positive momentum there.
When it comes about participation, it also is not just about the smaller hedgers, it's also about corporates and hedging mechanisms that are being created in India. We still do know that after so many years as well, there are big corporates which still are hedging outside the country. While there is a law, and of course they have to now tell on what are they hedging and how much, and whether or they're hedging or not to begin with. But how is the exchange really looking at policy and framework changes within that?
Yeah, I think it's very important that the platform becomes more and more relevant for large hedgers, while they may be hedging smaller components. And for that, I think if there is some sort of incentive mechanism that can be created, that would be wonderful. Certainly cost of hedging in India, straightforward in the rupee, without all the currency, hedging, et cetera, is a no-brainer.
Right.
But change is always a transformation, and I think we will see that happen step by step.
How are you looking at the growing curve for MCX from here on? What is it that Praveena Rai is thinking about for the next year, 2026, that is a near term, and then a 3 to 5 year as a horizon?
Yeah. So I think 3 pillars, and I speak about them all the time. Number 1, the solid foundation is the compliance and regulation. So our own compliance as well as the integrity of the market that we operate. On that bedrock is really the enabling operating framework. So operational excellence, we spoke about investment in technology, our vision for how we want our technology to work and where do we see that being an enabler for growth. And then finally it comes to products and participation. We spoke of products, we spoke of participation. Yes, we will be looking at a pipeline of whatever is required in the commodity space. We will be looking at, also looking at capacity building when we look at participation, because that's going to be very important across the industry. So these would be, and capacity building, I would put it in that little longer time frame. It's not a immediate activity, but these would be the simple actions, and the devil is in the details, and it's all about execution. The shared purpose, and I come back to the point about shared purpose, and I hear it all the time. So I think to have an industry which has that shared purpose, our teams, who are really passionate about making this happen, we'll have to execute this through.
Also, Ms. Rai, when you look at overall commodity markets in India, it still is a very niche product, would you say? It's been around for decades now. And yes, it still is at an infancy, if you may say so, as compared to the other financial instruments and other financial markets, though. But where do you see overall commodity as a market growing from here?
Commodity as a market is in its early growth phase. So yes, we've been around for a while, but sometimes you have to wait for the time to come, right? Where our markets have matured. So there is now a sort of diversity of participation that is available. And between all of this, growing interest in the commodity space, both as an investment asset class, as well as from a hedging standpoint. And I think that's really where this is coming together now. The timing is right.
The timing is absolutely right, especially when given the fact what we've done in 2025 and 2026 seems equally promising when it comes to commodity as a segment, not just India, but in the global markets as well. Mr. Rai, as always, thank you so much for coming by in our CNBC studios and having that conversation. Appreciate your time.
Thank you.
And with that, that's all the time that we have on this segment of Commodity Champions. Thank you for watching.
Hello, welcome to News Center. The big story this evening, India has a new labour law regime in place. 29 colonial-era laws have been repealed or rationalised into 4 new labour codes. The stated aim is to modernise the legal framework, extend social security to a wider workforce and ensure universal wage protection. However, trade unions affiliated with opposition parties have announced nationwide protests. So how do the new labour codes change the landscape? Let's focus on some of the big changes. First, the central government will be fixing what it calls the floor wage, taking into account minimum living standards across geographies. The states, however, will have the power to fix the minimum wage rate, which shall not be lesser than the floor wage fixed by the centre. Second, and this has been a major bone of contention for trade unions, the law gives smaller companies more flexibility when it comes to laying off workers. Companies that employ more than 100 people needed government approval before layoffs. That threshold has now been increased to companies that employ over 300 people. Third, the gratuity eligibility timeline has been eased as well. Fixed-term employees who have completed a year of continuous service are eligible for gratuity. Earlier, the provision mandated 5 years of service. It also has a new code to give gig workers legal recognition. This had been a long-standing industry demand. Platform companies could see limited short-term financial impact. Another interesting policy change is the introduction of night shift for women, provided they can give their consent, and adequate safety measures have to be put in place for women. This ensures that female workers have equal opportunities to earn higher incomes in well-paid roles. In addition, there is now a mandatory requirement for women representation on grievance redressal committees. Meanwhile, several trade unions have protested against the codes, calling them anti-worker and pro-employees. In a statement, 10 central trade unions and various independent federations called the move a deceptive fraud committed against India's working people. Joining us to take this discussion forward is Jyoti Vij, Director General of industry body FICCI, Ramani Datti, CFO of Teamly Services with us, and Pooja Ramchandani, Partner, Employment and Labour and Benefits at Shardul Amarchand Mangaldas. Let me go across to Jyoti Vij first. Jyoti Vij, do you feel this helps the ease of doing business? The industry had always spoken about the need for labour law reforms, but does this come as a benefit? Is this going to help working in India?
So, good afternoon, everybody. So this is a very balanced act, what we have studied. It does, of course, bring in the ease of compliances. It uses the technology for surveillance. It does have decriminalized a lot of provisions, etc. So I think to that extent, there is a lot of simplification, ease of doing business, decriminalization for the industry. But at the same time, I think there are a lot of good things which have been done for the worker welfare, for the worker safety, for their safety and for their social security as well. And I think that brings in kind of a holistic a labor law which has good for both employees and employers going forward. Even for, you talked about the women worker, but I think one of the biggest one is for the gig workers, given that India has a large percentage, almost 90% in the unorganized sector. Gig worker, the platform worker bit is only expanding. Going forward, it's going to be a very important one. So bringing them into the organized fold, getting all the informal worker into the organized fold, into the social security network, I think that's a very big one. And that will give a lot of credence to our employment numbers going forward.
Right. Let me also go across to Ramani Datti, CFO of Teamly Services. Ramani, if I were to ask you about what happens to your take-home salary? Does the take-home salary now come down? Do expenses of companies, when it comes to retirement benefits, gratuity, provident fund, does that increase now?
Many of the companies over the last few years have already corrected their CTC structure to align with the indicative labor codes. So many of the large organizations have already increased the PF contribution up to 50% of the total CTC. For those companies, there may not be any significant change in the CTC structure or any reduction in the take home of employees. But having said that, that's a very small percentage of companies that we are talking about, especially the MSME segments and startups and other organizations where they have capped the PF contribution. So there can be a significant reduction in the take-home salaries of the employees, both on account of PF and gratuity incremental provision. The companies may also have a higher CTC impact on their P&Ls. The short answer, yes. So there can be an impact on the take-home salaries.
All right. Do you also believe that there would be certain aspects of these labor code which will be difficult to implement, and you would want to seek some sort of clarification from the government, especially points related to overtime work?
Yeah, not just the overtime work. In fact, since labor is a concurrent subject, which is governed by both central as well as state laws. So while these 29 central laws have been codified into these 4 codes, how are the states going to have the operational framework to implement these labor codes is also a big question, because in India, many state laws are different, be it across minimum wages or ESIC and many other regulations relating to labor laws. So how would the framework work? Because will all states go together, or will there be a staggered implementation across states? How long it would take? So at this stage, we are seeing this as a primary issue in terms of overall clarification on implementation of labor laws. And also, as you pointed out, on overtime computation, how it is measured and how it is computed. So even that, on that part, we need more clarification. We are expecting that in the subsequent notifications from the government.
Right. Let me also go across to our other guest, Pooja Ramchandani from Shardul Amarchandas. Pooja, when it comes to setting a floor wage, how difficult is this exercise going to be? And how do you think the centre can come to a conclusion? And do you think this floor wage will have to be annually revised?
Thanks, Parishit. A very interesting question. So setting off the floor wage is going to depend on various factors such as, the geography, the demography, and what is the earning capacity and the extent of consumption per family. So these are the aspects on which the government is going to look at to, look at what the floor wage is. There is a possibility that this will need to be revisited depending on how things move forward. It's an evolving world that we live in. Expenses are increasing, and that's something that one will have to keep in mind going forward. And I believe that the government will probably go back every once in probably 5 years, if not shorter, to look at where things stand in terms of floor wage, as that forms the threshold for the states to prescribe their own minimum wage.
That's true. Let me go back to Jyoti Vij once again. Jyoti Vij, from an industry point of view, are there certain clarifications that FICCI would seek from the government? These new codes would, of course, have some impact on companies that employ gig workers, because you have to now give higher social security benefits as well. Are there certain clarifications that you're seeking? Jyoti Vij, you're on mute.
So while we'll go into the nuances of the, the details of the act codes, but FICCI was the one which had propagated the need for having social security for the gig worker, for the platform workers, etc. We worked extensively with the government to kind of, look at this aspect. We've also talked about it at the international platforms, etc. So there's been a lot of work we have done along with the platform operators to see that, this is something which should be considered and be brought into place. So I think it's a very positive factor. That's how we have seen, because this will, like I said in the beginning also, it will help in formalization of the workforce. I think there are a few areas where probably we'll also look into, some clarifications, like, Pooja also pointed out on the minimum wage, etc. Across the states, is it going to be differential? But obviously a floor has been set. So that much kind of, is very clear. And many aspects of these were known to us. So, we've been working on it for a while. And hence we see that, we're almost kind of ready to adopt this and go forward.
All right. Pooja, if I were to ask you about the ripple effect of this, are these codes going to impact all sectors uniformly? What about those in the unorganized sector? What about those working in construction sites? What about agricultural laborers for that matter?
So yes, the code is going to impact across sectors. And if one looks at, the 4 different codes, what it does bring about, which is new, is that it talks about social security for gig workers, social security for unorganized sectors. While there was a law on unorganized sectors and their welfare benefits, which has been subsumed here, by virtue of these codes, there will be an impact in terms of the types of welfare schemes that the government proposes to put together. There will be provident fund for unorganized sector workers. There will be welfare schemes in terms of insurance, accident benefit, pension even for gig workers. So in terms of unorganized, there is a whole stream of schemes and welfare measures that the government is looking at for the first time for gig workers. If you look at different industries and how it's going to have an impact, with the increase in these thresholds in terms of, the number of workers required in order to, retrench or close a factory, that has increased, as you mentioned earlier on, from 100 to 300 under the codes. Now, that is going to impact, those who fall under what is currently Chapter 5B of the Industrial Disputes Act and will find its way into the Industrial Relations Code. Where this number has increased for factories, mines, and plantations primarily. This is the number threshold that required an approval for the government, but not the non-manufacturing sectors. So now, with this increase in the threshold, restructuring would become a little more easier for the employer. In terms of, employees, one has to look at it from the perspective of what benefits that comes with any sort of restructuring. The employees, as usual, are protected. There are retrenchment compensations that are given. There are other measures which organizations already take when there are restructurings. So, as to answer your question, ripple effect, yes. Across industries, yes.
All right, we're going to take a short break at this point, but we'll request all our guests to stay with us. Lots more on this. This is a very important topic for India's workforce, and clearly we will be putting all those questions we've been getting through the day to all our guests. Stay with us. We'll be right back. Welcome back to News Center. Still with us are Pooja Ramchandani of Shardul Amarchand Mangaldas and Jyoti Vij of FICCI and Ramani Datti of Team Lee Services. Ramani, if I can ask you about the minimum working hours. Now, the working hours remain capped at 8 hours per day, 48 hours per week. Has anything changed from previous clauses in the labor laws about minimum and maximum working hours? And if you were to work beyond that, do companies need to compensate that mandatorily?
Yes, Parikshit, as per the notification that we currently have, so there has been a flexibility that has been brought in terms of overall weekly number of hours of working that has been increased from the current level, which is 40 hours per week to 48 hours per week. But at the same time, for any overtime over and above this 48 hours, the minimum wage to be paid has been 2x of the base wage. Earlier, under different provisions, it was 1.5 times of the wage or 2x in certain cases. But now it has been streamlined that it would be 2x of the base wage for any overtime hours that are being spent.
Right. But Pooja, do you feel that this is going to be impacting all professions? What about doctors for that matter? What about those working in the electricity sector, in the power sector, essential services, police, media for that matter?
Right. So I think the first thing to know is that overtime is for, firstly, someone who is an employee. Second is that what the code says that every employee for which employment minimum wage is fixed, minimum rate of wage is prescribed by the government, would be entitled to overtime. So these are two factors that we have to keep in mind, which is slightly different from what the current law is. If I talk about what the current law is, the overtime is prescribed under the Factories Act and the Shops and Establishment legislations. Shops and establishment legislations across many states exclude those in managerial and managerial capacity and supervisory capacity and those occupying positions of confidence. So entire sector of classification of employees are outside the scope of the shops and establishment, which prescribes overtime. Now, here, when we come to the labor code, we need to see how the minimum wages are prescribed. I would, take a cue from here that very senior management level or CXO level employees would still be out of this scope because historically, as we see that, minimum wage, when it is prescribed for skilled, unskilled, highly skilled and such. And that's the way the code also has sort of prescribed different category of employees, at least, when we look at the draft rules, which might, be out for circulation again.
All right. So that will be possibly a clarification that we will need. But let me also go back to Jyoti Vij. Jyoti Vij, now that this labor code has been implemented, there are 45 days for the industry to start implementing. The government also has to notify the rules. What more do you think can be done by the government to make labor laws easier to work with for the industry? Because the focus of the government right now is to think about how to make it easier to do business, how to open businesses easily, how to shut down businesses easily. Would there be any further recommendations here on?
So I think the rules have to align with the overall codes and the legislation. So I think it's very clearly laid out that we are looking at, decriminalization. So exact provisions around that is something which we will be working with them. And then, of course, the tech-driven inspections that they're talking about, which brings in a lot of ease of doing business, which wasn't there, before, which means a lot of trust-based regime, which is kind of, being envisaged or being worked upon under the labor code. And, we also need to stay, again, what Pooja also said is that the alignment with the states on these rules, because while the basic code will be provided, since it is also state subject, what kind of rules will emerge at the state level? I think that's where we probably need to work a lot and understand, the commonality across, and hopefully, the implementation will not get, impacted by different rules at different states. So I think that alignment is very important from the industry point of view to have the real ease of doing business being enabled.
Right. And Ramani, if I were to ask you about how difficult would it be to implement? Yes, states have their will have some legal leeway to make modifications, make changes, or work according to their wishes. But, for example, issues such as pay parity for women, gender parity or in wages, would there be certain guardrails, certain penalties to ensure that whatever is written in the code is implemented in letter and spirit?
Yeah, we have to see the guidelines on how these things have to be implemented. But my understanding is that as long as the company or the entities are giving equal opportunities, irrespective of gender, and maintaining pay parity, so I don't think that would be, again, construed as any kind of deviation. But the main issue in terms of implementation would be the huge increase in costs for entities who are currently not complying or who are way below, especially in terms of PF computation and gratuity provisions. So there can be a substantial increase in their overall labor costs, especially if we take MSME segments or the industries or sectors which hire a large number of unorganized labor. What I mean by unorganized labor is any workforce which is not fully compliant with all the 44 labor laws, 29 central laws, as well as the rest state laws. So for those workforce, there will be an increase in labor costs, maybe up to 20 to 40% as well. So how are these industries and segments going to absorb this increase in cost? Are they going to pass it on to the employees? If that's the case, there can be a drastic drop in their take home. So these are the nuances which are much more difficult to deal with at ground level.
Right. And finally, let me go across to Pooja. Pooja, now in the next 45 days, what are some of the changes that companies will have to implement? And from an employee benefit point of view, what are some of the enhanced benefits that employees could see in terms of greater contributions towards PF, gratuity?
Right. So let me start with what, companies would need to go back. So first and foremost is to look at, the wage and the remuneration structure. The CTC, as, Ramani also mentioned, that will need to be re-looked at, and one might need to go back to the drawing board to see what's the cost impact. Given the change of the definition of wages and it being uniformly now used across all 4 codes, which was a little fragmented in the current legal framework, this impacts how one is going to calculate gratuity, provident fund, ESI, bonus, and leave encashment. These are your main statutory payouts. For those, who have been calculating provident fund as per the, definition of basic wage under the PF Act, I think there is not much movement there because you are either already calculating it in the right way, which is within, the definition of wages, or like a lot of companies do in terms of provident fund, they base it on the minimum threshold of 15,000. So there again might not be as much of an impact for those who are already complying with that. Now, when we look at bonus and leave encashment, or even retrenchment compensation, speaking academically, one needs to look at the gross wages. Now, there, I think market practice has been a little varied, where, organizations have focused on only basic pay, and that may then change going forward. One will have to look at the definition of wages, see whether you meet the 50% threshold. If not, one plows back whatever is the excess from the from the allowances, and that's the reason why one goes back to it. So that's the first thing. Right. Policies, of course, processes, HR processes, of course. So these are few other aspects that, companies should start looking at immediately.
All right. Thank you very much, Jyoti Vij, Pooja Ramchandani, Ramani Datti for joining us on the program. A very important issue, and of course there will be more clarifications in the days to come, and the government will be engaging with the industry before the final rules are published. With that, it's a wrap on this edition of News Centre. More news and updates continue right here. Hello and welcome to CNBC-TV18. We're joining you from Goa, where Royal Enfield is celebrating Motorverse. At Motorverse this year, they have unveiled 4 new motorcycles, the Bullet 650 and also the electric Flying Flea Scrambler Edition. The company's had a very strong and record second quarter. To know more about Royal Enfield's strategy going ahead, we will be joined by Eicher Motors Managing Director and Royal Enfield CEO B. Govindrajan. Govind is here with us. Hi, Govind. Good to see you. I'm glad we could do this.
Pleasure meeting you.
And looking forward to chatting with you.
Welcome to Goa. Welcome to Motorverse, Royal Enfield's annual motorcycling festival. Parikshit, I suggest before we start, why don't we take a spin? It's a motorcycling company. I'm sure you'll enjoy.
Why not? I see you've got 2 motorcycles already.
We have Goan Classic and your Meteor 350. I'm sure you can choose any motorcycle which you are comfortable with. We'll just go for a spin and then we'll come back and start talking about it.
I think great idea. I'll choose the Cruiser. Let's get ready. Let's put our jackets on. We'll take a quick spin and come back.
Come.
All right, let's start.
Stop.
So we are at the Waggator Hilltop, where Royal Enfield is organizing its annual motorcycling extravaganza called Motorverse, and Govind is with us. Govind, 125th year of Royal Enfield. You're entering into your 125th year. Could you give us a sense of the vision going forward?
See, Royal Enfield is the oldest motorcycle brand in continuous production for the past 125 years. Very few brands can actually climb. Over this 125 years, this brand has gone through a lot of challenges, some seminal moments, but yet it withstood all the storm and became very successful. Primarily, we started making motorcycles in the middleweight segment. That's where the focus is. As an organization, we had a choice at a point of time what sort of a motorcycle we have to make. We took a decision and we said that less is more. We won't do too many things. We will focus on middleweight. And continuously we have been doing it. So at a point of time we were making 4,000 motorcycles per month. Currently we make almost 4,000 motorcycles per day. And last year we crossed about 1 million motorcycles. So that has been a success story for Royal Enfield. What is that? It's built based on what? It's built based on our understanding with the community and ride with the community. We are riders, myself, Siddharth, we all ride, and our top management ride. So we ride with the community, learn from them, come back, go to the drawing board, design the motorcycles, make the motorcycles, ride, test it, take it back to the community. That's what it is. In fact, the Motorverse is our annual motorcycling festival. We do every year. In fact, this year we had, if I'm right, about 35,000 plus footfall. And this is a place where we celebrate motorcycles, customs, art, music. That's why every year we make it bigger, better. So that's the Royal Enfield as a DNA. From here, what do we see? We do see the motorcycling culture, which is getting built, and we are an evangelist in a way. We want the motorcycling culture to spread across the globe. In India, in fact, we have been very successful, and we hold a market share of almost about 89% in the middleweight. Outside India, we are holding a market share of almost 9% in the middleweight, but still we see there's a huge scope for us to create one more success story, what we have created in India.
What's going to power the growth? What's going to be the goal for the next 10 years? What would that be?
In my understanding, Parikshit, I think motorcycling as a culture, it is growing. And the motorcycle which lends itself for a particular usage, for us, it is all about the motorcycle as an ally for the rider, and it's a self-expression. That's continuing. And as of now, I do see the motorcycle industry will continue to grow in the near future. Currently, it is growing almost about some 7-8%. In fact, we have been growing. Even last quarter, we grew almost about 45% compared to last year. And in the whole H1 level, we grew almost about 27%. So our growth also has been good. And I do see the growth momentum will continue. But the powertrain may change. You know, technology disruptions are taking place. Consumer preferences are taking place. The preferences can be on the technology of the powertrain or the way the retail takes place. So as an organization, we are always proud to say we are a 125-year-old startup mentality company. And we are very agile. We enjoy that because fundamentally we feel, you know, we have to continuously improve. And as an organization, we won't mind in doing pilot, failing, and then going back, correcting it. That's what we are. We don't have anything solid to say we are a corporate. We won't do it. We are not that type. We would like to be a company which is very agile, listen to the community, understand what the community wants, and be part of them and provide solution to what exactly they're looking for.
What about bigger bikes? Is Royal Enfield ready to bring out those bigger high-capacity bikes like the likes of Harley-Davidson, BMWs, Triumphs have in global markets, 800, 1000cc motorcycles?
You know, if I had to put myself as a rider, I would like to be looking at the higher cc motorcycles. The era is slightly going off. I don't think people are really enjoying. If given a chance, even I won't enjoy that sort of a bigger motorcycles. And I want a motorcycle which has to be interacting with me. And I control the motorcycle and I enjoy the motorcycle. And that's why we said middleweight, Rashid, is what we will focus as a company. And the middleweight, our definition is 250cc to 750cc motorcycle. And currently we have 350cc, 450cc, 650cc platform. And I do believe strongly that even this market can grow because premiumization in India is the thing. And we are by far the motorcycles which is very accessible price point which we have brought in, and gorgeous looking motorcycles, and everybody is loving. And I do see there is a good growth even in this platform which we can bring in for future.
So are you giving us a hint that maybe a 700 or a 750cc motorcycle soon? Is that something that is being worked upon?
Our focus is as a middleweight is 250cc to 750cc. I'm sure I will not be in a position to tell you exactly what well and all. But, you know, we always look at adjacencies and the middleweight focus. And why are we making it? As I mentioned, 250cc to 750cc, that's the focus. Currently, the focus, because we do feel there is a good market for 350cc, 450cc, and 650cc. And as I mentioned, our market share is about 89% in India. And yet our market share is only about 9%, 8.5%, 9% outside India. So there's a huge scope even to grow this. But we never say never. So we always look at adjacencies opportunities.
I want to ask you about the quarter gone by. A record quarter on the back of GST reductions and a strong festive demand as well. Which were the motorcycle segments that really fired for you? It was clearly the 350cc. Within that, what's really working for you?
You know, I think during this time, festive season, even government intervention on the GST reduction also has helped. Because less than 350cc, the rate reduction has really helped. That's a good move by the government and we welcomed it. At the 350cc level, all our products, in fact, we came out with a variant in Hunter and in the Guerrilla 450. And Meteor, we launched the series of products, new color variants. And we also kickstarted our classic campaign. So during this window, that's about 33 days festive window, if I have to tell you, we grew by almost 50% compared to last year festive window of 33 days. And in the quarter, we grew by almost about 41%. Primarily because of both ways. There is GST reduction and also a festive thing and our interventions in this. Yeah, it's been a wonderful quarter for us as an organization. And it is continuing. The inquiries are continuing and the demand is continuing. It's a good sign. In fact, so that now our production have to ramp up and capacity has to come up. That's the deep discussions which are going on now.
Right. To give us a sense of what's the capacity at which you're working right now, what you were working with in the quarter gone by, and what's the ramp-up plan?
So we have 3 manufacturing plants at Chennai now, and one at Oragadam, one at Vallam, and one at Cheyyar. The Cheyyar plant is primarily catering to both the plants, Oragadam and Vallam, as a support plant. These are the world-class manufacturing facilities which we have set up. These 2 plants, the combined capacity is almost about 1.2 million per annum. Is not what we started off with interventions, automations, and all those things, we racked it up to almost about 1.34. But we have gone ahead with modules because as are modules, so we cracked the code of how do we make modules and enhance the capacity rather than putting heavy capex into this. And we will be working on building it almost about 1.5 million capacity, which is good for our near growth.
By when?
It'll kick on from coming year, first quarter onwards.
Has some product planning been put on hold as a result of these GST
Royal
changes?
Enfield, no, we haven't put anything on hold. As I mentioned, we are a long-term ambitious company. We don't look at anything short-term, and we have charted our own plan for next 5 years, what are all the pipelines. If I have to tell you, yeah, maybe because of the GST, are we taking time to reflect? Is there something which we have to do for the domestic market? Of course, yes. But we won't do any knee-jerk reaction. All our product pipeline work, which is continuing, and because we also cater to 65 plus countries outside India, where the 450cc and 650cc's are and on need by the consumers. So our progress on all those product pipeline and the new product will continue. But I have to equally tell you, because of the scale, it actually deters any organization to put more money into R&D for future. Because if the scale is not there, then one will look at where is an ROI, how do I do that? So that's where we are requesting the government to consider. If in case there is one equal GST of about 18%, even for more than 350cc, it will really help to get good scale, thereby keep the cost down and take it to the international market at an accessible price point for more people to buy.
Overall, you feel that this is something that could impact the growth of the company?
No, I don't anticipate because our 350cc, as I mentioned, it's growing, and we have a lot of new variants, products which are going to come out of that platform also.
Right.
So to that extent, I'm optimistic about the growth of Royal Enfield.
I have to take a short commercial break here, but don't go anywhere. We'll be right back, and we will be speaking to B. Govindrajan, the CEO of Royal Enfield, about the electric push by Royal Enfield. Welcome back. We're joining you from Goa, where Royal Enfield is organizing its annual motorcycling extravaganza called the Motorverse. With us right now is B. Govindrajan, the CEO of Royal Enfield, and right behind us is the Flying Flea Scrambler Edition. This is the electric motorcycle from Royal Enfield, which will go to market next year. Govind, tell us more about it. You have the C6 there. Now you've got the S6. How do you plan to position these bikes, and when do they hit the market?
Yeah, good question, Prashant. This Flying Flea is our city plus electric mobility understanding and the brand. Actually, we got the inspiration from the original Flying Flea. At that point, after it was the most lightweight, used for the war purpose, dropped airborne types. That's where we got the inspiration. So Flying Flea is the City Plus electric mobility brand from Royal Enfield. The focus is going to be, as I mentioned, City Plus exploration, lightweight, sexy, super technology, and very intuitive UI UX, and it has to create a segment. That's where we thought that we will use this platform to create a segment in electric motorcycles. We came out with, in fact, I'll just take you to the C6 first. This is our Flying Flea C6. You'll see the girder forks and the lightings, all those things is classic looking and easy to ride, and all premium materials which we will use, and even the dial, which is round in shape. So you'll see a lot of classic thing which will be there in this. This is our first product, which is a C6, and for the City Plus applications. But when you say City Plus, I mean, there is also a possibility for us to do a bit of off-roading and some exploration which is possible. Maybe this caters to one kind of a consumers which we like it. Then we thought that, okay, in that platform, what is that we can do is the S6, which is the scrambler version, and which has a bit more ground clearance. You can see it here.
Yeah.
So it'll be easy for that.
I'll let you show this motorcycle to us.
Yeah, so this is the bit more ground clearance which are there, and a tire which is, I mean, the seat which is actually given as the rally type, easy for going back and then doing it. The ergonomic positions are properly done for this, and the wheelbase and wheel sizes, and with the intuitive UI UX and all those things. And we felt that this is another motorcycle which has a huge potential. So currently our focus is on taking to the market both C6 first and S6 subsequently. We'll not be coming together, but there will be a gap, but C6 to S6 within, say, about 4 to 6 months gap, both the products will be available in the market.
So will the launch first be in global markets, then India?
We're just thinking about the strategy of go-to-market. Currently, the thought process which is coming up is probably in India first, and followed by Europe within a short window.
Will this be the most expensive motorcycle in your segment? Will it be within the same range? Will it be on the lines of the twins? How would it be?
Look, I think the fundamental philosophy of Royal Enfield in the pricing is not, it's cost plus profit. That's not what we look at. We always look at a value proposition for the consumers, and we want to create this segment, and nothing is available in the electric world as of now like this. That's why we chose the C6 and then S6 to take it to the market. And one DNA of Royal Enfield, we always look at pricing is it has to be most accessible and create a market. So we will be at the most accessible price point for the consumers to see. That's a value for money that I can't deny like that. That will be there.
How much you've invested in developing these motorcycles till now?
Yeah. So once we thought Flying Flea is our electric City Plus urban mobility brand, we started first getting the team together. We have almost about 400 people as of now who are working exclusively into the electric field. In fact, already we have about 40 patents which we have filed. At a capex level, we have a lab which is set up at our Vallam facility. Almost about 120 crores we have set up for the electric lab. It is a product development lab. And the total capex so far, we have done almost about 400 crores. And we have applied for PLI, and along with the VECV together for the mega PLI application. And we are set well for the capex. And we also set up a line which can cater almost about 1.5 lakh capacity for both these products at our Vallam facility. So those lines are also ready now.
So what is the initial offtake that you expect or capacity that you have in mind for these motorcycles?
It's a new segment and it is not available. It's on our shoulder to create this. It will be a slow start, but I'm confident the kind of a response which we are getting it currently when we are showcasing the product, we will have a graph going up north slowly. That's Royal Enfield DNA also. We don't do anything immediate. We are a long-term ambitious company. We would like to grow the market over the period of time. That's all we have done in Royal Enfield, even in India for our growth. And our confidence as a team is that we will grow the segment over the period of time. So it's not a sprint, it's a marathon, but we are prepared for it.
We walked up to the 1901 Cafe here at Motorverse. And Govind, please tell us more about it.
Yeah, it's 125 years of Louis' journey of Royal Enfield. And in fact, to celebrate this year, 125th year, I'll just show you a motorcycle which is very different. This is our 125th year special edition motorcycle. You can see the paint scheme, which is it's called as a hyper shift paint. Normally it's not there. This is the first of its kind in the entire two-wheeler industry. It'll be used only in high-end cars and all. So we thought that's how we will celebrate the 125 year on the classic which we love most. And this year we also launched one more product which I just show you, which is with the double love, which we call it.
Is that the 650cc?
It's a 650 Bullet because Royal Enfield life started here in India at 1955 with Bullet. And this is the 650cc motorcycle Bullet, which is loved by everybody.
We've been a big bike maker, a middleweight leader for the last many years. Now, going into the future, maybe in the next 5 to 6 years, how much of your portfolio do you expect to be electric? How much of it will be ICE? Is there a 10-year vision plan that you're working with?
To be honest, in the current scenario, because it is an important question for an organization. What's the strategic plan? How do we do that? If I had to give you a straight, open answer about it, it's too premature from anybody to say that there is a tipping point for the electric to take on, the ICE to come down. At least I am seeing up to 2030 plus time window, the ICE motorcycles will continue to grow. India premiumization is continuing, and the motorcycle growth and the interest is also continuing. Will electric take a tipping point at a point of time? Possibly, yes. But for that, the total cost of ownership for electric has to come down. And there is also dependence on geopolitical things. Some parts are not available suddenly. Thereby, you tend to pay premium for that. So overall, if I have to talk about, for a electric to take a tipping point than an ICE in this, it will take time.
How much?
In my opinion, at least about 5 to 7 years time is clearly I'm seeing will take. And motorcycles probably, yes, there is motorcycles probably it will be more. Yes, on a scooter segment, it is unisex, last mile, that application for an electric and the number of kilometers usage is lower. Probably that will be very economical, so people may be looking at. But for a motorcycle kind of an experience which you're talking about, I don't see anything happening in the near future, at least 5 to 7 years.
How do you feel the current magnet crisis? Of course, China has started giving out certain licenses, but have those disruptions started easing up?
Yes. So what was happening is initially, the understanding is like the rare earth magnets were not allowed from China and said any product which has a rare earth magnet has to be tested and certified by any of the labs. So there was a huge queuing which was there in the China lab. As a result, people are not getting it. But what has happened is now that is easing out. Second, people are also started looking at various other alternatives like ferrite usages. So most of the companies are also started looking at whether the ferrite magnet is good enough so that the rare earth magnet can be avoided. Equally, that technology also has been proved during this point of time. So the challenge was taken by, I think, most of us to say that, okay, let's find an alternative also. So we are also ready with an alternative to adopt.
Going forward, how much of your capex will go towards ICE? How much towards EVs?
Currently, our focus more will be on ICE because, as I mentioned, up to 2030, 32, any projection which is showing ICE is growing. But we can't get away from not investing in electric because that's where the trend is coming. There is a CAFE norm which is there. For that also electric is required. So now it's a balancing which we have to keep doing on the percentages on a year-on-year basis. Currently, ICE is slightly higher, but we are a...
Percentage-wise?
On the capex, you are saying, no, it is very minimal because it's only about 10-15% asset now. But it will, at a point of time, it will have a change depending upon how the market is behaving.
Talking about your export growth, how do you plan to accelerate exports? Are there new markets you're looking to enter and consolidate?
So at last year, in fact, I have to tell you 100,000 plus motorcycles we have actually exported. We are a global company now, and we don't want to be actually sending motorcycles out of India as a trading. That was, at a point of time, to be honest, our thought process that let's send some containers to different countries. Now, we wanted to be there in the market, part of the fabric, understand the cultural nuances. So what we have done is we have prioritized the markets. And in those markets, we started having our own subsidiaries. And all the key markets, we have our own subsidiaries. We have our own team sitting there. And we are having a riding club which is coming up, and we have about 6 CKD plants which we have come up with. In all those markets, slowly we are gaining the market share. Currently, if I had to tell you, in UK, we are number 2 in the middleweight, and we are number 3 in Korea, Australia, Thailand, and all those areas. What the plan going forward is, with the product lineup which we have and the CKD facilities which we have and the entire logistics, we also decided to take on our distribution on ourselves. So because we wanted to be close to the customers and not having a distributor in between. So all those markets now we are taking over the distributorship so that we can go near to the consumer, activate the market, ride with the community. So I do see the growth pattern for us in the year to come better. In fact, last quarter we grew almost about 27% even in our international market. It's been going steadily for us.
How do you expect the full year export growth to be?
If I have to tell you about the percentage with respect to the last year, it is almost about 9 months over. Now it is a cold season which will come up. We'll be somewhere around 30% growth even in this year compared to the last years. And I do see it is opening up. In fact, Brazil is our next big market. It is just opening up for us. And I was there in Interlagos. I just said on our showroom, and almost about 1,500 guys came in and then said we all ride together. So the community is loving our motorcycles even in Brazil. And we have our own CKD facility which is in the setup. So that's a big market which we are really looking at, that it will cater more volume to us in future.
All right.
Thank you.
Govind, thank you so much for joining us here at Motorverse. Great talking to you about the roadmap for Royal Enfield over the next few years and how you're dealing with the market challenges as well. All the very best to you.
Thank you very much.
All right. That's all from us from here in Goa. Thank you for watching. Goodbye.
Hello and welcome to Startup Street. I'm Shruti Mishra, and with me are Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space. FinReach Solutions has raised 21.9 crore rupees in fresh funding led by Colossa Ventures, along with existing backers Michael and Susan Dell Foundation, Omidyar Network and Caspian's SME Impact Fund. The new capital will help FinReach scale operations and strengthen its risk and technology platform to accelerate credit guarantee facilitation at speed and scale.
Fay Beauty has raised 17 crore rupees in a fresh funding round led by Spring Marketing Capital, with participation from Titan Capital Winners Fund and others. The fresh capital will be used to accelerate product innovation, launch new phase-focused categories, and expand its omni-channel.
SBI Ventures intends to raise 2,000 crore rupees for its third climate-focused fund to invest in early and growth-stage climate startups, particularly in frontier climate technologies and AI-enabled climate innovations.
Rapido has seen its GMV grow 111% on an annual basis as of September 2025, according to its investor process. Rapido's annualized GMV as of March 2025 was 133%. Process doubled its shareholding in Rapido, picking up an additional 5% stake that was previously held by Swiggy.
YouTube, Facebook and Instagram have introduced tools enabling users to tag content as AI generated or modified. This move aligns with the draft amendments proposed by MeToo that aim to tackle the issue of AI-based deepfakes by requiring users to declare AI generated content and urging platforms to verify such content.
Those were the headlines that we're tracking for you this evening. But our top story today, India's new labour codes makes minimum wage a universal right for every worker. The central government will fix a floor wage which may differ across geographies, but allows states to fix the minimum wage. The code also mandates gratuity for fixed-term employees after they complete a year. Gig workers get legal recognition. Shilpa Rani Peta joins us now with more on what these rules mean for India's gig economy. Shilpa?
Well, you know, these new labour codes, for the first time, they give all those who deliver our food, our online orders and drive our cabs a formal worker status. Now, a gig worker has been defined for the first time as anyone working outside a traditional employer-employee setup, and a platform worker is someone who provides a service via an online app. Now, formally coming under the Code of Social Security, gig and platform workers will get life, accidental and disability insurance, health cover and maternity benefits, old age protection or pension and a lot more. Now, they will also receive an Aadhaar-linked universal account number which will allow them to access welfare benefits irrespective of which state they are in, removing the issue of migration as well. Now, a dedicated social security fund that will be financed by the governments, platform companies and CSR contributions will be supporting these schemes. Now, this brings in a big change for platforms with a mandatory contribution of 1 to 2% of their annual turnover to the Social Security Fund, and it's capped at 5% of payouts that are made to these workers. Now, analysts estimate that this could increase costs for the like of Swiggy and Eternal by anywhere between 2 to 3 rupees per order, with an incremental burden of about 150 to 200 crores on their GMV. Now, Eternal and Swiggy already provide benefits worth around 1% of their revenue. Now, from Swiggy to Eternal to Uber, Amazon, others, all of them have welcomed these changes. Both Swiggy and Eternal say that they don't expect any material long-term financial impact and are strengthening their internal systems for compliance. Online shopping apps like Amazon and Flipkart are also evaluating changes required, and all these companies are engaging with the government as the final rules are drafted. Now, remember, what are all these companies? It covers all the major platforms: Swiggy, Eternal, Zepto, Amazon, Flipkart, Urban Company, Ola, Uber, Rapido, you know, every other online ordering platform that you and I use. Now, analysts expect that these companies will pass on most or all of the cost to us consumers because they're already working with very stretched, thin margins. So this could mean a slight 2 to 3% increase per online order that we make, and this will likely be added to an existing platform or handling or convenience fee going forward. But this will go towards giving a much needed social security benefits to the 40 crore plus gig workers that we depend on almost every day. Back to you.
Thank you for those details, Shilpa. Appreciate you joining us. Moving on. Wealthy, a wealth tech platform for mutual fund distributors and wealth management professionals, has raised 130 crore rupees in a Series B round led by Bertelsmann India Investments. The Bengaluru-based startup is betting big on AI to supercharge India's mutual fund distributors, from cutting onboarding time to 2 minutes to giving advisors institutional-grade tools and insights. With AUM soaring from 200 crore rupees to 5,000 crore rupees in just 3 years and a network of 6,000 distributors across 1,000 towns, Wealthy now wants to onboard 50,000 partners and hit 1 lakh crore rupees in AUM. To tell us how, joining me now is Prashant Gupta, the co-founder of Wealthy. Prashant, welcome to Startup Street. Like I just mentioned, your AUM has grown from 200 crores to 5,000 crores in just 3 years. What's driving this acceleration? And in a landscape filled with execution platforms, advisory platforms, brokerage apps, where does Wealthy position itself? What is your moat?
Thanks, Shruti and Arundhati, for inviting. So we are building the operating system for India's MFDs, bringing institutional-grade wealth tools straight into their hands. That's why about 6,000 plus partners across 1,000 towns already run on Wealthy. We are not competing with brokerage apps and DIY platforms.
So let's talk about the fundraise then, Prashant. What does this 130 crore rupee round unlock for Wealthy at this stage of your journey? What are your top deployment priorities?
So we're doubling down on three areas. One is AI-driven tools and workflows, deeper expansion into tier 2 and beyond, and powerful multi-product stack that lets MFD operate like top private bank RM.
Okay. Mutual fund AUM stands at 75 lakh crore rupees, yet we have only 5 crore investors, Prashant. What is holding back retail participation? And you work with over 6,000 distributors across 1,000 towns. So what gaps do they report from the ground?
So the biggest gap in India is trusted advice. Right? Most investors lack confidence to start and confidence to stay on track. And that usually comes down to low awareness of asset allocation and risk. That's the core gap the MFD solves, and we are solving together with them.
All right, Wealthy offers, like you mentioned, a full 360-degree platform across mutual funds, equities, bonds, PMS, AIFs, insurance. You've said that technology alone can't solve the advice gap. So how do you combine human trust and AI meaningfully? And if you could give us examples of how AI is making distributors smarter and more proactive.
Sure. So as I said, tech can't replace trust, but it can upgrade it. Right? So for example, client onboarding, which used to take days, can be done in 2 minutes. That's the power of tech. Another example, a proper portfolio review used to take weeks just to collect prospect clients' data, another 4-5 hours to stitch all of it together, which a tech-led workflow and AI, that review can now be more precise, instant, and proactive, right? It makes MFD faster, sharper, and more consistent across clients.
And if you could also throw some light on the risk tracking ability.
Right. So, the data that the MFD gets from the client, that also enables him to give the platform to give tools to give prompts to the MFD to be able to take proactive measures rather than reactive measures, which has been traditionally the case.
Okay. Again, like I mentioned in my introduction, you're targeting 50,000 distributors and 1 lakh crore rupees in AUM. What does it take to build this scale, Prashant? Earlier you mentioned expansion into tier 2 and tier 3 market is a big part of your plan. Walk us through that strategy as well.
So AUM is a function of is the outcome. So the input really is the number of MFDs that trust us, right? So we already onboard about 350 MFDs per month, and we train most of them. The next milestone is to onboard about 1,000 MFDs a month, and the most of that growth will come from tier 2 and beyond towns, where demand is exploding and the MFD supply is still very thin.
Sure. And how different is this market, as compared to the metros? What is the playbook at the tier 2 and tier 3 market level that you have?
So compared to metros in tier 2 and beyond, you have to actually create the advisor or the MFD supply. So you have to actually onboard them, train them, get them certified, handhold them in the early years. And it takes some patience in the beginning to build, but that's what we have been doing for the past 3.5 years, and now we have a playbook to do that in multiple geographies as well.
All right, Prashant, RBI data shows that 4.66 lakh crore rupee net inflows into equity mutual funds in FY25, which is pretty much 7x growth in 5 years. What structural tailwinds are you banking on?
So financialization in India is accelerating, right? So incomes are rising. Digital rails like Aadhaar and UPI do help make everything faster and more reliable. Mutual fund assets are growing at around 15% per year, but assets managed by MFD are growing at 30% a year, right? So, and MFDs on Wealthy with Wealthy's tech stack and the platform are scaling nearly 60% year on year, far ahead of the industry, right? So these are the structural tailwinds that we see, which we foresee in the next coming decade as well.
Okay. Prashant, with less than 15% of households invested in equities today, how do you see this number a decade from now?
So developed markets are at about 50+ participation, whichever market you take. India is still just at, as you said, 10 to 15%. In a decade, we see India doubling, or if not tripling that number. We are still at a very, very early stage in wealth creation cycle. But we foresee about doubling of that number to tripling of that number, which makes it about 10% to 15% now to about 20 to 30%, or maybe about 30 to 40% in the next decade.
All right, Prashant, before I let you go, one final question. If you could take me through your current growth plans, what's immediate, in terms of expansion?
So we are currently in about 20 cities. We would, which includes the metros and tier 1. We would, and some tier 2. So we would go from geographical expansion wise, we will go to tier 2 and beyond. So we will add another 10 to 15 cities in the next couple of quarters, where our presence will be expanded, and we will onboard new MFDs, train them, and go to the market in those cities. Second would be strengthening our multi-product platform from investments and insurance and broking as well. So making it more robust and scalable for the MFDs to be able to offer to the clients.
All right. Wish you the very best with all these growth plans that you just mentioned. Many thanks, Prashant, for joining us on Startup Street today.
Thank you. Thanks a lot.
All right, and moving on, Agraga, India's digital freight forwarder rebuilding the cross-border logistics stack for MSMEs and enterprises, has raised 100 crore rupees in a pre-Series B round led by Bajaj Finserv. The company plans to deploy the capital towards expanding its LCL vertical, deepening its automation and real-time visibility tech, and scaling across major export hubs. With over 700 customers and 1,000 vendors already on its platform, Agraga says this funding will help them accelerate adoption among smaller exporters and push India's trade ecosystems towards greater transparency and digitization. So joining me now to discuss this further is Venkatesh Narayanaswamy, the co-founder and CEO of Agraga. Thank you so much for joining us on the show today. Like I mentioned, you're a digital freight forwarder in an industry that has been historically fragmented and highly manual, right? So if you could sort of take us through how you're simplifying cross-border trade for Indian exporters, what are the core solutions you offer across discovery, tracking, execution, and financial services?
First, thank you for having me on the show. One of the key things that has happened in the B2B cross-border trade is that it's a very fragmented piece with multiple moving parts in the entire ecosystem. Our focus is to ensure that we are moving towards delayering the existing fragmented piece by working with asset holders rather than intermediaries, creating a layer where there is complete transparency in the supply chain, and the MSME exporters have complete control over what's moving, and they have the visibility and transparency towards what's moving across the supply chain from the factory of theirs until it reaches their customers. That's what's really creating.
Sure. Yeah. And, congratulations on the 100 crores that you've raised, right? How will this round sort of accelerate the adoption among MSME exporters who continue to face, cost, compliance, and multi-intermediary challenges? Where else will the capital be deployed?
So one of the key aspects is building the technology stack. We are ensuring that there is a much deepening of our supply ecosystem, not only in India, but in international geographies, that enables us to be giving access to customers to a much larger ecosystem than what they have today. The second is the complete capability on technology that has created a layer where they are able to discover the solution, both the movement of cargo as well as the price, in currently probably 2 minutes. Earlier in the traditional ecosystem, it could take anywhere between 48 to 72 hours. And this has really enabled them to push forward in terms of building the trade and access to global markets with a lot more ease.
All right. And, you're also looking to expand your LCL vertical, and that's a big focus area for you. So what tech upgrades, automation capabilities, or real-time visibility features can, your customers sort of expect over the next 12 to 18 months?
So LCL is a little bit more complex. And I think one of the reasons that we have deep dived on LCL is that the small customers do not have enough volumes to move a full container. The LCL enables them to be cost effective when they ship globally across multiple geographies. The ability to aggregate demand across a large funnel of customers, small customers in tier 2, tier 3 cities, is what we are able to build. We are able to give small customers enterprise level logistics solutions, which they otherwise are unable to access. And that's what creates a significant impact through the LCL vertical. What we have done is creating an ecosystem where we are able to optimize routes, optimize pricing based on real-time API integrations with all the supply ecosystem that we work with. And that's what's democratized the entire supply chain for the small exporters. They're really underserved, and that's what they don't have access to.
All right. And you've grown to 700 customers and 1,000 vendors across 40 geographies, right? So what does this mean for your revenue run rate? If you could take us through the kind of revenues you're clocking and where you sort of hope to exit this year and what the next 1 year plan is.
So I think at the exit of this year, we should be clocking around 200 crores in annual revenue. That's probably a 75% growth over what we had last year. Over the next 12 to 18 months, we believe that there would be a 150% growth in our overall revenue or the annual run rate. And we believe that the deepening of access to customers across tier 2, tier 3 towns and ensuring that there's a large funnel is going to create this impact.
Right. And demand for organized tech-led logistics solutions is rising across India's export hubs, right? Like you said, they're underserved and they need these services. If you could walk us through your current presence and which geographies or trade lanes you're prioritizing for the next phase of growth, because you're looking to enter more areas within India itself, right?
So we started off with US being a primary focus. It was the largest trading partner on the export leg of the business. We believe that going forward, we are expanding into around 12 geographies in Europe. We will be accessing the Middle East across 4 countries and then further expanding into South America and Africa. These are the projected trade lanes that we intend to develop. But we also intend to making sure that we further accelerate growth in the existing geographies that we have.
Sure. So you're looking at a lot of geographies there. Which is your best? What's the revenue mix at this point? Which is your best performing geography? And where does sort of India lie in your plans for the next 1 year?
So India would continue to remain a focus. I think there's a lot of power there's a lot of backing by the government, especially for the MSMEs to propel the export story that India has. India is expected to reach $1 trillion in exports over the next 4 or 5 years. And I think MSME is going to be at the heart of the entire growth story. Obviously powered by the government initiatives like one region, one product, all of that happening. And the doubling down on US and Europe is where we believe consumer markets are going to grow for the Indian MSMEs. Also backed by some of these global marketplaces like Amazon, Walmart, eBay, creating that kind of infrastructure for the Indian exporters to reach global markets.
All right. And Venkatesh, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey going forward.
Thank you so much.
All right, with that, it's time for us to head into a short break. But up next, unified data platform Control B has secured $2.5 million in seed funding led by Chola Ventures. We put the firm's co-founder and CEO, Adarsh Srivastava, on the hot seat to know more about the firm's fund allocation and growth plans. Stay tuned.
Well, unified data platform Control V has secured $2.5 million in a seed funding round led by Chirite Ventures. Founded in 2023, the company builds a platform that helps businesses understand what's happening inside their complex apps and systems, something which is known as observability. Now, as online services grow, companies collect huge amounts of data to keep things running smoothly, but storing and searching through all of this information has been slow and expensive. Now, Control B says it has developed a faster and far more affordable way to handle this data. With this new funding, it plans to grow its team, expand in India and the US, and strengthen its technology. For more on the company's plans ahead, joining me now is Adarsh Srivastava, the co-founder and CEO of Control B. Adarsh, thank you so much for your time here. For our viewers to just understand what you do in simple terms, what everyday problem does Control B solve for companies that are running large digital systems?
Sure. So what happens is that whenever any company has a digital infrastructure, be it servers, be it they hosting an application or they running an e-commerce or a fintech, the problem that gets in their way is no matter how good a software is written, it always has bugs. And whenever things are in production and actual users are using the software or the application or the tool, it tends to break down. Now, whenever this happens, it is called an incident. And whenever an incident report is raised, a developer usually gets a page or a call on their cell phone, and then they have to leave everything that they're doing and go back and solve the issue that has happened, which causes a lot of loss of productivity, which in turn causes a loss of revenue for companies. So in general, for enterprises, every minute of downtime or every minute that an incident is going on costs them around $5,000 to $10,000, depending on the size and the nature of the incident. So what Control B's mission is to help these developers cut down the time that they have to spend trying to understand what went wrong.
Well, you claim companies can cut observability spending by up to 80%. How exactly does your platform enable these savings, and how big is the cost burden for large enterprises today?
Yes, for large companies, they spend close to 30 to 40% of their entire cloud budget on observability, which amounts to a lot because these companies have more than $1 million, $5 million, $10 million of yearly cloud spend, and 30 to 40% amounts to a lot of money. What Control B does is that it reinvents the way the data is stored, processed, and queried, which helps in this drastic cost reduction. And we are also filing for the patent on the same technology that we have built.
Well, let's get to that funding then. How exactly are you going to utilize this $2.5 million seed funding that you raised for the growth of the company?
Yes, so right now the main focus is to strengthen the R&D. Because as I mentioned, our goal is to cut down the cost without sacrificing on the speed that the developers experience when they're using the platform. So that involves a lot of R&D. And so I think the majority of chunk will go in R&D, hiring new developers. And then I think some portion will also go in our US GTM, wherein we'll also like to expand the market in US where the problem is much more severe.
You're targeting more than 50 enterprise customers in the next 18 months across India and the US. What is your acquisition strategy, and which sectors are proving to be the fastest adopters?
So what I've seen so far in my journey is that the finance sector as well as the internet commerce sector is the biggest beneficiary of softwares like these because they generate terabytes to petabytes of data daily, and hence their costs are usually very high. Be it Flipkart, be it Walmart, and other fintech players like Zerodha, they spend a lot of money on storing these telemetry and observability data. So, and the primary acquisition channel that we are going for is right now founder-led, because you need to come from a position of trust in order to sell such a critical tool, because Control B forms a very crucial part of their infrastructure. And then we are also talking to a couple of channel partners that can help expand the reach of our funnel.
Well, Adarsh, your platform talks about high-speed ingestion and extreme compression. How defensible is this technology, and how important are these patents you were talking about in building a long-term moat for the company?
Yes, so the patents are pretty unique to us, and what we are trying to do is build defensibility against the other players in the market. And we have taken our steps to ensure that that defensibility remains. And we have our own compression algorithm that helps compress data up to 200x, whereas the current market standard is anywhere from 70 times to 100 times, whereas we are sitting at 200 times. So that is something unique to us. And then we also have our own indexing engine, which can sort of index large chunks of data and then compress it into just a few gigabytes of inverted indexes, which again helps companies get way faster search.
Well, finally, long term, do you plan to evolve into a full stack observability and security cloud? And what does that roadmap really look like? And secondly, how do you see revenue scaling as you move into these adjacent markets too?
Sure. So I'll first answer the revenue question. So what we have seen is that enterprises, it's far more easier to sell to enterprises because the pain point there is much bigger. And each enterprise we close gets us around 50 to 100K in ARR. So we see the revenue scaling exponentially within the next 1 year.
All right, Adarsh, we leave it at that. Thank you so much for your time here today. It was a pleasure having you on Startup Street.
Thank you, Ritu. Nice talking to you guys.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. A late sell-off on the Lal Street. The Nifty drops below 26,000, ending at the low point of the day. The Sensex loses over 440 points. Mid-caps continue to come under pressure. India's new labour code makes minimum wage a universal right for every worker. The central government will fix a floor wage, which may differ across geographies but allows states to fix the minimum wage, mandates gratuity for fixed-term employees after they complete a year. Trade unions call the codes a deceptive fraud and announce nationwide protests. Real estate companies could see labour costs increase by 10 to 15% due to the new labour codes. Gig workers get legal recognition and platform companies could see limited short-term financial impact. 50 lakh IT sector employees likely to see a reduction to their in-hand salary, but cost to companies remains unchanged. Hindustan Aeronautics calls the Tejas fighter jet crash in Dubai on Friday an isolated occurrence arising out of exceptional circumstances, says it would have no impact on the company's business operations or financial performance or future deliveries. The stock falls up to 9% in trade before recovering. 40% GST rate will deter Royal Enfield from investing in bigger motorcycles as the company's CEO Govind Rajan plans to adopt a startup mentality to minimize the GST impact, doubles down on exports and plans to ramp up capacity. That's an exclusive. After 6 quarters of margin expansion, Tech Mahindra CEO Mohit Joshi expects business transformation to be completed in FY27, puts the spotlight on profitability, delivery optimization and scaling of AI services. The US and Ukraine update the framework to end the war with Russia after talks in Geneva. Zelensky says conceding territory to Russia is the main problem, but promises to work with the US on compromises that strengthen the country. President Trump's Department of Government Efficiency, DOGE, has disbanded with 8 months left to its mandate. Elon Musk led the initiative in the first few months after it was launched with much fanfare to slash the size of the government. Justice Surya Kant takes oath as the 53rd Chief Justice of India. He will have a tenure of 14 months, promises to focus on reducing the pendency of cases. The Indian Navy commissions INS Mahe, built by Cochin Shipyard. The ship is designed to hunt submarines, conduct coastal patrols and secure vital maritime routes. Legendary film actor Dharmendra dies at 89 after a prolonged illness. With a career spanning 6 decades and a crowd favourite for his debonair appearance, Dharmendra straddled action, comedy and romantic roles with equal ease. He was honoured with the Padma Bhushan in 2012 and also served as a BJP MP for a term. Well, let's start with the day's market action. The Lal Street witnessing an all-round fall in the last hour of trade, with the Nifty slipping below the 26,000 mark. IT and bank stocks supported the market in the first half, but then witnessed a sell-off in the later half of the trading session. So that's the Nifty down 100 points for you, 330 lower on the Sensex. The Nifty Bank closing flat off its intraday highs. The Nifty Mid-Cap Index down by about 200 points. Nearly 40 of the Nifty stocks closing in the red today. Nigel standing by now to wrap up the day's trading action. Nigel, pressure in the afternoon.
Well, the Nifty slipped and ended closer to the day's low, a day ahead of the monthly expiry. And there were some jitters that we saw in the headline index itself. But it could be more attributed to the monthly expiry that will play out in tomorrow's trading session. However, the breadth of the market favored the number of stocks that were declining, and there was aggressive selling from the word go itself. And that's what led the broader markets to underperform. The tech index, though, that was the outperformer. Remember, it's underperformed in the last 1 year or so, and there were various brokerage calls coming in from the likes of Motilal Oswal that suggested that the time has come now to get into tech. And some of the stocks reacted quite favorably. And if you look at the Nifty itself, the top winners came in from a mix of tech as well as two-wheeler makers. You had Royal Enfield, in fact, that completed 125 years, and the bulls celebrated in today's trading session. On the flip side, you had high beta. That came in for a bit of a hit. Steel stocks from the Nifty pack did take a hit. JSW Steel, Tata Steel, both of them were under pressure. And select defense names like BEL as well did take a bit of a knock today. The broader market losers, though, included the likes of Saman Capital, post that action on the erstwhile promoters. Last week itself, CG Power, well, that stock got hit after an order was cancelled. And since, high beta took a hit, metals were down. You had a real estate stock like Prestige Estates as well that was under pressure, in today's trading session. Net, the month of November, the Indian markets have actually outperformed. However, the breadth of the market has been negative, and that's where you're seeing that the small cap index is down close to around 4%, and that's why portfolios aren't feeling very, very good. So the outlook for the Nifty from here on, well, the US-India trade deal, that's what's awaited. However, till that crucial support zone of 25,500 to 25,800, which is around the 20 DMA, that gets protected, the bulls will feel they're still in the game, and they'll attribute today's fall to expiry-related factor out there. The bigger question is, can the broader markets recover? That's something that the street will track very closely.
All right, Nigel, many thanks for joining us. And from the equity action to the currency, the Indian rupee posting its biggest one-day gain in a month today. This as the central bank intervention helped the rupee rebound from the all-time low it hit on Friday. However, the currency is still above the 89 mark against the dollar, so 89.23 is the dollar rupee for you. Now, India's largest commodity exchange, MCX, says it has found the cause of the technical glitch that halted trading for 4 hours on the 28th of October. Speaking to CNBC-TV18 exclusively, MCX's CEO Praveena Rai did not reveal what caused the glitch, though. She said the exchange employed a third party to assess the root cause of the incident, and the whole system was then tested to identify any other potential issues.
First and foremost was the root cause analysis that got done immediately. I think by within a day or two, we knew what it was, and we communicated that as well. In addition to that, we've also gone to market and we've brought in a third-party assessment of the root cause, so that in case there's something getting missed internally, it gets picked up. So that is also completed. The next step is to say, hey, this is looking at the root cause, but why don't we actually put the whole system through a testing so that with real volumes, we are able to identify any other such threshold parameters. So that's something that is currently in process.
Well, that's MCX, and S&P Global Ratings has forecast that the Indian economy will grow at a rate of 6.5% in FY26 and 6.7% in the next fiscal. In its latest economic outlook, the rating firm has said the GST rate rationalization and easing monetary policy will drive consumption-led growth. The report also states that domestic demand continues to support growth, even though US tariffs have impacted exports. Now, Hindustan Aeronautics shares dropped after a Tejas fighter jet crashed during a Dubai air show on Friday. The Indian Air Force pilot wing commander Naman Sayal was killed in that crash. HAL has called the incident an isolated occurrence arising out of exceptional circumstances. In a statement, the company said the incident will not impact the company's financial performance or future deliveries. The big story this evening, India has a new labour law regime in place. 29 colonial-era laws have now been repealed or rationalized into 4 new labour codes. The stated aim is to modernize the legal framework, extend social security to a wider workforce, and ensure universal wage protection. However, trade unions affiliated with opposition parties have announced nationwide protests. So how do the new labour codes change the labour landscape? Let's focus on some of the big changes. First up, the central government will be fixing what it calls, and I quote, the floor wage, taking into account minimum living standards across geographies. States, however, will have the power to fix the minimum wage rate, which shall not be lesser than the floor wage fixed by the centre. So that becomes the floor. States can do more than that, but not lower than that if they like. Second, this has been a major bone of contention for trade unions. The law gives smaller companies more flexibility when it comes to laying off workers. Companies that employ more than 100 people needed government approval before laying people off. That threshold has now been increased to companies that employ over 300 people. Number 3, the gratuity eligibility timeline has been eased as well. Fixed-term employees who've completed a year of continuous service are eligible for gratuity. Earlier, the provision mandated 5 years of service. And lastly, the new code gives gig workers, people who work for the likes of Zomato, Swiggy, etc., legal recognition. This had been a long-standing industry demand. Platform companies could, however, see short-term financial impact on account of it. Let's now bring you a sector-by-sector analysis of the new codes. My colleagues are standing by, Reema, Shilpa and Sonal here with us to decode what the new labour codes mean for different sectors. Sonal, to you first. Real estate is a labour-intensive sector. How is the real estate sector reading into these developments? What is the likely impact?
That's right, there will be an impact on real estate industry and buyers as well because of changes that we are seeing in the labour laws. Now do remember, labour costs are different for different cities. For something like a Mumbai, we have more percentage going to land costs in the total developmental cost versus a city like Hyderabad where labour costs will be higher. On an average, labour costs are anywhere between 15 to 30% of the total developmental cost for a real estate builder. And also if we talk about cost X of land, it is anywhere between 20 to 25% of the total total construction costs. Now, what would the impact be of these changes? Now, we spoke to Anirog. They indicated that labor costs would increase by 10 to 15% due to these new laws, and of the total developmental costs, it would mean an increase of 3 to 4%. Would the developers be able to absorb that? Not really, because their balance sheets are very stretched currently, and they will not take it on their P&L as well, and these costs will be passed on to the buyers, so there could be an impact of 3 to 4% on buyers' buying costs as well. We also spoke to Knight Frank, and they said that shortage of labor has been a serious issue in the real estate industry, and if these labor laws are implemented, there could be a massive shift. The labor shortage could not be an issue anymore, and it will be solved for this industry. However, he did indicate that yes, this implementation by builders could take more than a year, and to formalize this process as well completely. So this could be the impact of these new labor laws on the real estate industry, ultimately coming down to the buyer cost as well.
Well, that's right, Sonu. Let's bring in Shilpa now with what these rules mean for India's gig economy. Shilpa, what does it mean for platforms like Eternal, Swiggy, etc., and those who are employed by them?
Well, you know, these new labor codes, for the first time, they give all those who deliver our food, our online orders, and drive our cabs a formal worker status. Now, a gig worker has been defined for the first time as anyone working outside a traditional employer-employee setup, and a platform worker is someone who provides a service via an online app. Now, formally coming under the Code of Social Security, gig and platform workers will get life, accidental, and disability insurance, health cover, and maternity benefits, old age protection or pension, and a lot more. Now, they will also receive an Aadhaar-linked universal account number, which will allow them to access welfare benefits irrespective of which state they are in, removing the issue of migration as well. Now, a dedicated social security fund that will be financed by the governments, platform companies, and CSR contributions will be supporting these schemes. Now, this brings in a big change for platforms with a mandatory contribution of 1 to 2% of their annual turnover to the Social Security Fund, and it's capped at 5% of payouts that are made to these workers. Now, analysts estimate that this could increase costs for the like of Swiggy and Eternal by anywhere between 2 to 3 rupees per order, with an incremental burden of about 150 to 200 crores on their GMV. Now, Eternal and Swiggy already provide benefits worth around 1% of their revenue. Now, from Swiggy to Eternal to Uber, Amazon, others, all of them have welcomed these changes. Both Swiggy and Eternal say that they don't expect any material long-term financial impact and are strengthening their internal systems for compliance. Online shopping apps like Amazon and Flipkart are also evaluating changes required, and all these companies are engaging with the government as the final rules are drafted. Now, remember, what are all these companies? It covers all the major platforms: Swiggy, Eternal, Zepto, Amazon, Flipkart, Urban Company, Ola, Uber, Rapido, every other online ordering platform that you and I use. Now, analysts expect that these companies will pass on most or all of the cost to us consumers because they're already working with very stretched, thin margins. So this could mean a slight 2 to 3% increase per online order that we make, and this will likely be added to an existing platform or handling or convenience fee going forward. But this will go towards giving a much needed social security benefits to the 40 crore plus gig workers that we depend on almost every day. Back to you.
Well, it is a large number and the gig economy is growing. Thanks very much, Shilpa, for joining us. And let's go across to Rima now and what these codes could mean for the IT sector. Rima, you've been speaking with companies. What's the likely impact?
Thanks so much for that. So the overall impact on the IT industry is not expected to be material. Now, even though the IT industry is one of the largest employers of the formalized workforce, more than 5 million people are employed in the IT and IT-enabled services, which includes BPO, and a large chunk of the IT services expenses, some estimate 75%, some go as high as 85%, is on account of the wage bill. But the overall impact is not expected to be material. Where the costs could go up perhaps is on account of this mandatory health checkup for employees above 40, because IT companies, some of these legacy old companies would have a sizable number of employees above the age of 40. But that other big change, where there is a mandatory PF-linked basic pay increase to 50%, is not going to impact the IT companies, because while it may reduce the in-hand amount for the employees, the overall cost to the company remains unchanged. So for a company, the CTC is not going to change. It's just the composition of the basic pay versus other allowances will change. So for an IT company, there is no impact on account of the basic pay increasing to 50%, unless they say that, okay, you know, the company, the employees are going to get less money in their hand, and therefore we'll increase the overall CTC. And there could be a minor increase in the cost on account of the overall compliance burden, etc.
Okay, Rima, many thanks. So, sectoral analysis of what the labour codes could mean for employers and employees. Meanwhile, trade unions affiliated with opposition parties have criticised the notification of the 4 labour codes. In a statement, 10 central trade unions and various independent federations have called the move a deceptive fraud committed against India's working people. The unions have called for a nationwide protest on Wednesday and called on all members to wear black badges to their workplaces. On to a CNBC-TV18 exclusive. Royal Enfield plans to launch its first electric motorcycle by April next year. Parikshit Luthra caught up with the company's CEO B. Govindarajan on the streets of Goa to take stock of the brand's 125-year-old legacy and its future plans. Govindarajan said the 40% GST rate will deter Royal Enfield from investing in bigger motorcycles. He also said the bike maker plans to adopt a startup mentality to minimize the GST impact while it doubles down on exports.
The higher CC motorcycles, the era is slightly going off. I don't think people are really enjoying. If given a chance, even I won't enjoy that sort of a bigger motorcycles. And I want a motorcycle which has to be interacting with me. And I control the motorcycle and I enjoy the motorcycle. And that's why we said middleweight, Rashid, is what we will focus as a company. And the middleweight, our definition is 250cc to 750cc motorcycle. And currently we have 350cc, 450cc, 650cc platform. And I do believe strongly that even this market can grow because premiumization in India is the thing. And we are by far the motorcycles which is very accessible price point which we have brought in, and gorgeous looking motorcycles, and everybody is loving. And I do see there is a good growth even in this platform which we can bring in for future.
Well, that's Royal Enfield on their launch plans. Here's another exclusive this evening. After 6 quarters of margin expansion, Tech Mahindra CEO Mohit Joshi expects business transformation to be completed in FY27. This as the heads of 14 group companies came together on television for the first time at their annual Investor Day. Speaking to CNBC-TV18, Joshi also said the company will prioritize profitability, delivery optimization and scaling of AI services. Take a look.
Very confident, and we're completely committed to our F27 goals, and then beyond that, we'll sketch out a vision for for the next 3 years.
Yeah, so give us a glimpse of what the vision for the next 3 years could potentially look like.
I left my crystal ball at home, unfortunately.
You don't need a crystal ball. I'm sure you've got a vision board that sets out those numbers for you. But Mohit,
I'm not going to. So look, I think the thing is right that I don't want to start manifesting my FY30 vision over here, but. I do feel that, look, the first part of the journey has been about becoming world-class, right? Really a catch-up with the peers in terms of growth, in terms of margins, in terms of deep capability, while building on the strengths of the company. FY30 is going to be about becoming world-beating, right? How do we figure out what are the things that we do exceptionally well, and how does that start to show up in our financial results?
Well, that's Tech Mahindra, and time for us to take a break. But up next, India and Israel are set to fast-track the first phase of free trade agreement. Commerce Minister Piyush Goyal said both countries have agreed to focus on getting sensitive issues off the table. That and more when we return. Prime Minister Modi met Canadian Prime Minister Mark Carney on the sidelines of the G20 Leaders Summit in South Africa. Both leaders have agreed to formally launch negotiations for a comprehensive economic partnership agreement. This agreement will include goods, services, investment, agriculture and digital trade. Modi and Carney expressed confidence that the agreement will help more than double bilateral trade between the two countries to $70 billion by 2030. Commerce Minister Piyush Goyal is upbeat about a trade deal with Israel. The minister is in Tel Aviv, where both nations agreed to the framework based on which the negotiations will be held. Speaking to our colleague Abhimanyu Sharma, Goyal said the discussions will focus on increasing investment, R&D and partnership in the agriculture sector. Take a look.
Yesterday, I had very extensive discussions with my counterpart, the Honourable Commerce and Industry Minister. And we have both agreed that we will focus on low-hanging fruits, get the sensitive issues off the table on both sides, look at how innovation and R&D can drive greater investments in each other's countries, work at joint projects where we can leverage on their skill sets, they can leverage on the economies of scale that a large market like India gives, whether we can do infrastructure projects or provide them youthful, skilled and talented manpower to support the Israeli economy. So it's a very multifaceted partnership that we are crafting with Israel. And it's quite possible that we may come out with a first phase of an FTA so that we can kickstart the benefits faster.
Are there any actionable insights from the meetings which you had with several leaders and the meetings you are slated to have with several leaders? Any targets being looked at with respect to mutual investment opportunities and with respect to other opportunities with respect to manufacturing?
Well, I've met their finance minister and we are looking at a joint protocol which will help encourage import and export of goods and services from each other's countries. I've had very good meetings with the agriculture minister, who's a very, very good friend of India and is looking to expand relations on the agri field with India. I'll be meeting their senior leaders tomorrow to further discuss how this partnership can be taken to the next level. All in all, I think the country, the people of Israel have showered a lot of respect on the entire business delegation that came with me, and I see tremendous potential in this partnership going forward.
So a final question now. Several FTAs India has already signed with developed economies. Are they going to serve as a template for future FTA negotiations? Because as you indicated earlier too, several red lines cannot be crossed. So all FTAs which are being negotiated with different economies, be it the US, the EU, or even the Mercosur for that matter, or GCC, what kind of targets can be looked at? What kind of timelines can be looked at in near future?
Well, there are always red lines, there are always sensitive issues, but every agreement stands on its own ground. Every agreement has its own positives, benefits, and you really create a balance at the aggregate, considering all aspects of a relationship. Keeping that in mind, we decide what would be included in an FTA, what would not be included. What may be sensitive for one country may not be sensitive in another country. There are many products that are desirable for us to have in India at low cost for our own economic growth and development. So it's on a case-to-case basis. You have to decide what you will open up and what you will not.
Well, that's Commerce Minister Piyush Goyal in Israel. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more.
Hello and welcome. You're watching Commodity Champions. I'm Manisha Gupta, and today we have a very special guest joining us right here in studios. Praveena Rai is MD and CEO at MCX. Ms. Rai, hi, thank you so much for coming by. And it has been a great year for you, year 2025. I mean, if I look at the numbers, it has been the biggest ever turnover that we've seen, an average of 4.11 lakh crores. What really has led to these very strong numbers?
Yeah, the numbers are very exciting, and it's wonderful to be here, Manisha. I think we've actually practically quadrupled our numbers. So last year we doubled from about 1 lakh crore to 2 lakh crore, and this year we are already looking at 4 lakh crore as an average for H1. And I think this is really on the back of some tremendous work in the market. There has been a slew of launches, especially in the bullion segment, and these have been products that were created specific to market needs. And when the market requirement really cropped up in the last few months, it's played an important role there. We've also seen very active participation. So on the back of the larger macroeconomic trends, how India is doing, I think it's really the market participants who've also stepped in, and we are seeing higher levels of participation that our teams are also very heavily engaged with.
Well, yes. I also have your numbers in front of me. And when you look at the second quarter and the first half numbers, it shows strong growth, revenue, EBITDA, PAT. What really is driving all of these numbers, and how much of that really is structural?
So, we are growing at about 40% on the operating revenue side and 50% odd on the EBITDA side. This is a result, of course, of first and foremost the headline numbers we spoke about. But behind that is also all the enabling factors, right? The strong technology, the strong compliance framework, and certainly I would say the factors around the macro trends, right, that really drive the fit for purpose across all segments. So the energy segment is a strong one, continues to do well. The bullion segment, which has been a strong segment, has really performed above par. And the metal segment, has also, we are looking at sort of doubling in some of the metals there. And agree, while it's a much smaller space, also does its own role being fit for purpose there.
Electricity futures is another introduction that you've done in this year. We do understand that it is a long gestation product. How much of a readiness do you see in the markets for that, whether it is from the retail or the company part of it itself?
So electricity is something that we absolutely need in India. If we look at global markets, be it US, Europe, Asian markets like Japan, it's one of the new emerging commodity sectors across all markets. This product has been designed taking into consideration the requirements we have in India. The renewable sector is growing. In fact, I think we are really beyond plan when we look at the policy numbers on where we need to be for the renewable sector. So all of this comes together to say that this product, is a requirement for the purpose of hedging across producers, consumers, and the entire value chain there. So we are seeing strong interest. The momentum is right. It will take some time because it's about, financial players understanding electricity and electricity ecosystem, looking at hedging. A lot of internal corporate and governance enablement activities are also in play. We are looking at an average ADT nowadays of about 40-50 crores. Okay. And I think within 3 months of launch, these are good numbers. So I think we are positive that the product is designed for market. It's simple, easy, works on what we call the day ahead market prices, with a lot of data, back data, coming from a very established spot exchange reference. And all of this makes it good in terms of how it will play out in the long run.
But it isn't gold and silver and copper. I mean, it's slightly a difficult product in that sense and a market too. How long do you think and how much time are you giving yourself or your team to ensure that it reaches a point or a target that you would have envisioned?
It is very different from the other segments because they are tightly correlated globally, right? They are related and correlated, primarily because we also tend to be an importer in many of those segments. Electricity is ours, we produce it, we consume it, right? So it's really about India as a market and how that gets created. So it will take a little bit more time than what the other sort of segments have taken. But it's something that we need as a country. And I think we are positive about it. So we'll see these numbers certainly look much better by the end of the year. And I would say that within 2 to 3 years, we should see it starting to make its presence felt in the portfolio.
When you talk about electricity and there are various other products, that the conversation has been about whether it is about weather and renewables and carbon credit as a market as well. Is that something MCX is looking at actively too?
There will be a number of related products for sure. And I think I don't want to comment on it because we are looking at a pipeline of products. So, we spoke about what we've done on bullion with gold and silver, the new sub-products that have been launched across the spectrum. In the energy vertical, we've launched electricity in addition to crude oil and natural gas. If we look at metals, we've done a relaunch on nickel because that was a very liquid and successful product in the past till there was a global situation during the COVID time. So that's something we've relaunched, taking a lot of feedback from the market on how that needs to be designed. And then looking at agriculture, where we've launched cardamom, so which has its own niche space, but very important for the spice segment and, the players there. So I think these are going to be very important factors here.
So can safely say that there is an array of newer products and commodities that are in the pipeline that MCX is looking at?
Yeah. So I think these are examples of what we've done. There is a healthy pipeline and timed well, paced well, looking at when the market is ready. These will all come to market slowly.
Talk to us now about a difficult subject that you had to go through in the month of October, 28th October. And while you did continue to send out communications on what was really happening around that, but take us through on what really conspired and how have your communications with the regulator been on this right now?
Yeah. So I think if you look at context, right, and I'll just spend a few seconds on that. Our volumes and, we spoke about quadrupling of throughput. And similarly, over the last 2 years, there has been a quadrupling of volumes as well, right? When you look at parameters like orders per day, orders per second. So MCX has been continuously investing in technology because we can see the momentum, we can see the growth, and one has to be prepared for it ahead of the curve. And what really has happened is not really the headline sort of numbers that we look at, but one of the parameters, the parameter definition, that created this bottleneck. So it created a threshold, unexpected, unanticipated, which created the issue that day. So it took our team, and I would say, thanks to good efforts of a lot of trial and error that happened that day, that really led to the identification of the problem on the fly and a resolution in the time it took. Needless to say, it's not something that we want to happen again. So there are some very strong measures we've taken, in addition to all the work that we do on technology. So if I just run you through them. So first and foremost was the root cause analysis that got done immediately. I think by within a day or two, we knew what it was and we communicated that as well. In addition to that, we've also gone to market and we've brought in a third-party assessment of the root cause so that in case there's something getting missed internally, it gets picked up. So that is also completed and it has corroborated the root cause that was identified earlier. The next step is to say, hey, this is looking at the root cause, but why don't we actually put the whole system through a testing so that with real volumes, we are able to identify any other such threshold parameters. So that's something that is currently in process, will get completed very soon. The third is to look at a sort of expert panel along with third-party assessors to have a fresh look at where we stand from a scalability and resilience standpoint. So yes, the platform has been continuously upgraded to come to where it is today, but we have to make sure that it's fit for purpose as we look at scale going forward. And I will say, as we continue to invest in technology, the most important thing is the voice of the customer. And in our interactions, and we've had a number of interactions with our stakeholders. Most important stakeholders are our members and participants. So what I heard is, you have to be ready for 10x, right? And I think that was really a rallying cry.
A ringing thing, huh?
Yeah, and I said, and I think all of us agreed within MCX that I think that really is our goalpost now. So I think we are going for 10x, and we sort of ballpark numbers looking at something like maybe 10 billion orders a day. So that's what we're getting prepared for now.
Yes, as you said, your conversations with the industry, the stakeholders, the intermediaries has been on the positive side. But having said that, there were always also various statements saying, or, memes and WhatsApp messages suggesting, oh, the exchange isn't working. Maybe you can go to another exchange. MCX is perhaps 98 to 99% of what it does in this market share. Dealing with that day wouldn't have been easier. What have your also been engagements with this year? That's another thing that the markets are very, very curious about.
Yeah, so I think first and foremost, engaging with our participants, right? And we spoke about that. I think that was super important, and we've given that top priority.
And they've stuck with you all these years.
Yeah, I mean, they have stuck with us, and I think we are very happy and privileged to be part of that, ecosystem. Now, as far as the regulator is concerned, there are some processes. There are methods and timelines within which certain submissions have to be made, and so on and so forth. So all of that will following process, and will sort of play out in due course.
What has been the engagement till time? What is it that is going back and forth with the regulator on that?
I think those are part of the standard, SOP discussions. And I think pretty much in line with whatever I have explained till now.
You also earlier spoken about the 5-point mitigation plan. What are the key actions therein? What is it that you're looking at in sense of capacity building? You talked about 10x there. What work is being done there? What are the other timelines that you have in place?
Yeah, I think this is the 5 points that I mentioned some time back. And when we look at timelines and we say, look, we want to target to 10x, 10x may not be like a single short jump, right? So probably it's going to have 2 or 3 milestones. If I look at very headline numbers, and we've sort of quadrupled in the last 2 years. So if we say, hey, if I look at that as a potential run rate, and there could be best case, there can be like a better case, and so on and so forth. Looking at all of this, I would say we should look at a first benchmark in about 12 to 18 months as a milestone, and in 2 to 3 years, really be at the kind of levels we're talking about now.
I also want to talk about other products. The other launch that you had this year was Buldex, and a great year to have it because the gold and silver prices were doing best what they do. Very volatile, best year, all-time highs into that one. How are you looking to sustain it in a year, perhaps next year itself, when we may not be looking at that kind of volatility or price moves for that matter?
I think the commodity sector is at an early growth phase. When we look at global markets and we compare to where we are in India, we're still at an early growth phase. So I think when we look at the kind of products that India needs beyond what we have today, and when we look at the kind of participation that is also available and required, the measures to bring in more commercial corporate participation via hedging. If you look at all of these, so yes, there is a headline macro parameters that will always play a role, but across 4 segments and the product and participation, I think we are in a good place.
All right. Ms. Rai, please do stay on with us. We have to take a very quick commercial break, but we'll come back and we'll talk to MCX MD Praveena Rai on her plans going forward on how do the next 3 to 5 years look, what are the visions from here, and especially what is the next year looking like in 2026 after this very short break.
Welcome back. You're with us at CNBC-TV18. We have with us in our studios Praveena Rai, who's MD and CEO at MCX. Mr. Rai, we spoke about gold and silver, and you spoke about metals as well, on how they have done quite well in sense of consolidations. The efficiencies are building great, and you're looking at participation coming in on the stronger side there. What is it that you're looking at to growing from here on when it comes to the existing products? We've seen you introduce more financial products within the instruments itself, whether it has been about quarterly, monthly, options also. What is it that you're trying to do now with the existing commodities? Where do we go from here?
I think our existing commodities are doing well. For example, one of the steps we've taken on metals, hearing the feedback from our market, is to consolidate warehouses, right? Because there are some challenges around GST when you have multiple warehouses. And this is more about procedural challenges. And it's important that the warehouse is located for suitability of supply and consumption. And we have data because these have been around for a while. So we've really looked at where it matters, taken feedback from the industry, and consolidated. So for example, in copper, there is a single warehouse now in Thane. Same with zinc, aluminum, etc. So they've also been consolidated. Some warehouses which were not required have been reduced. So we've looked at a difference between the trading unit and the delivery unit with the new nickel launch. This will make sure that there is access and availability reach for the small, medium sector participants for whom large sort of capacity is not either required or affordable. So I think these are some of the steps that we've taken when it comes to the metal segment. And similarly, work is on across all the segments. I think we are very fortunate to have participants, members, great teams, within MCX, all of whom understand the domain very well. And, I think that's when the magic happens, when they all come together. And that's how the creation will be. So I think it will be a co-creation exercise. It will be a consultation exercise. It will be a collaborative exercise.
Okay.
And so we may have some theoretical ideas looking at commodities and product design based on scale, based on volatility, based on global studies, based on what we think India needs. But ultimately, it will be the coming together of all of this that will answer this question of yours.
So there are three P's really: prices, which you won't talk about, and products you have spoken about. The third really is about participation. How are you looking to deepen that one? Because if you look at SEBI regulator, and he's been talking on various forums, he's talked about pension funds perhaps going to be allowed in commodities. There has been conversation about on how we can perhaps be price makers and not price takers. A lot of conversation really going around. How are you looking at that part? And the second, of course, is about hedging mechanism, allowing or enhancing or ensuring that you have SMEs and MSMEs being part of this.
Yeah. No, I think let me pick up on the price benchmark first, right? Being price makers, that's very close to heart, very close to my heart. Because in India, if you look at, for example, bullion, pretty much, I think MCX gold prices, for example, are the
benchmark right
now. They tend to be used across the industry, so on and so forth. But we do still have international benchmarks, right, getting used within our industry as references. So I think there's been a consultation paper. Of course, we've given our input, so has the industry, and we are looking for some of that to play out. And I would think bullion is a starting point, and we should be looking at this across the spectrum. Because when we look at international prices, ultimately India prices are, duties and sort of logistics, but ultimately there is a India demand supply element that comes in that creates that premium discount. So no matter how correlated we are with international markets, there's nothing like creating our own price benchmarks. Your question on participation, there is scope for expanding participation. Today there is good participation when it comes to proprietary firms, when it comes to HFTs, when it comes to traders who are trading on various commodities, when it comes to retail. The scope, right, to really expand participation across many other segments who are extremely active on the equity side is strong. And we see that working globally, but it's also a big and important opportunity for India. It will have to happen in a calibrated manner, looking at what are the rules and sort of frameworks within which they have to operate. So I believe that we'll be looking at some, we hope that we'll be looking at some positive momentum there.
When it comes about participation, it also is not just about the smaller hedgers, it's also about corporates and hedging mechanisms that are being created in India. We still do know that after so many years as well, there are big corporates which still are hedging outside the country. While there is a law, and of course they have to now tell on what are they hedging and how much, and whether or they're hedging or not to begin with. But how is the exchange really looking at policy and framework changes within that?
Yeah, I think it's very important that the platform becomes more and more relevant for large hedgers, while they may be hedging smaller components. And for that, I think if there is some sort of incentive mechanism that can be created, that would be wonderful. Certainly cost of hedging in India, straightforward in the rupee, without all the currency, hedging, et cetera, is a no-brainer.
Right.
But change is always a transformation, and I think we will see that happen step by step.
How are you looking at the growing curve for MCX from here on? What is it that Praveena Rai is thinking about for the next year, 2026, that is a near term, and then a 3 to 5 year as a horizon?
Yeah. So I think 3 pillars, and I speak about them all the time. Number 1, the solid foundation is the compliance and regulation. So our own compliance as well as the integrity of the market that we operate. On that bedrock is really the enabling operating framework. So operational excellence, we spoke about investment in technology, our vision for how we want our technology to work and where do we see that being an enabler for growth. And then finally it comes to products and participation. We spoke of products, we spoke of participation. Yes, we will be looking at a pipeline of whatever is required in the commodity space. We will be looking at, also looking at capacity building when we look at participation, because that's going to be very important across the industry. So these would be, and capacity building, I would put it in that little longer time frame. It's not a immediate activity, but these would be the simple actions, and the devil is in the details, and it's all about execution. The shared purpose, and I come back to the point about shared purpose, and I hear it all the time. So I think to have an industry which has that shared purpose, our teams, who are really passionate about making this happen, we'll have to execute this through.
Also, Ms. Rai, when you look at overall commodity markets in India, it still is a very niche product, would you say? It's been around for decades now. And yes, it still is at an infancy, if you may say so, as compared to the other financial instruments and other financial